You've got Bostic coming on. They're very vociferous in their bones, doves. But by the same token, you've got Cleveland staying on for the first 6 months. Those first 6 months are going to be critical because the closer we get to election, the less the Fed's going to do. Remember, they have a meeting that ends on November the 7th, 2 days after Election Day, which means September the 18th is their last opportunity really to do anything. If you look back historically, they don't like to tread in the month of October. And they're actually pushing their meeting back from November by a day. So that first 6 months of 2024, that's when you're going to potentially see action or not out of the FOMC, depending on what this data do.
Because looking at our data right now, we have just under 2 rate cuts priced in by June 12th. Is that ambitious? I know you're saying basically the market is fighting the Fed, but does that kind of jive with what would be realistic, all things considered?
So what I don't think is that the Bureau of Labor Statistics can continue playing this game forever. They've been playing it for a long time. At some point, I think reality is going to catch up to the data and the Fed's hand will be forced. But I think that Powell would prefer that that be in May, not March.
All right, I'm looking at ECFC, the economic forecast function on the Bloomberg terminal. Tells me a couple of things. Probability of recession, 50%. I guess I could have done that. But I don't see any quarter next year negative GDP in the forecast here. Are you feel comfortable with that, or do you think there is, in fact,
a fellow by the name of Ben Herzon, he's now at S&P Global, but he effectively 30 years ago invented the GDP model that the entire street now goes off of.
Okay.
So he's at 0.7% for the fourth quarter of this year.
That's what we got.
And that tells you that you are a sneeze away from a disappointment that could actually flip that negative. Look no further than Germany. I mean, this morning, industrial production out of Europe came out, and it was awful. It was 2 times worse. And what we're seeing is that the big 3 automakers front-loaded a ton of production before the strike. Now we're seeing that come off. We're seeing it come off in rail traffic. So you could have a big backlash on the industrial side that can easily sway that GDP math.
The consumer's still out there ripping. I mean, right?
The consumer is technically still out there, yes. But delinquencies are well above what they were prior to the pandemic, and they keep going up. And you're seeing buy now, pay later delinquencies go through the roof, especially with the 20 to 30, 30 to 39-year-olds.
Yep. Isn't that just what we did, John? Layaway? Isn't that the same thing?
It's called layaway.
Didn't we do that back in the day?
It's, what do they call it now? Pay.
It's buy now, pay later. But remember, with layaway, you had to leave the merchandise at the store.
Okay.
And now it can be a Mai Tai that you can spread out over. I mean, try to get getting a drink back.
Exactly. Danielle DiMartino Booth, CEO and Chief Strategist at QI Research, our go-to voice on all things on the Fed and the economy. We appreciate her coming into our Bloomberg Interactive Broker studio. We're going to have more coming up. This is Bloomberg. Let's get some company news right now with Steve Rappaport.
All shares of Tesla are down after the EV maker recalled more than 2 million vehicles because of problems with their autopilot system. We get the latest from Bloomberg News Global Autos editor Craig Trudell.
This dates back actually to August 2021 when the National Highway Traffic Safety Administration opened an investigation into autopilot after several crashes into first responder vehicles. So there would be an existing crash scene that the Tesla would come up on and run into, say, a police car or a fire truck. And since then, actually, NHTSA has opened a separate defect investigation into autopilot. There's been all sorts of scrutiny into these systems going back years.
Bloomberg's Craig Trudell reporting. Pfizer stock plunges more than 8% after the drug maker missed the mark on sales and profit outlook for next year. Bloomberg's Lisa Mateo reports.
Steve, Pfizer's forecast fell short even after the company purchased a cancer drug maker that's producing some of the hottest treatments in the oncology market. Pfizer says sales for 2024 will reach $58.5 billion to $61.5 billion. Wall Street analysts ballparked a figure of nearly $63 billion. Pfizer cut revenue guidance twice this year as demand for its COVID-19 vaccine and pills dries up. Steve.
Thanks, Lisa. Netflix opens the books on viewer data. The streamer issued a report yesterday detailing how many people watch every title on its service. Netflix says its political thriller, The Night Agent, was the most watched title globally in the first half of 2023, generating 812.1 million hours of viewing. Those are the company stories we're following this hour. I'm Steve Rappaport. This is Bloomberg.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. I guess we're kind of treading water right now. 2-year yields, we'll start there. They're lower after wholesale inflation. When you strip out energy and food, that came in flat rather than the expected increase. And with the Fed meeting announcement this afternoon, the data unlikely to move the dial a lot, but still kind of a dovish sign. Pfizer shares most active, down almost 9%. Earnings forecast for 2024 below estimates. They also forecast sales that missed expectations. And Steve was just talking about Tesla. Right now, that is among the most actively traded. And it is down 1.6% after that recall. And then in the oil space, West Texas Intermediate edging higher right now, but it's near $69 a barrel after plunging yesterday. It was 3.8% lower yesterday. There are persistent signals supply is eclipsing consumption. Right now, the S&P 500, 6 points higher. We're at 46.49. Dow Jones Industrial Average, 16 points lower. And the NASDAQ 100 right now up 57 points. That is a 0.4%. You know, if you type ECAN GO on your Bloomberg terminal, I guess that's economic analysis. You look at the makeup of inflation, in this case, consumer inflation. And in the below the zero line, that's energy. It's actually deflationary right now.
Nice.
I think it was like $3.20 at the Wawa for filling up.
Ours was $2.98, I think, at some discount gas in the suburbs of West Orange.
Oh, there you go.
Yeah.
New Jersey's the place to be, apparently, for
Cheap gas.
cheap gas.
Don't go to California here.
No. So anyway, that is your Bloomberg Business Flash. I'm John Tucker, Bailey, and Paul.
All right, John Tucker, thank you so mumuch. We appreciate it. Bailey Lipschultz, Paul Sweeney live here in our Bloomberg Interactive Broker studio and streaming on YouTube. So head over to youtube.com and search Bloomberg Radio. Look at MA Go. MA Go. And I'm just clicking on the time series. It was a terrible year for M&A. I mean, less than $3.5 trillion. You compare that to 2021, which was a banner year of about $6.5 trillion of deals done. I mean, this is the weakest year since 2013. How about 2024? Any better? Let's check in with Ted Smith, co-founder and president of Union Square Advisors. Of course, his highlight of his career when he was a managing director at Credit Suisse First Boston. I think we crossed paths there back in the day. Hey, Ted, talk to us about 2023. What did you see in the marketplace? And more importantly, what are you guys in the M&A biz thinking about 2024?
Morning, Paul. Great to be with you again. Thanks. Well, you hit the nail on the head. It certainly has not been a great year for M&A in 2023, off almost half from the peaks of 2021. We saw a lot of fits and starts this year. Heard the earlier commentary with Danielle about where things are with the Fed. That certainly put some freeze on the market. The higher cost of capital for longer meant that some folks stayed on the sidelines. Also, as the large corporate acquirers were thinking about whether they wanted to get back into the market or not, took longer, frankly, than we thought at the beginning of the year. So we started to see some green shoots really in late summer and right after Labor Day. We do think activity is picking up now and will continue into 2024. But we were delayed by about 6 months from our beginning of 2023 forecast on when we thought M&A would start to pick up from 2022, which itself was significantly down from 21.
And Ted, when you look at, though, question around regulatory uncertainty, it seems like the FTC is pushing back against everything. Is that something that's top of mind at all?
It certainly is. I mean, we think about it, and obviously acquirers think about it. Such a big part of the market, though, today is about private equity as acquirers, not just the strategics, and they typically are not as wound around the issue from a regulator's perspective. And also, we've seen an approach for a long time from the large strategic acquirers of asking forgiveness rather than permission to do a number of these deals. So we think that attitude will continue to pervade. The FTC clearly and the DOJ clearly want to flex their muscles here amongst the really large tech acquirers, and we think that will continue to be the case. On the other hand, there's a lot of other acquirers out there other than the Magnificent Seven that we think don't get as much scrutiny and will probably rise up and participate in more M&A.
Ted, the era of free money is over. You know, we've got a 10-year trading north of 4% here, so the cost of debt capital is higher for acquirers. How is that impacting kind of activity, structures, that kind of thing?
Yeah, we definitely saw a little more structure both in terms of because of the cost of debt, but also just uncertainty in the market generally. But the reality, at least for technology companies, where at USA we spend our time, is that the cost of debt is still cheaper than the cost of equity in most cases. So while it's more expensive than it was a year ago, 2 years ago, the total explosion in private credit that we've seen over the last couple of years has really made debt still a possible source of capital, a meaningful source of capital. We just completed a $460 million transaction that was exclusively done in the private credit market for a large private equity firm and one of its portfolio companies. So it's available. Yes, it's more expensive than it has been, but we continue to see the private credit markets being really active, particularly in the tech sector.
And Ted, I talk to IPO bankers for the bulk of my day, and they keep kind of pounding the table on valuation discrepancy. When you look at private equity buyers who are in need to return some of the cash to LPs, are they going to cave on valuation, or how are those conversations going to play out?
Yeah, I think it's a really good question. I think we continue to think that the IPO market is going to be tepid going forward. I was an IPO banker for the first phase of my career, and so I've seen this up and down movie before. But we really just don't see a lot of product likely to come loose in the IPO markets. We do think those private equity buyers who do need to return capital to their LPs are more likely to pursue sales to either strategics or other private equity firms, but far more frequently and at more volume than we'll see in the IPO market. And if they do cave on value, we think that's going to be the exception to pursuing an IPO rather than the rule.
Hey, Ted, I know you guys at Union Square Advisors, traffic a lot in the tech space. If I go out to Sand Hill Road and look for some capital, or if I just go talk to the folks out there who are the VC folks, who are the real capital folks out there for the tech industry, what's the mood out there on Sand Hill Road these days?
I think it's we're glad 2023 is almost in the rearview mirror is one big part of that. There continues to be a lot of focus around investment around all things AI, although I think the irrational exuberance around that is even coming down a bit. Again, I used the term green shoots earlier about what we were seeing in M&A. We're certainly seeing a little bit of an unloosening of the purse strings in earlier stage VC, which obviously then leads to mid-stage and late-stage VC investing for the right companies. So I think right now the mood is we're going to get through the end of the year. We're going to take stock of where our portfolio is, but we want to put more capital to work in 24 than we did in 23.
And looking at 24, how does that timeline play out? Do we see a flurry of activity, call it second quarter, ahead of an election in November and elections globally, or how does that shape up in 2024?
It's a really good question. It's somewhat ironic that we're sitting here talking about that the more stable year is going to be the election year than the year that we just went through. But we do think that may, at least for the first half of the year, that may be true. We're working on a number of transactions where we've been in prep mode for the fall that are going to launch in January. I expect our competitors are doing exactly the same thing. So we do see sort of a Q1, Q2 flurry of activity well ahead of what we've seen in 2023. And then the uncertainty that the elections always inject into the markets may take over as we hit summer and early fall leading into the elections. As we all know, markets hate uncertainty, so we'll see some up and down on that. We may see some slowing in both the investing and the M&A life cycle as we move closer to the election. And then we may see a lot of activity post-November once it's clear one way or the other which way things are going, at least in this country.
And Ted, one of the things that's new to me, at least, compared to when I was in your game on the street, is the growth of private credit. How important is that to just getting deals done? Because we talked to a lot of private credit people, and the capital is flowing into their funds like crazy, and they're really, really active. Talk to us about that private credit business and what it means for your M&A market.
Yeah, it's today, Paul, it's north of a $2 trillion asset class. So to your point, a lot of money has gone into it. We continue to have that be an incredible part of the work that we're doing in our off of our capital markets desk. We're not underwriters, we're arrangers, but we still have a tremendous business led by Mike Meyer, who's driving that for us. They're part of virtually every deal that we do on the financing side, unless it's a pure equity deal. And then when we're talking on the M&A side, if there is going to be a debt component associated with it, again, we'll tap a broad range of relationships in that private credit market. So that's a long-winded way of saying they've become incredibly important, not only to our business, but to the tech business broadly over the last 5 years. And we don't see that dimming at all.
And how does that structure play out in 2024? Are we seeing a mixture of debt being brought on and some of those cash offers? Do you see kind of earnouts being part of that in 2024?
We've seen more structure. We've seen some earnouts. We've seen other sort of bells and whistles, if you will, higher preferences in certain investments. Not in every case, but in some over the course of 2023 as people evaluated being a little more risk averse. I think as we go into 2024, I heard the great conversation about what's happening in and around the Fed as we start to see some stabilization and some easing there. We think some of that structure may fall away a little bit. But generally, that market will be very active, and we will see a combination of debt capital used and cash on hand by strategic buyers, and for private equity buyers who, again, have big checkbooks but also like to use debt to increase their returns. We think they'll be very active in doing that in 2024.
Ted, thanks so much for joining us. Really appreciate getting your thoughts here. And Ted Smith, he's a co-founder and is president of Union Square Advisors, financial services firm, M&A, focusing on the tech space, based in New York and San Francisco. Got a good view of kind of what's happening in the world. They're getting a little update on the M&A market, which again, less than $3.5 trillion in deals so far this year, compared to 6.5, which was a boom year in 2021. So a weak year for M&A in 2023, maybe a little bit of a bounce back in 2024. Looking at the markets here, S&P up about 0.1%. The NASDAQ up a little bit more than that, 0.3%. We'll have more coming up. Right now, let's head down to Washington, D.C. Amy Morris has got world and national news for us.
All right, thank you, Paul. Hunter Biden on Capitol Hill in a defiant statement. The president's son lashed out at GOP investigators and says he'll only testify in public. Today's scheduled session was to be closed door only. Hunter Biden's overseas business dealings are at the heart of an impeachment inquiry House Republicans launched against his father, President Biden. The COP28 climate talks in Dubai ended in an historic deal, committing the world to a transition away from all fossil fuels for the first time. The final agreement calls for countries to quickly shift energy systems away from fossil fuels in a, quote, just and orderly fashion. Ukrainian President Vladimir Zelensky's in-person push for war aid in Washington left him mostly empty-handed. Bloomberg's Anne-Marie Hordern reports that the president failed to win over Republicans who want the administration's $61 billion funding request tied to tougher enforcement at the southern border.
Lindsey Graham couldn't be more direct about it. This is an individual who is a defense hawk, and he said, I told President Zelensky my number one obligation is to secure my country as well as help yours. Republicans want a strict border policy or there's not going to be Ukraine aid.
Bloomberg's Anne-Marie Hordern reporting from Washington. Nearly 3 years after that mob tore through the Capitol, January 6th, still casting a long shadow over Congress. Jonathan Tamari covers Congress for Bloomberg Government.
So it's something that continues to trail Congress. And really, it's rising up again with Donald Trump seeking re-election, still claiming he won, talking about pardoning rioters, and many of his allies having even more power in Congress. So it's a scar that I think will continue causing problems in the Capitol.
That's Bloomberg Government Congress reporter Jonathan Tamari in Washington. Global news 24 hours a day and whenever you want it. With Bloomberg News Now, I'm Amy Morris, and this is Bloomberg.
events, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. S&P 500 kind of wavering after closing at the highest level since January 2022. Traders are waiting for any indications on whether the market's aggressive, dovish bid is now overdone. We're going to get the Fed decision this afternoon, along with a summary of their economic projections and comments from the Fed Chair Jerome Powell. Well, just a few hours ahead of the decision, we had data this morning that showed wholesale prices gains. The gains there slowed as energy costs declined. And meantime, Alberto Gallo, he's at Andromeda Capital, saying investors need to respect the momentum in the markets.
Investors in the rates market are pricing in a lot of cuts for next year, and the equity market is at a high and volatility is at a very low level. So it's a period where you want to step back. You want to be respectful of the fact that the market can keep going.
Tesla has a recall covering more than 2 million vehicles. As a result of that, among the most active, its shares down 1.4%. And then you have Pfizer. That's the biggest laggard right now in the overall S&P 500. Its shares down 8.5% after delivering a disappointing forecast. Overall, the Dow Jones Industrial Average 10 points lower. S&P 500 is 8 points lower right now, and the Nasdaq 100 8 points higher for the S&P 500. I should add. The Nasdaq 100 right now up 60 points. That's a rise of 0.4%. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash, Bailey and Paul.
All right, John Tucker, thank you so much. We appreciate it. Bailey Lipschultz, Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio like we usually are. Also doing that YouTube thing, so you can see live streaming video, youtube.com, and search Bloomberg Radio. When we hear from Fed Chairman Jay Powell, a lot of forecasters are saying that he's probably going to point out that maybe the market's a little ahead of itself, a little over its skis, if you will. We had the 10-year Treasury go from 5% down to 4.16% today, just for example. Let's check in with Kara Murphy. She does this stuff for a living. She's a CIO at Kestra Investment Management. Kara, we've had some kind of Santa rally here. I'm not sure what we want to call it, but boy, it's been a good November going into December here. What do you make about what we've seen from the markets in the last 4, 5, 6 weeks?
Yeah, I think you're absolutely right. And that Santa came early this year. So in many ways, the rally that we've had is very much in keeping with seasonal trends that we see, where September tends to be the worst performing month. October tends to have the most market bottoms. And then the last couple of months of the year tend to be quite strong. So what's a little bit different this year is that rally really came, around Thanksgiving time rather than Christmas time. And one thing that's changed a lot from the beginning of that period to the end is that by the end of October, technicals were looking very, very constructive. So a lot of indicators were suggesting that the market was sold off, that pessimism was high. Those are usually really great entry points. Now those are really reversed, where there seems to be a lot less pessimism in the market. A lot more names are trading at recent highs. So a little bit of that, sort of reason for buying into the market today is less there than it was 2 months ago.
Have we gotten too far, though? The S&P is up 13% from an October bottom. We've got the market pricing in 100 basis points of cuts next year. But earnings have, broadly speaking, held in relatively strong.
Yeah, there's certainly been an awful lot of momentum. And let's not forget that much of that return in the S&P is because of a handful of names. Equal weighted S&P, I think, is running about 7% so far year to date. So we've seen, a fair amount of exuberance into stocks. But as you said, the earnings cycle has clearly turned. Last quarter really seemed to show a bottom kind of across the market in terms of earnings. And then when you look at things like valuation, it's not signaling a big red flag. We're a little bit above average, but typically the market can hang out there for a very long time without trading down again.
So, Kara, what do you think we will hear from Fed Chairman Jay Powell this afternoon?
I think Powell has absolutely no incentive to say anything except more of what he's been saying, which is pause, pause, pause. There's no reason for him to help the market continue to get excited that interest rate cuts are on the horizon. Inflation overall, although it's trending in the right direction, it's still not back to where the Fed wants it to be. And in fact, when we look at the CPI report from yesterday, yes, overall looked pretty good in line with expectations. But one thing I want to highlight is if you look at goods prices, those continue very much in a downtrend. Services prices are still fairly sticky, and that's really where Powell and the rest of the Fed are going to be focused on to make sure that that is significantly in a downtrend before they start talking about cuts for next year.
And what are we going to see with the dots, though? And can the market continue to look through what Powell is saying about higher for longer?
So I think we might see the dots move a little bit, but typically the market is very comfortable looking through what the Fed is telling us is going to happen. And to be honest, neither the market nor the Fed has a fantastic track record of predicting where things like GDP growth, interest rates, and even the Fed funds rate are going to go. So I don't think that'll have that much of a lasting impact on the market and the expectations.
Kara, I think the last time we spoke, you were saying that you guys were overweight equities. Given the move we've had, is that still the case?
We are still overweight equities in general. So when you look at the relative performance of equities versus fixed income, despite the fact that there's a little bit of caution there because of technicals, we still think that there's a fair amount of momentum, particularly as earnings starts to pick up. Now, fixed income, we do see a lot of opportunities still. We would just be cautious about going too far out on the credit curve, particularly in the high yield space. But overall, we think we're in a much better position in both broad asset classes than we were, a year and a half ago.
And when you look out in 2024, what are some areas in the equity market that you see more upside value to?
So technology, interesting, despite some of the really strong gains that we've seen this year, we think that there's some really interesting opportunities kind of outside those, those ones that have really led the pack. But that's an area broadly where you see improving corporate profit margins. Earnings are starting to pick up significantly. And so we think some of that momentum can continue into next year. But then on the other side of the spectrum, we see opportunities in energy, an area that's been really beaten up. We saw briefly a period where those shares and underlying oil prices and whatnot picked up in the middle part of this year, but they've really retreated. It's also an area where for a very long time, we think that there's been a lot of underinvestment in infrastructure associated with that space. And so that will provide some longer term opportunities in energy as well.
All right, so when I type in INGO in the Bloomberg terminal, it gives me the Bloomberg Index browser, total returns year to date across a number of fixed income spaces. And in the U.S. fixed income space, the best performance this year, which surprises me, is U.S. corporate high yield up over 10%, really outpacing anything else in fixed income. How do you guys think about the high yield space? Because I would have thought, but everybody's talking to me about a recession. I'm not sure I want to own high yield here.
I agree, and I think that's part of the reason for our caution. So a big part of what's been driving that performance of high yield so far this year is declining credit spreads. So usually you're willing to take a fair amount of risk if you're being paid for it. But with these really tight credit spreads, you're really not being paid to take that additional risk. And what we're seeing is that a lot of those high yield companies, things like debt coverage ratio are declining. They've done the right thing, and in this higher interest rate environment, they're shrinking the duration of their debt, right? They're trying to buy themselves some more time for interest rates to come back down again. There's only so long that you can play that game, right? And the risk is next year the Fed holds rates higher for longer, and those companies really get squeezed. And so that's the reason why, for that kind of what we think is a little bit more frothy area of the market, we would be more cautious.
And how do you see that playing out within bankruptcies in particular, just given a lot of the companies we saw go public and are still private kind of stretched beyond their limits?
Yeah, and it's interesting to me that people aren't really focused on this uptick in bankruptcies. I mean, if you look at where we're trending right now, we're at the highest level of bankruptcies that we've seen since 2010. So there is this stress that's starting to show up kind of underneath the covers a little bit. And again, as long as interest rates stay high, we're going to start to see that accelerate into next year because companies will have sort of bought all the time that they can. And in fact, if you just look at these numbers just came out, the NFIB Small Business Optimism Index, that's actually at the lows that we saw in COVID in early 2020. So small businesses are definitely feeling the pinch.
All right, Kara, thank you once again for joining us. We always appreciate getting your thoughts on these markets. Kara Murphy, she is the CIO of Kestra Investment Management, giving us her thoughts on the markets. And again, just looking at the markets here today, just a little bit of movement, a little bit of green here. The S&P's up about 0.2%, NASDAQ up about 0.3. And on that yield front, the 10-year Treasury is off about 4 basis points, 4.15%. Boy, we're just at 5% there in late October. What a big move in rates we've seen. We'll have more coming up. This is Bloomberg. Let's get some company news right now with Steve Rappaport.
All shares of Apple are up less than 1% after the company announced expanded access to its self-service repair. The latest on that from Bloomberg's Jeff Bellinger.
Steve, Apple's do-it-yourself service is now available for the iPhone 15 lineup and Mac models powered by the M2 lineup. The tech giant also expanded self-service repair geographically with access in 24 additional European countries. Additionally, Apple launched a new diagnostic process that it says will give users more transparency and autonomy to troubleshoot issues. Apple Diagnostics for self-service repair is available today in the U.S. and coming to Europe next year. Steve?
Thanks, Jeff. So with all the hype surrounding those hot weight loss drugs like Ozempic and Wegovy, some food companies worry those treatments will eat into their profits. Nestle, not one of them. Just ask CEO Mark Schneider.
It's not so much a threat for us, it's more like a full-blown vindication of the strategy that we've been pursuing very patiently over the years. Take our high-growth categories that are not impacted by GLP-1, pet care, coffee, and our Nestle Health Science business. That used to be 30% of our business in 2016. It is now about 50% of our business. So clearly this is where portfolio rotation prepared us for this lower calorie, higher value future that we've been pursuing. So it's not impacting us.
That was Nestle CEO Mark Schneider on Bloomberg TV. And Tesla will fix more than 2 million vehicles to address concerns from regulators about the autopilot system being misused. Those are the company stories we're following this hour. I'm Steve Rappaport, and this is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, looking at these markets, a little bit of a gain here. S&P up 0.2%, the Dow pretty much unched, and NASDAQ up 0.25%. Yields come in slightly here. We've got the 10-year trading at 4.15%. WTI crude oil up a buck, $69.60. And let's talk Bitcoin. Tom Keene's not here, so we'll get it out there. It's up about 2%, 41,900 for Bitcoin. Right now, let's head down to Washington, D.C. We'll get more of the national news with Amy Morris.
All right, thank you, Paul. Divisions between President Biden and Israeli Prime Minister Benjamin Netanyahu over the conflict in Israel has spilled now into public view, with leaders offering competing visions for the post-war Gaza Strip. We get more from Bloomberg's Roz Matheson.
Really, for the first time, Joe Biden publicly castigating the Israeli Prime Minister, saying that things are not going in the right direction, that they need to think about their plans, especially in the aftermath of this war. And that was highly unusual.
Bloomberg's Roz Matheson. Biden also labeled elements of Israel's bombing campaign as indiscriminate. A prominent donor to President Biden's 2020 campaign is now throwing his support behind long-shot primary challenger Dean Phillips. Galaxy Investment CEO Mike Novogratz says he thinks both the president and Republican frontrunner Donald Trump are both too old to run in 2024. Brown University political scientist Wendy Schiller says she doesn't think President Biden's going to step aside.
He believes that he is the most experienced candidate. He believes he's the only person who's already beaten Donald Trump. And you have to shake him of that belief. So if there are poll numbers out there that show somebody else can do it more easily and more definitively, then I think he'd listen to that.
Wendy Schiller of Brown University was a guest on Bloomberg Surveillance. Hear more of her thoughts on the 2024 race on the Surveillance podcast. Emmy-winning actor Andrew Brower has died. He's being remembered as one of the most versatile actors of his generation. Brower most recently was known for his role as the deadpan Captain Holt on Brooklyn Nine-Nine. He made his film debut in Glory, but found his breakout role as Detective Frank Pembleton in Homicide: Life on the Streets. He's won 2 Emmys. Andrew Brower died after a short illness. He was 61 years old. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Amy Morris, and this is Bloomberg. Paul and Bailey.
All right, Amy, thank you so much. We appreciate it. SpaceX value jumps closer to $180 billion in tender offer. Here's the reporting. SpaceX will sell insider shares at $97 a piece in a tender offer, a price increase that boosts the value of Elon Musk's space and satellite company closer to $180 billion. That's according to people familiar with the matter. The world's second most valuable company, closely held startup, has been discussing a tender offer that could range from $500 million to $750 million, Bloomberg News reported on December 6th. The share price increase from the roughly $95 discussed last week, said the people who asked not to be identified because the information is confidential. The rising valuation illustrates strong investor demand for a stake in a dominant space transportation company and its fast-growing Starlink internet from space service. Wow. Good news for the employers and the employees who can, cash out.
Cashing out. I mean, the question is, do you want to? This is, as you mentioned, Paul, the second most valuable private company, only second to ByteDance, the owner of TikTok and Temu and a number of other things. This is exactly what I talk about most of the day. Finally. But when you look at some of the trading on secondary platforms, everyone talks about SpaceX value not falling off. A lot of the other companies.
Remind me what SpaceX does. It's going to send me into space.
No, well, they have a whole portfolio. So you have Starlink, which is all the satellites.
Okay, that I get.
That's internet service from space for underserved areas that don't have the towers and all that kind of stuff. So that's the real business.
That's the valuation?
And then they shoot up spaceships. How cool is that?
I mean, looking at the Bloomberg reporting, booking about $9 billion this year across rocket launch and the Starlink businesses and revenue. So,
do I sound skeptical?
Well, do you think Tesla's overvalued where it's at right now?
I'm just not going to say anything.
So, I want to see who's buying this stuff. You know, I understand the sellers, employees, this is a big part of I'm sure their personal net worth, get some value there, get some liquidity. That makes a ton of sense. Just wonder who's going to be buying here and what is it, VCs? Is it strategics? Really interesting to see, but the values are extraordinary. This is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
Why were the economists so wrong? What are the economists getting wrong?
Isn't this a slam dunk time to buy U.S. Treasuries?
Soft landing, hard landing, no landing. I don't know.
True. What the heck does that mean?
I don't know.
Breaking market news and insight from Bloomberg experts.
We're going to be in an environment with higher rates for longer.
The 5-day in-office work week is effectively dead.
It's definitely a good sign that we're not ready to land this economy just yet.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, coming up in this hour, we're going to have a heavy dose of the experts from Bloomberg Intelligence. First, Sam Fazeli. He's head of European research, and he's a pharma analyst at Bloomberg Intelligence. He's over in London or Burgundy, France. I can't keep track. He's all over the place. But anyway, we're going to talk a lot of healthcare, weight loss drugs. Pfizer missing some numbers here. A lot to talk about with Sam Fazeli. And then Steve Mann, global auto market research leader at Bloomberg Intelligence. He was in Hong Kong for us, for Bloomberg Intelligence, for 6, 7, 8 years. He's back in Princeton, back on USA soil. So we're going to check in with him with the auto industry, particularly Tesla. Have a recall of some cars out there. And Joanne Bianco, partner at Bond Blocks. We're going to discuss ETF flows and investing strategies in the fixed income space for ETFs. Let's kick everything off this hour with Mr. John Tucker.
All right, you mentioned those two stocks. Let's start with that. Pfizer is the biggest laggard right now in the S&P 500. That is down 8.7%. Tesla among the most active after that recall. That is down 1.2%. But overall, traders kind of treading water as we wait for the Fed decision on rates this afternoon. We also had this morning more evidence of a cooling rate of inflation measure of core wholesale prices. That strips out food and energy. That rose 0.1% last month. So that brings the 12-month rate of change to 2.5%. That's the slowest rate since February of 2021. Meantime, Andrew Hollenhorst of Citigroup says the Fed today will try to present the message that rate cuts are premature at this point.
I don't think that that's a message that's going to be believed by markets. I don't think it's a message that's meant to be believed by markets. So they're in a little bit of an awkward position here because clearly the next move is going to be a cut. But technically, the bias is a hiking bias. So that's what they have to navigate today.
And right now, 8 of the 11 major industry groups in the S&P 500, they are higher, being led right now by utilities. Overall, the S&P 500, 10 points higher. That's up 0.2%. 46.54 on the index. Again, we're about, 3% away from a record close. The Dow Jones Industrial Average, 18 points higher. The NASDAQ 100 up 59 points. That's a rise of 0.4%. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash. Bailey and Paul.
John Tucker, thank you so much. We appreciate it. Bailey Lipschultz, Paul Sweeney. We're live here in the Bloomberg Interactive Brokers studio. We're also streaming live on YouTube, so you can head over to youtube.com and search Bloomberg Radio. And we are also now in your dashboard with Apple CarPlay and Android Auto. It gives you access to every Bloomberg podcast, live audio feeds from Bloomberg Radio, print stories from Bloomberg News in audio form, and the latest headlines at the click of a button with Bloomberg News Now. How do you get it? Well, the good news is it's free with the latest version of the Bloomberg Business app. That's the Bloomberg Business app. Get it on your phone in the Apple App Store or on Google Play. Just download the app, connect your phone to your car, and get started. And it's all presented by our sponsor, Interactive Brokers. Some good stuff there. Tom Keene is all over Apple CarPlay with the tech savvy that we know Tom Keene is. So he's all over it, a big proponent. Let's check out what's happening in the markets here. Jess Menton, the pride of College Station, Texas, earlier did a stellar job interviewing the CEO of Southwest Airlines. Jess, what are you looking at here?
Well, mentioning what you were talking about when you, me, and then Tom Keene talked to Bob Jordan, the CEO of Southwest. If you look at this stock this morning, LUV, the shares are down a little bit more than 5% today. If you look at that stock year to date, down 15%, though. If you do look at Southwest, it did raise its outlook for the fourth quarter revenue, and it was helped by higher travel demand and ticket prices than it had expected over the year-end holidays. And so when we were speaking with Bob earlier with Tom Keene, he was talking about as far as the outlook for the consumer as well as the economy, he sees brighter times ahead. He doesn't necessarily, because we talk so much, Paul and Bailey, also John Tucker, sort of this debate about whether or not a recession could be around the horizon. But when you look at a lot of this data, especially the consumer type data, still appears to be pretty resilient, and he sees that as well. So that was pretty notable. As far as when it comes to looking at some of the major indexes, though, the Dow Jones Industrial Average less than 1% away from its all-time high. Also, if you look at the S&P 500 when it comes to the total return index, that's actually already trading at a record. So that obviously includes reinvested dividends. But, don't sleep on the Dow or the total return index right now if you're looking at that. But so if you do look at the S&P 500, though, it is about 3% away from that closing record on January 3rd of 2022. So looking to see if some of these major indexes could potentially eclipse those records pretty soon. But obviously all eyes on the man himself, Fed Chair Jerome
John
Powell
Tucker might be able to
this afternoon.
retire. I mean, given where the market is in his
Getting
vast
closer
401k.
and closer to a magical mark in that 401k plan.
I hear that
right.
somebody is celebrating their 30th anniversary at Bloomberg this Friday.
Well, actually,
bearing
I
the
think
lead
it's-
there, John
I think
Tucker.
it's the whole week is
Is the whole
celebration
week? Well, I think we should. Are you going to be here Friday?
Yeah, I think Paul's out, so probably.
Oh wow!
Probably filling
Throwing
in for-
Paul under the bus there.
Exactly.
30 years.
Paul,
Only seems like 50.
You took the day off when John
I
Tucker
know, I didn't
was
know. Had I
celebrating.
had known,
I feel like we should do something special for you. You know what? We're going to surprise you with something. You wait.
All right.
You wait.
Bailey's looking at me like, no. We'll see what happens.
All right, Jess, anything else happening?
Well, some other stocks keeping an eye on. I know we've talked a lot about Tesla this morning. TSLA stock down close to 2% right now. So that does come after the EV maker filed a recall covering more than 2 million vehicles after the top U.S. auto safety regulator determined its driver assistance system, Autopilot, doesn't do enough to prevent misuse. And then another stock I'm looking at, Pfizer, PFE is the ticker symbol on this, down about 9%. So the drug maker did give an adjusted earnings forecast for 2024 that was below the average analyst estimate, and the company also forecasted sales for next year that did miss expectations, guys.
All right, Jess Menton, thank you so much for that. Jess Menton, she covers all the markets for us here at Bloomberg News, and again, close to those highs, and it's amazing that the market has performed as well as it has in the face of rising interest rates. But I guess, as they taught us in business school, the market discounts future cash flows, and if you think that interest rates are going to be peaking and declining, then those cash flows are worth more. Let's buy them.
Yeah, if you actually believe into what options are implying, you have 100 basis points of cuts next year, which is still
See, this is the WERP function, and I've kind of lost faith in the WERP function.
I know. I'm more fascinated by it, I think, than actually trusting what's going to happen.
Yeah, maybe just directionally, maybe it's worth it. So,
What about dot plots this afternoon?
So we go dots go.
Dots go.
Okay, so I go dots go on this thing, and it's got a lot of dots there, and it's got like lines and stuff like that. What it shows me, being the simpleton that I am, is that even Fed officials think rates are going to be going down over the next couple of years.
If you look at analysts, actually economists rather, at Barclays right now, they're estimating that there will be no more rate increases next year in forecast 2/4 percentage point rate cuts. So that would bring the median dot plot to about 4.9% by the end of 2024. But we know those get revised very often. They come out quarterly, so the next one after this would come in March, even though we do have another meeting at the end of January. But that's something that investors are focusing on, even though we know those do get adjusted. Still investors keeping a close eye. And in the median dot plot previous to this was 5.1% for the end of this year. So
for the end of 23.
2024.
Okay, so
yes.
the expectations are coming down for even more. All right. So I don't know what this Fed chairman can say today other than kind of what he's been saying, which is we're data driven, we're mindful of where things are going. We think we're on the right path, but we're just going to hang.
Well, I want to go back to the comments he had on December 1st, where he said policy is well into restrictive territory, and the entire market read into the the word well drove markets to rip and gave everyone kind of this dovish hawk standpoint of Jay Powell, and that really sparked expectations that we're going to have these rate cuts. Using WERP to look back to where we were in October, obviously as markets were moving down and to the right, we only priced in 2 rate cuts for 2024. So things can change on the head of a pin, really, across expectations around the Fed, what we're seeing with rates, what economic data is actually showing. Jess loves to talk technicals. Like, there's so much that everyone puts into the market, but it almost feels like at the end of the day right now, we kind of have maybe a FOMO-driven rally. Personally.
Right. And I know Paul likes to bring up RSI too. We talk to Abigail Doolittle about that often. Traders I speak with, even though if you look at the RSI is around 70 on the S&P 500, they don't like to look just at daily charts. They look at weekly, also monthly. So I was speaking with some who, if you look at the instances going back when RSI had actually jumped less than a month from below 30 to above 70, there's only been about 11 other instances going back to the 50s since that's happened. But usually in the shorter term basis, that has led to more gains. So I think there's a lot of people talking about a potentially overheated market, though there are some contrarian indicators there that might suggest otherwise.
All right, Jess, thanks so much for joining us. Jess Mann, Bloomberg Equities reporter. I'm going to go to big big pharma here. Pfizer, the stock off pretty substantially today, falls to its lowest in 10 years on a disappointing forecast. And I'm looking at the stock right here. I'm going to bring in Sam Fazeli. He is the head of European research, and he's a pharma analyst at Bloomberg Intelligence. He's based in London. He has a PhD. Not really good with the Zoom thing, but he's pretty smart, I've been told here. So, Sam, what's going on with Pfizer? These are the great people that brought us the COVID vaccine. The stock's down 50% year to date. It's given up so much of kind of what it gained during the COVID period. What's the story on Pfizer with the guidance they gave and kind of maybe the longer-term view?
Yeah, hi, Paul. By the way, I'm fully zoomed up here, so I don't know what that Zoom thing was. But no, look, I mean, it's I
literally,
I don't know if you guys
the only one left in the office. Let me just, for the people on
can you see this?
YouTube.
All right, I'm making a phone call to somebody. This is ridiculous. It's a Wednesday.
No. They're all having tea.
No,
it's England and it's tea time. Come on.
Right.
No, look, the thing with Pfizer is that there's been this uncertainty since the massive boom in COVID vaccine sales, et cetera, as to what is the long-term shape of this business. And, frankly, we've just had cut after cut after cut. And we're now being told that maybe next year, instead of the 8 billion that consensus was looking for COVID vaccines, it's going to be 5.
Wow.
Maybe instead of the 5 billion of Paxlovid sales, is going to be 3. So, that's a big cut. But in reality, if you take out COVID and you take out the acquisition they've just completed today or yesterday, at least going forward, if you take those numbers out for 2024, you're still a couple of billion or $1 billion or so short of consensus. So it's not just about vaccines. It's not just about Paxlovid. Business is tough for this company, which is why they're doing the deal they're doing.
Sam, you mentioned the deal they're doing acquiring Seagen, a cancer drug manufacturer. What could Pfizer have done, or should Pfizer have done differently with the benefit of hindsight? It's down 57% from a December 2021 peak and lost almost $200 billion in market value.
Yeah, I honestly don't think it's something that, clearly they could have had a more exciting pipeline. If things had gone better for them in the obesity drug that they reported a week or two ago. There are quite a lot of headwinds for this company, which is, again, why they're doing the deal. The reality is, it's just the stock is resetting to what the facts are in the world of COVID. And it was very difficult to second guess those. Nobody knew how bad the vaccine fatigue would be when it comes to dealing with the second and third year or fourth year of boosters. Nobody knows what it's going to be next year. I actually think, and I think they've said it themselves today, that they're being as conservative as possible on the COVID vaccine front for next year. They're assuming the same as this year, but lower sales in terms of volumes, but lower sales. So let's see how this pans out. Is it going to be a better year for them? Is this the low point from which guidance is going to start going up? Is what I think everybody's going to have to be figuring out.
Yeah, and when you look at the ANR function on the Bloomberg terminal for Pfizer, which is analyst recommendations, it's right as Sam was suggesting, 14 buys, 14 holds. The street has no idea what's going on with this name. Sam, let's broaden that out a little bit. You mentioned the weight loss drugs, and that is, boy, if AI was the early part of 2023's driver of the market, it seems like these weight loss drugs have been the driver for the second half of the year. Big story here. And I know you guys at Bloomberg Intelligence have done a ton of work on this, have a big seminal research report out on this market here. Can you frame out kind of where we are today with these weight loss drugs, and how much of a driver is it for the pharma industry going forward?
Yeah, so for the industry as a whole, let's start with your last question. I think a lot of people are getting into the game. You know that Roche has just got announced a deal. You've got AstraZeneca's got into this. Pfizer's doing its best to stay in the game. One company that did rule themselves out is Johnson & Johnson. They said it's too crowded, too busy, we're not interested. And they have a pretty powerful oncology business. And then where are we going with these drugs? The reality is that the more we see from them in terms of the control of other obesity-related side issues, cardiovascular disease, kidney disease, and in time, cancer and other types of diseases that are the results of this upsetting balance in the body, which is essentially what happens in these patients. They are what we call constantly under a state of inflammation, which is bad. I mean, inflammatory response. The whole body is under that stress when you have extra poundage around. So that's what I think these drugs are going to be shown to continue to be powerful, but we're going to get more data. We're going to get more competition coming. Prices are going to have to go up, and I'm assuming volume will go up on the back of it.
And Sam, is there an indication or an area that's most similar or reminiscent to you of weight loss drugs in terms of the potential market? I'm just looking at some of the stock moves we've seen with Novo and Lilly and a lot of the small caps, and it does remind me of the gold rush that was COVID vaccines.
Yeah, except the COVID vaccines, we were vaccinating an entire population to try and manage that pressure. And I think most countries did a pretty good job of that. But then you come back to the diseases endemic, and most of the countries are now suggesting it for only 65 plus, certainly in the UK where I am. And the reality is a lot of people got bored with it. I don't think people are going to get bored with obesity drugs. Some people are not going to tolerate them. Some people are not going to be able to take them for 52 weeks or whatever, 88 weeks, which was the latest data set that came out. But that doesn't matter. As long as they can keep their weight down, take a holiday from the drug, come back to it. I think this is a much more sticky market than COVID vaccines was.
Yeah, very quickly though, is it reminiscent of kind of Hep C in terms of the fact that these drugs do require you to be on them forever, essentially?
Yeah, but again, if you remember, Hep C was a blip. We had a large rise, and then everybody got under control, and Hep C was curative. Yeah. We don't have a curative setting here. I think the best thing I'm going to equal it to, potentially, is if we get a highly effective Alzheimer's drug. Remember, the obesity game has been in play for 10, 20 years. Now we've got effective drugs. I think we might see that with Alzheimer's in the next 10, 15 years.
I mean, the headquarters for Bloomberg in London is spectacular. Queen Victoria Street. It is the absolute coolest building you'll ever see.
I wouldn't know.
And these knuckleheads are not in the office. I'm going to make a phone call as soon as we're done here. Sam Fazeli, head of European research. He covers all the pharma stuff for Bloomberg Intelligence, one of the top pharma analysts in the city of London for Bloomberg Intelligence. Getting an update on Pfizer. Again, the stock down pretty big today, down 50% year to date. Ever conservative guidance coming out of Pfizer, and that's a problem for that stock. This is Bloomberg. All right, let's get some company news right now. Steve Rappaport.
Paul, Tesla issues its largest recall yet, affecting more than 2 million vehicles after U.S. regulators concluded the EV's autopilot feature doesn't do enough to prevent misuse. Bloomberg News Global Autos editor Craig Trudell has more.
This, in the end, is still not over. The defect investigation that started more than 2 years ago will continue with NHTSA monitoring for whether or not this series of remedies that Tesla is going to do via an over-the-air software update, whether it's going to go far enough to ensure that people pay attention and remain engaged in the task of driving.
Bloomberg's Craig Trudell reporting. Kroger is ordering thousands of employees back to the office for the majority of the work week starting early next year. We get the details from Bloomberg's Charlie Pellet.
Beginning February 5th, they have to be present 3 to 4 days a week. That is an increase from the previous guidance of 2 days a week from June of 2021. The mandate will affect about 5,800 employees in and around Cincinnati, as well as in Charlotte, North Carolina, Portland, Oregon, San Jose, California, Boca Raton, Florida, and Chicago.
Charlie, while Kroger wants people back in the office. Citigroup is offering a way to get some out of the office. The Wall Street giant is offering to pay some staffers a portion of their bonuses early if they agree to voluntarily depart as executives continue with their restructuring of the bank. Sources tell us employees who accept the offer would also be allowed to keep all of their deferred stock awards. Right now, shares of Citigroup are up. And those are the company stories we're following this hour. I'm Steve Rappaport. This is Bloomberg.
Headlines and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Investors seeing some mild moves in the markets today. There is the betting the Fed's going to keep rates on hold and try to put a lid on expectations for rate cuts of over 100 basis points in the next 12 months. This is shaping up to be the most important Fed meeting of the year. Right now, the S&P 500, 10 points higher. That's up 0.2%. We're at 4653 on the index. The Dow Jones Industrial Average up 35 points. NASDAQ 100 right now up 45 points. That's a rise of 0.3%. Well, Pfizer, worst individual stock in the S&P 500. That's down about 8.6%. Then on the other side, you have Vertex Pharmaceuticals. That's the best performer. They announced positive results from a study of a non-opioid pain drug. It's over 9% higher. Meantime, Bloomberg Intelligence writing that earnings growth should rebound across all global markets in 2024. Analysts do expect a roaring earnings recovery in technology, especially next year, while the cyclical sectors, the financials and energy, may broadly lag global corporate earnings growth trends. And we have the two-year yield right now ahead of the Fed decision, down 6 points. That is at 466. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash. Bailey and Paul.
All right, John Tucker, thank you so much. We appreciate that. Bailey Lipschultz, Paul Sweeney here in our Bloomberg Interactive Broker studio. We're streaming live on YouTube as well. Some news out on Tesla today. They're recalling 2 million cars to fix autopilot safety flaws. That sounds kind of important. Let's check in with somebody who knows this stuff cold. Steve Mann, global auto market research leader, Bloomberg Intelligence. He's based in Princeton, New Jersey, and that in and of itself is news because for 10 years he ran our Asia business for Bloomberg Intelligence. Somehow he got back into this country despite all my efforts to keep him out. He's a good man. He's a great analyst. We appreciate getting some time. And Steve, don't be afraid. You can get on that New Jersey Transit and get up to New York City, the capital of the financial world, anytime you want.
Will do.
Thanks for joining us, Steve. What do we make here of Tesla here? Is this a problem? I mean, this sounds like a kind of a standard auto issue.
It is. It is a standard auto issue. If you just look at the surface, It's 2 million cars. This is a lot of vehicles. It's everything they've built so far. It's in terms of cost, it's a minor change. It's an over-the-air fix. But what's really, I think, will get into the investor's mind is how is this going to impact this company going forward? Because they do have an aggressive target to roll out AI, roll out autonomous vehicle at level 5, fully automated by next year. So now this recall, it's about a simple fix at the level 2, a much more basic level in driving automation. So it puts into question, like, look, you know, is Elon, is Tesla going to get to level 5, a much more sophisticated level next year?
And Steve, when you look at it, you mentioned that it's an over-the-air software fix. This is a 2-year probe. So when you talk about expectations for fully autonomous vehicles, kind of where could that target move if this is just a signal that, again, Tesla is going to have to punt just a little bit?
Well, you know, I think the fix is kind of small. And like you said earlier, I think it's a little bit too early to say if this will significantly delay that. But it does put into the investor's mind, like, you know, some doubts, right? If you look at the valuation for Tesla, it's a big chunk of it, it's about AI. It's about autonomous vehicle. And because of this recall, is likely to, you know, put some doubts into the investor's mind in terms of, are they going to achieve it? Now, if they don't achieve it next year, I have no doubts they will achieve it. I mean, that's where the world is moving to, right? AI. They're going to achieve it. Now, you know, there are some questions in terms of how they're going to get there. Are they going to get there next year? Or do they need to add other, you know, other equipment, for example, to get them there? Do they have to add more software redundancy to get them there because of this recall? So delays, potentially delays, but I still think they will get there eventually.
Hey, Steve, you know, one of the issues out there as it relates to electric vehicles has been trying to get a sense of what the ultimate demand is for EVs. I just bought a new vehicle, had zero interest in paying any kind of premium to get an EV, so I went with the old internal combustion engine. What's your take on kind of global demand for EVs? Even Ford announced that they're cutting production of their F-150E truck.
I think there's huge differences depending on what region you're talking about. You know, we've talked about China. That's definitely going higher. It's, you know, they're selling 1 million EVs, battery EVs, 1 million battery EVs, you know, a month. That's how much U.S. sells in a year. So they're accelerating. Now, if you're talking about U.S. and Europe, there's some delay, and the main reason why is the battery supply chain is not built out for the U.S. and European market. So what that means is the end cost to the consumer will be much higher because they have to import those batteries into those regions. Now, we have the Inflation Reduction Act. You know, that's actually coming online, and with that act, it's actually what they're doing is limiting the amount of materials and components, battery materials, battery components from China. That will also raise prices for consumer here. So there is some risk in terms of demand in the next 3 years. But because of the long term, this Inflation Reduction Act is actually the whole intent is to build out the supply chain, the battery supply chain in the U.S. And hopefully as those battery manufacturing capacity ramps up, the costs will come down for battery production, and that's going to get passed on to consumer, and hopefully that will create some demand, lift the demand up for battery EVs.
And Steve, you mentioned the demand overseas. Just looking at the financials from Tesla, about half of their revenue generated from the U.S. and just over 22% based on 2022 sales in China. How do those competitive dynamics, though, shape up, given NIO and other companies operating in China and, as Paul mentioned, U.S. competition?
Yeah, it is. I think EVs in China, you know, China has always been a very hyper-competitive market for the auto industry. It hasn't been for battery EVs, but it's becoming that. It's, there's NIO, there's XPeng, there's Leapmotor. You can, in the last few years, there's been a lot of public companies. There's been the public companies that came that listed, and there's a whole host of private companies that are producing battery EVs. So it's becoming a tougher market, but Elon Musk and Tesla still have a niche. They still have, I would say, a majority of the market in China for battery EVs. But if you include PHEVs, that's a different story. BYD is the market share leader. But if you just look at the battery EV, Tesla still leads because of the brand cachet it carries.
So, one of the issues here in the States, I think there is, and this is just my opinion, not based on any research, but just talking to people, I don't think the demand here for EVs is as strong as maybe the companies think it is, or maybe some analysts think it is. What do you think?
That's true. We're actually, sales is probably definitely will slow down. We're probably thinking around the 10% range, right? From, high, mid kind of double digits. So it's definitely going to slow down. And I think a major reason for that is the affordability. Like I said earlier, batteries are still being imported. There's going to be bans in materials, because China actually owns the battery supply chain. And if you're banning that technology from China, then where else are you going to get the batteries from, really? But so that means it'll take time. It'll take time for the U.S. to build up the supply chain. And once they have the supply chain, I think the cost will come down. Hopefully by then, the EV charging infrastructure will be, expanded further to what it is, what we have today. And with the lower pricing, with EV infrastructure built out, charging infrastructure built out, hopefully it'll create some demand for battery EV. But that's, like I said earlier, that's probably 2-3 years from now. I think we're going to take a break. We're going to slow down a little bit until the supply chain catches up.
Is the Cybertruck actually going to drive sales for Tesla?
I don't think so. I don't think it's a high volume product for Cybertruck, for Tesla. It's, the styling is not for everyone, obviously. Everybody's used to the traditional truck. They have to prove themselves. You have strong incumbents, GM, Ford, and Chrysler, that they have to overcome the mindset of the average consumer that buys pickup truck to go with the Cybertruck. So I don't think so, but Tesla is planning to roll out a compact vehicle. Some have dubbed it as a Model 2, I think that could be the next thing that we should be focusing on, because that's going to help them not only expand into other segments within the auto market, but also help them expand into other regions as well. Because pickup trucks is really big in the U.S., but not so in other parts of the world.
Right. Steve Mann, absolute best. Steve Mann, global auto market research leader, Bloomberg Intelligence. He is back in the USA, as they say, based in our Princeton office. We'll be talking a lot more to Steve Mann about the global auto industry, unique insights into Asia, given his time over there. So good to have him back. Right now, let's head down to Washington, D.C., world and national news with Amy Marrs.
All right, thank you, Paul. President Biden's son, Hunter, is raising the political stakes with Republicans. He held a news conference on Capitol Hill, challenging them to let him testify in public as Republican members get set to vote this afternoon on formalizing the impeachment inquiry against his father. We get more on this now from Bloomberg White House reporter Jordan Fabian.
He was requested to testify behind closed doors, and he really boldly went out there and said, I'm not going to do that. I would testify in public. I won't testify in private. I feel like the Republicans who are in charge of this committee have distorted everything about this case.
Bloomberg's Jordan Fabian in Washington. Hunter Biden says he's made mistakes, but his father had nothing to do with his business dealings. The Supreme Court has agreed to take up a dispute over a medication used in the most common method of abortion in the United States. It's the court's first abortion case since it overturned Roe v. Wade last year. Justices say they'll hear appeals from the Biden administration and the New York-based maker of the drug mifepristone. The case will be argued in the spring, with a decision likely by late June. right in the middle of the 2024 presidential and congressional campaigns. Hugs and applause at COP28 climate talks in Dubai as nations agreed on a landmark deal to transition away from fossil fuels. U.S. climate envoy John Kerry.
The decision, supported by all nations of the world, calls for transitioning away from fossil fuels in energy systems so as to achieve net zero by 2050.
And the agreement came about a day later than they expected. It sends a strong message, he says, to the rest of the world. Climate campaigners singled out the need for the U.S. to lead the charge in shifting away from fossil fuels. Global news 24 hours a day and whenever you want it. With Bloomberg News Now, I'm Amy Morris, and this is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. I think it's safe to say traders are pretty much on hold to get more clarity from the Federal Reserve this afternoon. Ahead of that, we had a breakdown in PPI data that offered evidence of a broad-based cooling in prices. That kind of reinforces the case for a soft landing with the U.S. economy. Nadia Lovell at UBS is expecting the Fed today to dampen expectations for any rate cuts.
We'll get the updated summary of economic projections, and that's likely to push back on the market's very aggressive pricing of over 100 basis points of cuts for next year. It's likely to show probably half that, and that would be, when you think about it, very consistent with what the Fed has been talking about.
Right now, the S&P 500 only 6 points higher. That's up 0.2%. 4650 on the index. The worst performing stock right now, the index that belongs to Pfizer after their results, that is down just about 8%. The Dow Jones Industrial Average 13 points higher at 36,592. The NASDAQ 100 34 points higher. That's up 0.2%. And then you have European regulators putting the finishing touches on a decision that would prohibit Apple's practice of blocking music services from pushing their users away from the App Store to alternative subscription options. This also could come with a heavy fine, expecting that in the new year. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Bailey and Paul.
John Tucker, thank you so much. We appreciate that. Bailey, Liv Schultz, Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio. We're also streaming live on YouTube, so you can head over to youtube.com and search Bloomberg Radio. It is Fed Day. Bloomberg will have complete coverage starting at 1:30 p.m. Wall Street time. The surveillance team, Tom Keene, Lisa Bromwich, John Farrow, they will break it all down for you. The statement comes out at 2 p.m. Wall Street time, press conference 2:30. We'll have it all for you. What will Mr. Powell say today? Let's check in with Joanne Bianco, a partner at Bond Blocks Investment Management. Think ETFs for the fixed income folks out there. That's what the good folks at Bond Blocks do. Joanna, thanks so much for joining us here. I guess let's just start off with the Fed. What do you expect to hear from the Fed today?
Well, yes, it's going to be interesting to hear the Fed's comments from today's meetings and see any changes that they indicate to their multi-year forecast. Regarding Fed policy at Bond Blocks, we think it is likely that they're near the end of their rate hiking cycle. You know, in our opinion, 2 meetings with no rate hikes are a pause. This third one could mean that they are at the end of the rate hiking cycle. You know, the thing is what we're also thinking, though, is that they're probably not necessarily going to be in any rush to cut rates next year, especially when you see with November's in-line expectations, but not lower CPI release would, in our opinion, not cause the Fed to rush to cut rates anytime soon. And maybe this is the message that Chairman Powell will stress in his news conference today, pushing back on the idea that rate cuts are around the corner. Because, you know, really, what would be his incentive to sound too dovish today?
Joanne, how hawkish can he sound, though? Just because it feels like every time he speaks, the market initially moves, but then once he's done, everyone's more than happy to look past the higher for longer drum banging that he's been doing for the last months.
That's true. You know, the market consensus has been more optimistic than the Fed for about a year and a half now. They haven't really been right in being more optimistic, but eventually they will be. But in our opinion, we really don't see any reason to fight the Fed in terms of the language that they're coming out with. If inflation does remain persistent, the Fed could hold rates at these levels longer and has less reason to start cutting next year, although it is our expectation that they could start to cut.
Joanne, when I look across the fixed income space in 2023, I see some green, so that's good compared to what happened in 2022 when people just got slaughtered all across the fixed income space. I'm surprised, though, that the best performance by far in 2023 in fixed income was high yield. and everybody's been telling me about a recession, so I'm surprised that high yield would do so well. How do you guys think about that space?
Well, yes, high yield was our top pick in 2023, and we went against the grain with that pick. It's also our top pick again for 2024. It's basically just this asset class has been held up by the remarkable resilience that we've seen in the U.S. economy, and that's definitely filtered down to the high yield market. And in the high yield, within high yield, performance is led by triple C's, the riskiest area, and then single B's were the next best performer in credit rating categories, while consumer cyclical, energy, and financials were the best performers in industry sectors. In our view, high yield continues to offer an interesting entry point right now, just by virtue of the fact that if you look at forward returns for this asset class, whenever the Fed has paused on its hiking cycle, it's generated low double-digit returns in the coming year. And plus, the coupon income it offers is the highest that you could get in U.S. public markets, either equity or fixed income. With less volatility than stocks, we estimate around half the volatility of stocks over the past 10 years. And as I said, still supportive fundamentals. This is a key difference at this point in the cycle.
Okay, so Joanne, just to make sure I heard you correctly, you continue to like the high yield space regardless of concerns about a recession in 2024 and potentially piling up bankruptcies?
Well, I think that, our base case is that there isn't a recession next year, and that the U.S. economy will remain healthy, despite the higher interest rate environment. We think it could experience a modest slowdown, but nothing in terms of, heading into a recession. So we think, you are paid for the risk that you take in high yield. We especially like double Bs right now for their higher income generation potential and their position as the highest credit quality sector in high yield. And we also like single B exposure. It's got a pickup over double Bs and over the broad high yield index. It's always in high yield. It's about picking your spots. It's not, all the same in terms of risk. So there are areas of the market that we think are still attractive.
Where are the funds flows? Where are the funds flowing in your ETF complex, Joanne? Where are you seeing investor interest?
Well, we have definitely seen investor interest into our high yield funds, even our triple C fund, which is, the highest risk fund, but it's been the best performer, among the best performers in all fixed income ETFs in 2023. So I think our investors have been happy with that. We've also seen a lot of flows into our short U.S. Treasury ETFs, X-half and X1 in particular. But we've also seen people kind of going out the curve in X2, X3, X7 in terms of, looking at, the potential total return tailwind in going out slightly longer, especially if the Fed does end up cutting rates next year.
And if we do see the Fed rate cuts start to pile up, how does that change your strategy or your thought?
I think that our strategies are reflective of that. We're not anticipating more than 2 rate cuts at this point next year. I mean, we see, and that could change later today depending upon what the Fed says. But right now, their forecast for 2 25 basis point rate cuts is kind of what we see. We're not in the same camp as the market, that is about twice that. So, the focus on high yield, higher quality high yield, and short to intermediate term treasuries are, we think reflective of the rate environment that we could see next year.
Joanne, thanks so much for joining us. Joanne Bianco, partner at Bond Blocks Investment Management. Great business model over there. ETF business focused exclusively on fixed income and across fixed income classes, durations, different rating classes. So they've really parsed that business and established, I think, a really interesting business there. So we love getting her perspective. This is Bloomberg. get some company news right now with Steve Rappaport.
Paul, shares of Pfizer tumbled to a 10-year low on a disappointing outlook for sales and profit. Bloomberg's Lisa Mateo with more on that.
Steve, Pfizer's forecast fell short even after the company purchased a cancer drug maker that's producing some of the hottest treatments in the oncology market. Pfizer says sales for 2024 will reach $58.5 billion to $61.5 billion. Wall Street analysts ballparked a figure of nearly $63 billion. Pfizer cut revenue guidance twice this year as demand for its COVID-19 vaccine and pills dries up. Steve.
Bloomberg's Lisa Mateo reporting. Tesla issues a recall for more than 2 million vehicles because U.S. regulators are concerned about drivers misusing the autopilot feature. Bloomberg's Ed Ludlow reports.
It's a recall in name only, insofar as, yes, 2 million US vehicles are impacted. It impacts all generations of all Tesla models, but the fix is an over-the-air software update, and there is a argument to say, well, how fantastic is it that Tesla, after a multi-year investigation by NHTSA, can simply fix the issue by the press of a button by the consumer or the customer and patch it with software pretty quickly.
Bloomberg's Ed Ludlow reporting shares of Tesla down more than 2.75%. The Securities and Exchange Commission will vote today on new requirements for hedge funds and brokerages. Under the new rules, all transactions involving repurchase agreements must use clearinghouses. But in a partial victory for the hedge funds, the agency says they'll be exempt from having to centrally clear their cash treasuries trades. Those are the company stories we're following this hour. I'm Steve Rappaport, and this is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, getting a quick look at these markets here. The S&P's up about 0.1%. The Dow's unchanged. NASDAQ also up about 0.1%. So pretty quiet on the index front. Looking at the yields come in just slightly. 10-year Treasuries in about 5 basis points, 4.15% here. WTI crude oil up about 1.4%, almost $1. Still about $69.50, so below that 70 level. Bitcoin making a little bit of a move here, up about 1.9%, 41,800 on Bitcoin. Right now, let's head down to Washington, D.C. We'll get world and national news with Amy Morris.
All right, thank you, Paul. Hunter Biden has defied a congressional subpoena to appear privately for a deposition before Republican investigators digging into his business dealings. Now, he insisted outside the U.S. Capitol that he'll only testify in public, and that risks a contempt of Congress charge. Congresswoman Alexandria Ocasio-Cortez calls out House Republicans for refusing to allow Hunter Biden to testify publicly.
They have devised a story that they cannot substantiate with facts, and so they've decided that they want to invent their own take without evidence, and they want to ensure that that evidence remains behind closed doors and away from public view.
Congresswoman Alexandria Ocasio-Cortez says initial offers from House Republicans did give Hunter Biden a choice of testifying either in public or in private. The Supreme Court says it will hear appeals that could upend hundreds of charges stemming from the Capitol riot, including against former President Donald Trump. Now, the justices have agreed to review an appellate ruling that revives a charge against 3 defendants from Texas, Massachusetts, and New York, accused of obstruction of an official proceeding. The charge refers to the disruption of Congress's certification of the Biden presidential election victory over Trump. Now, the obstruction charge has been brought against more than 300 defendants after the deadly January 6, 2021 insurrection. Apple is about to be hit by a ban on its App Store rules governing music streaming rivals and a potential hefty fine in the European Union, the EU's latest attempt to limit the power of big tech. Sources tell Bloomberg EU regulators are putting the finishing touches on a decision that would prohibit Apple's practice of blocking music services from pushing their users away from the App Store to alternative subscription options. Watch for that decision early next year. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Amy Morris, and this is Bloomberg. Paul and Bailey.
All right, Amy Morris, thank you so much. We appreciate it. All right, Bailey, Coinbase Global is rolling out spot crypto trading on its international exchange as part of a global expansion, saying some users are wary of U.S. venues due to the country's uncertain regulatory backdrop. So institutional investors can initially trade Bitcoin and Ether against the USDC stablecoin from Thursday on the international platform, which currently focuses on derivatives, the company said in a statement. Now, this is at the same time that the U.S. Securities and Exchange Commission is suing Coinbase for allegedly running an illegal exchange, broker, and clearing agency. The nation's biggest digital asset platform disputes the claims, which are part of a broader SEC crackdown following a string of crypto collapses headlined by the FTX wipeout.
Yeah, to be fair, the SEC is suing Kraken and Binance and pretty much everyone in and around the crypto space.
Yep.
But this does come in as an interesting update for Coinbase, which is a company that year to date up some 300% or 296% year to date,
Okay.
Riding the wave alongside Bitcoin, which is more than doubled up 153%. And this is all coming as obviously we have more of a risk on year. Bitcoin coming back in vogue, maybe. I talked to a couple people yesterday at lunch and they were not optimistic on crypto, but definitely saying the shakeout that we've seen gives them a bit more interest in putting cash to work potentially. Obviously, this is all ahead of the spot ETF, which is likely, according to BI's Eric Balchunas, to come in mid-January.
That's been the big driver.
That's the driver. That's the thing that everyone is excited about. What that actually means and kind of pressing some crypto bulls on it. Maybe we do see it buy the rumor, sell the news, but there's so much excitement around that, and that's really been something our Bloomberg intelligence analysts have been all over, keeping an eye on those filings.
Coinbase Global, you mentioned that. Boy, it's up 295% year to date. It's got a $33.5 billion market cap. And despite all of the turmoil and all the negative headlines about the crypto space in terms of the exchange, FTX in particular, and Binance, the industry's still there. People are still bullish on it. We'll keep an eye. This is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
Why were the economists so wrong? What are the economists getting wrong?
Isn't this a slam dunk time to buy U.S. Treasuries?
Soft landing, hard landing, no landing. I don't know.
True. What the heck does that mean?
I don't know.
Breaking market news and insight from Bloomberg experts.
We're going to be in an environment with higher rates for longer.
The 5-day in-office work week is effectively dead.
It's definitely a good sign that we're not ready to land this economy just yet.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, coming up in this hour, we're going to check in with Stuart Paul. He's a U.S. economist with Bloomberg Economics. He's going to join us in here in studio, get a little preview of the final FOMC meeting, what we might hear later today. And then Mike Green, portfolio manager and chief strategist at Simplify Asset Management, will join us to discuss markets and investing. Kelly Kowalski, portfolio manager at Mass Mutual, will take a look at the markets heading into 2024. So we got a lot of smart folks coming up. And we're going to kick this hour off, as we do, with Mr. Charlie Pell.
Hi, thank you very much, Paul Sweeney. Wall Street right now trading a little change. The Dow, the S&P, NASDAQ doing a whole lot of nothing right now ahead of the Fed decision coming up just under 2 hours from now. S&P right now, little changed, up 5. That is a gain of 0.1%. NASDAQ 100 index up 29, up by about 0.2%. Could see an Apple record today. Right now, the Dow is higher by 9, little changed, up less than 0.1%. 10-year yield 4.15%, with the 2-year now at 4.66% on the 2-year. Wall Street gearing up for what is expected to be the most important Fed decision of the year, with traders awaiting any signals on whether the market's aggressive dovish bid is now overdone. Danielle DiMartino Booth is CEO and chief strategist at QI Research, right here on Bloomberg Markets. She did talk about what she is hoping to see in just about 90 minutes from Fed Chair Jay Powell.
I think we need to see the Powell who we saw a few years ago at Jackson Hole. Succinct, to the point. Financial conditions have eased to such a great extent, even since the Fed went into blackout. So I really do think that he needs to be resolute and emphasize that they're still data dependent and communicate that the market's gotten way ahead of itself.
And you can hear more of the conversation on the Tape podcast. You can download it wherever you get your podcasts. Fed decision, 2 p.m. Wall Street time. Jay Powell's news conference live here on Bloomberg Radio at 2:30 Wall Street time. Again, the 10-year right now, 4.15%. Spot gold up 0.1%, 19.82 the ounce. And West Texas Intermediate crude up 1.3%, 69.51 a barrel. Briefly, Southwest Airlines has kept its year-end outlooks largely intact despite stronger than expected holiday travel. Airline stocks, they are flying lower today across the board. We do have shares of Southwest Airlines trading lower now by 5.9%. Among some of the other airline names today, UAL down 1.8%, American down 2.2%, Delta down 2.1%, JetBlue lower by 4.1%. Again, recapping, little change for the U.S. stock market. S&P now up 4, a gain there of 0.1%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie Pell, thank you so much. We appreciate that. Bailey Lipschultz, Paul Sweeney, we're live here in our Bloomberg Interactive Broker studio. We're streaming live as well on YouTube, so you can head over to youtube.com and search Bloomberg Radio. As Charlie was just mentioning, looking at the index level, not a whole lot happening. I'm going to call it unched across the board for your equity markets, but we know there's stuff going on under the hood, so let's welcome Carmen Reinke. She covers the equity markets for Bloomberg News. She joins us here in our studio. Carmen, what are you looking at?
Yeah, so one that I'm looking at right now is Vertex Pharmaceuticals, ticker VRTX. It's the top mover on the S&P 500 right now. Shares are up 11%. The firm announced positive results from a mid-stage study of a non-opioid drug that should treat diabetic peripheral neuropathy. So the results said that, it was well tolerated and that there was a significant reduction in a change from the baseline. So shares of Vertex really surging today. It is at an all-time high.
Yeah, all-time high. Stock's up 37% year to date. So if you bet right on that one.
Yeah.
And that's what it is for those biotechs.
Well, and this is a company that has essentially a monopoly in cystic fibrosis and built out that pipeline over years and quietly is worth more than $100 billion.
Yeah,
so this is one of those companies that has a robust pipeline, as the sell side likes to talk about. Carmen, what else is going on? I know I saw some headlines crossing about Etsy.
Yes, so this is a really interesting one. Etsy, ticker ETSY, shares are down, let me see, about 5.5% right now. The company said that it plans to cut about 11% of its marketplace workforce, and that includes its chief marketing officer, Ryan Scott. Whoa. It also updated its fourth quarter outlook. This is a company that did really well during the COVID pandemic when consumers sort of rushed to its like niche offerings, and has done not so well since, as people are sort of switching to spending on experiences over things. So shares are down 34% this year, and in a note that was sent to both the SEC and employees, the CEO called its trajectory unsustainable. So Etsy looking to trim itself down, become a leaner machine as it goes forward, and tries to kind of, boost to sales back to maybe at least a portion of what it was doing during the pandemic.
Looking at the ANR function for analyst recommendations for Etsy, 15 buys, 15 holds, and 3 sells.
I know,
again, the street has no idea what to do with it.
Shares down 34% this year.
Yep.
So I guess it's a bargain.
Might as well be a sell, really.
Exactly.
If we're going to be honest.
Yeah,
This does come a day after, too. Hasbro cut 1,100 jobs, so
yes,
interesting to see how some of those consumer, more discretionary type businesses are adapting.
My sales manager, Payne Weber, Sweeney, are we buying them or are we selling them? I got to write some tickets today. No hold ratings here. So that worked. Anything else?
Yeah, the one other thing that I was looking at today is CalMaine, CALM. Shares are up about 8.7%. This is an interesting one just because it's all about egg prices. So
what prices?
Egg prices.
Really?
Yeah, so basically this
They're
is surging.
Down.
Yeah.
Right, Ken? I'm looking into Ken. Yep, they're coming down.
So this is surging even though there's a report of bird flu outbreaks. Basically, I guess the firming of egg prices is positive for the stock overall. So there you have it, CalMaine up, even though there have been avian flu outbreaks at its facilities in Kansas.
See, Ken Fellow, he's our global technical director, but he's also on the site. He's like the master baker. So they buy in bulk. So that's how, like when the pandemic hit and
consumers are spending, I'm just thinking I buy by the dozen. And
well, I think he buys by like the carton or the
whatever's bigger.
Whatever those things are, pallets. Yeah. All right, Carmen, thank you so much. We appreciate it. CalMaine Foods. I never thought I'd see that. Carmen Reinke, she covers all the equities. CalMaine Foods offers poultry products based in Ridgeland, Mississippi. It's got a market cap of $2.6 billion. The chairman is Dolph Baker. Like, nice. So you got to do it somewhere.
Yeah.
Yep. Awesome. Good stuff for the folks at CalMaine.
They pay a dividend.
They pay a dividend, thankfully.
Very small.
Yep. All right, very good. So they're down there in Ridgeland, Mississippi. All right, we got the Fed day today. We're going to have full coverage. Tom Keene, the surveillance team, 1:30 on Bloomberg Television, simulcast here on radio. We'll bring it all to you. Let's get a little bit of a preview. Stuart Paul, U.S. economist for Bloomberg Economics. I think you need to spend a little bit more time in the gym, don't you think? Yeah, so get on it, will you please? Stuart, what are you looking for today from our Federal Reserve at 2 o'clock?
It's all about the summary of economic projections and the dot plot.
Okay.
Where everybody is really expecting the Fed to remain on hold with the Fed funds rate staying in the 5.25% to 5.5% range. Well signaled, and the Fed is setting up for a pivot in 2024. So when everybody then turns their attention to the dot plot, the question is just how many cuts are going to be shown for 2024. As of the latest SEP released in September. SEP for the Summary of Economic Projections.
Sure, everybody's got that in the back pocket.
That dot plot, right, the formal name for the dot plot, there was an additional rate hike shown this year. That'll get stripped out. And then there were 50 basis points of cuts that were being shown for 2024. That could still remain at 50 basis points given that the unemployment rate fell in the latest jobs report. And so the Fed may be relatively optimistic about the outlook for growth and the outlook for employment. And so very gentle, smooth cuts may be what they're planning. But there is definitely upside risk in terms of additional cuts coming in 2024. We're, as you know, a bit more pessimistic than most. We've been more pessimistic than most for what feels like a very long time. But because of that, because of our more pessimistic outlook for growth and the labor market, we're anticipating there being actually far more cuts in 2024, about 125 basis points. Wow. So if the Fed shows just 50, and if the market is pricing 110 bips, and we're at 125 basis points of cuts, that looks relatively hawkish. So we'd call that a hawkish hold in this afternoon's FOMC release and Powell's press conference.
So a hawkish hold is different than what we heard from Powell at Spellman when he was a dovish hawk?
We've seen everything under the sun. It's like, lions, tigers, and bears. It's crazy out there. We've seen hawkish holds. We've seen dovish hikes. We would expect this to be a relatively hawkish hold, with the Fed trying to prevent further loosening of financial conditions as it remains on hold and as it shows cuts in 2024. Because if it allows financial conditions to ease further, it actually would require the Fed to then step up later and perhaps, even hike again, right?
All right, so Bloomberg Economics, what's your economic view for 2024?
We're expecting a mild recession. We actually think that a recessionary environment has already begun ensuing. Some of the key labor market indicators that we look at, including sort of the less watched U2 unemployment rate. We always look at headline unemployment, or U3 unemployment rate. But if we look at those that are more cyclically sensitive, like U2, which mostly focuses on job losers, we are approaching some of the trigger points that are typically associated with recessions. In particular, it was that October jobs report that looked so bad. Of course, the November jobs report sort of made the outlook, was more characteristic of an environment that is, more so associated with a tighter labor market.
Yep.
But in a year that we've seen dramatic revisions to payrolls, I wouldn't count on the November report carrying us through and being indicative of true conditions on the ground.
What should we be looking to or listening for when Powell speaks? Should we be listening for words being added or removed from what he's been saying in the past, or completely different a stance?
So we'll see just how much tinkering there actually is in the formal FOMC statement. The thing that I want to hear from Powell is just how much the FOMC is talking about cuts, right? So now we're here talking about when they're going to be talking about cuts. But I would bet almost anything that Chairman Powell says that they are taking meetings one at a time, that every meeting is live, they're not yet talking about cuts, but it would actually be relatively dovish during a meeting when we're expecting a hawkish hold if he were to say that the FOMC is talking about the conditions under which it would be appropriate to talk about cuts.
Does Powell want the market to fall today? Is that something that he needs to deliver on just because equities and Treasuries have kind of been laughing in his face?
Given the move that we've seen in Treasuries since October, I think that Powell would be happy to see longer-term rates start rising a bit. Again, to take a little bit of steam out of financial conditions. You can't allow too much loosening of financial conditions because then you just don't have that tightening of credit that the Fed actually needs if they are going to sustainably and permanently rein in inflation. So there's never a circumstance under which the Fed wants to see the floor fall out of equities, but I don't think that he would be upset to see Treasury rates rising.
What's the labor market outlook? It seems we had that labor report come in Friday, a lot stronger than expected here. And it's kind of defied, I think, a lot of economists' views about maybe where this labor market might be going, might be softening, but it still seems really, really strong. How do you guys think about it?
Yeah, so there are two elements here. The first is that primarily, just admittedly, the labor market is tight, right? We have to start there. And then the question is, in what direction is the labor market moving? And it is loosening. Undoubtedly, it is loosening. We've seen dissipation of excess demand of labor. We see that in jolts every month. We've seen the pace of wage growth slowing notably. That probably matters more than the pace of hiring. We've seen a stabilization in the average number of hours worked per week, and we are seeing on trend a slower pace of hiring. If we think about 2024, we expect the labor force to continue growing at a pace of about 1% per year, which is very normal. And if you even just look at consensus views for the pace of hiring, you would expect to see an unemployment rate of about 4.6, 4.7% at year end, 2024. Right now, the Fed has, I think, 4.1% marked in its previous summer of economic projections. If it ends up looking at the November jobs report and thinking, oh, wow, that still seems reasonable, it's completely ignoring the likelihood of a growing labor force amid a slowdown in the pace of hiring. So it doesn't seem to be entirely in sync with what it's actually looking to achieve.
With some of the jobs data that we get coming in, what stands out most to you? It feels like we've been talking, and Powell's been talking a lot about wage growth. We've been looking at the underlying jobs numbers. What matters for the Fed?
What matters for the Fed is wage growth primarily. Of course, right? Wage growth and the pace of hiring feed directly into an inflation impulse, just how much money out there is being earned by people that can then be spent on goods and services. So wage growth matters most, pace of hiring probably matters second most. Powell is expecting that in the long run, a pace of about 100,000 jobs per month is on par with population growth. We're expecting far fewer jobs than that to be, we're expecting far slower pace of hiring in 2024, in fact, with job losses in the second half of the year.
Really? Wow.
Yeah. And one thing that we can't ignore is that even in the surprisingly strong November jobs report, hiring was very much so concentrated in acyclical or even countercyclical industries like government and healthcare. So, and of course, there was a little bit of rehiring following the resolution of the UAW strike. So it's really difficult to look at that report and then say, oh, the labor market is so strong, isn't this wonderful? If we're looking at the diffusion of hiring, it ain't great. It's not great out there. And if we're looking at the pace of wage growth, it's slowing notably. So all things that the Fed, I'm sure, is keeping in mind and perhaps might warrant an uptick in the median FOMC members' forecast for the unemployment rate in 2024.
All right, inflation. The Paul Sweeney Inflation Index is the daily national average gasoline prices for regular unleaded, $3.12, down from, $3.90 just back in September. So big drop in gasoline. What's your best guess best guess inflation outlook? What are you guys thinking?
So we're thinking that core inflation stabilizes at least through the first half of 2024 in the pace in the range of about 3% per year. Okay. There are pretty unfavorable base effects. Again, energy matters. Energy matters a lot for the headline, as you say. There's a reason why it's the Paul Sweeney Index, right? It is the biggest price posted on billboards on both sides of the road that consumers see every single day, and it influences their behavior.
How's the snow at Wyndham Resort right now?
We had 6 inches of fresh snow last night. I'm going to skip town tonight and head up there.
Nice. All right, so will you be working as an all-mountain ski patroller, or is this leisure?
I've been doing it as a volunteer patroller for, I guess this is my 17th year now. Ooh. And it's my one true passion. Other than vector autoregressions and forecasting large economic data sets.
Exactly. Sure. Who doesn't have that as a backup?
Yes.
All right, Stuart Paul, thanks so much for joining us. Enjoy the weekend on the slopes. Stuart Paul is a U.S. economist for Bloomberg Economics. Again, we got the Fed coming up at 2 p.m. With a statement, 2:30 with a press conference. Bloomberg's coverage starts with the surveillance team at 1:30 p.m. All that is Wall Street time. S&P 500 up 0.1%. NASDAQ up about 0.2%. So we'll stay on top of that. Yields coming in just slightly ahead of the Fed. We'll have more coming up. This is Bloomberg. Let's get some company news right now with Steve Rappaport.
Paul, shares of Tesla are down more than 2.5%. This after the EV maker recalled more than 2 million vehicles to address U.S. regulator concerns about Tesla's autopilot feature. More on that from Bloomberg News Global Auto Editor Craig Trudell.
This dates back actually to August 2021 when the National Highway Traffic Safety Administration opened an investigation into autopilot after several crashes into first responder vehicles. So there would be an existing crash scene that the Tesla would come up on and run into, say, a police car or a fire truck. Since then, actually, NHTSA has opened a separate defect investigation into autopilot. There's been all sorts of scrutiny into these systems going back years.
Bloomberg's Craig Trudell reporting. Citigroup is offering to pay some staffers a portion of their bonuses early if they agree to voluntarily depart as executives continue to restructure. Bloomberg's Sally Bakewell reports.
It's the biggest restructuring of the bank in decades. It was unveiled in September. The goal is to boost profits, to boost returns, and the company has already made about 300 senior management cuts, with more expected. That could run into the thousands, but maybe not. It's incurred a big charge for this it will incur a big charge of about $1 billion, with a couple of $100 million of that being recorded in the fourth quarter.
Thanks, Sally. Citi shares are little changed, and Apple is set to get hit with an EU antitrust order banning its App Store rules that govern music streaming rivals like Spotify. Those are the company stories we're following this hour. I'm Steve Rappaport, and this is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 12:21 on Wall Street. We do check markets all day long here at Bloomberg, with the Dow now lower, S&P little changed, NASDAQ is advancing, also little change, stocks, bonds, and the dollar seeing mild moves amid bets that the Fed will be holding rates and try to put a lid on expectations for rate cuts of over 100 basis points in the next 12 months. 10-year yield is at 4.15%, with the 2-year now at 4.66%. Spot gold up $3 the ounce to $19.82, up by about 0.1%. West Texas Intermediate crude up 1.1%, $69.40 for a barrel of WTI. S&P up 3, a gain there of 0.1%. Dow Industrials down 3, now lower by just less than 0.1%, while NASDAQ is up 7, a gain there of about 0.1%. Bitcoin up 2.4%, 42,075 on Bitcoin. Pfizer shares have tumbled to their lowest level in a decade after its disappearing forecast for next year showed the purchase of a leading cancer drug maker is not enough to fill the ever-growing hole from its flailing COVID franchise. We do have Pfizer shares now down by 7.7%. Again, recapping, stocks are trading mixed. The Dow lower, little changed. S&P higher, little changed, up now by 3 points. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie Bell, thank you so much. We appreciate it. Bailey Lipschultz, Paul Sweeney, we're live here in a Bloomberg Interactive Broker studio doing the YouTube thing as well, so you can head over to youtube.com and search for Bloomberg Radio. Let's get a sense of kind of where this market's going. We got the Fed today. I don't know. I'm not that big of. I'm not going to be watching.
Feels like nothing's going to happen.
I'll read about it afterwards. Mike Green joins us. He's a portfolio manager, chief strategist at Simplify Asset Management, joins us live here in our Bloomberg Interactive Broker studio. Mike, I'm not going to be paying attention. I'll probably be sitting on a train somewhere, but you will be paying attention to, as will other professional investors out there. What do you want to hear? What do you think we're going to hear? What should we hear, do you think?
Well, I think the market has pretty much priced this in at this point, right? There's a 0% probability, slightly less than 1% probability that there's going to be any actual movement. Fed's not going to, upset the apple cart in that process. At the same time, I think everybody is expecting effectively a stern lecture on financial conditions and that we, really should be more responsible in our thought process. And I think that's going to be the underlying story, right? We saw with inflation today that the Fed is actually rapidly moving towards this objective of 2%. Some people would actually argue, myself included, that we're probably going to overshoot to the downside. And that becomes the key question. But I think the one thing, if I were to make a quick observation, it's that everybody keeps pricing the markets off of 25 basis point moves. And that's a pretty good model when you're talking about hikes, because the Fed tends to hike in a somewhat conservative fashion. It was a surprise when they did 75s and 50s, contributed to the volatility in 2022. As we look at cuts, though, those actually have about a 50-50 chance, about equal probability of 50 basis point cuts. And so a lot of the statements around we're going to cut early, we're going to cut in the first quarter, I think are contingent on the idea that the only cut that can occur is a 25. I think it's more likely, actually, that we probably see a 50 later in the year, and that would suggest that the probabilities that the market has are not quite as crazy as people think, right? If we were to wait and be more patient and not cut in the first quarter, or certainly not January, but instead we're to wait and cut in July, August, September, et cetera, and do so in 50 basis point increments, that would be consistent with pricing, also feels probably more accurate.
So what happens in the first half of the year, though, from a market's perspective, if the Fed, as you said, kind of punts until there's called a jumbo cut in the summer?
Well, that becomes the real question, right? Because where we are today is at a very bifurcated market. If I'm Apple or if I'm a wealthy, U.S. individual, I'm celebrating the fact that interest rates are higher because I've got a significant amount of cash on my balance sheet or in my bank accounts. I'm suddenly earning a really attractive return on that. And with the retreat in inflation, that makes me feel much wealthier. If I'm a senior citizen, I've benefited from a 8.38% increase in Social Security this year that now looks like one of the greatest giveaways in history, right? So when we think about it from that perspective, actually, if the Fed starts to cut, it becomes actually a problem for those entities. On the flip side of the equation, we're seeing from things like the NFIB small business surveys that credit availability is not loose for small businesses, that small businesses are really struggling, and the lower income Americans who need access to credit to pay their daily bills, they're also really struggling using credit cards with 30% interest rates, et cetera. So this is a very bifurcated market, and it really becomes an interesting question of, do we get to the point where something breaks and the Fed is forced to do this? or as many particularly that are active in the Fed, Fed researchers, et cetera, are kind of hoping for it as the Fed behave in a proactive fashion. I think the odds of that are low.
Hey, Mike, you've been doing this a long time, equities, credit, FX, commodities, all that kind of stuff. If we're in a higher for longer kind of range here, I mean, I guess we'll start cutting at some point this year. Where do you see some of the best opportunities right here, just across asset classes?
Well, I think that there's a couple of interesting things that have happened that suggest, as we particularly come into the presidential election year, that the opportunities are relatively limited for Biden to goose the economy once more. Yep. And so some of the areas that have fallen deeply out of favor would include areas in green investment, things tied to the Inflation Reduction Act. I would actually point to some of those as having fallen significantly enough that now as a contrarian play, they become somewhat interesting, some of the lithium plays, et cetera. On the flip side of that, and just to be very clear, the Inflation Reduction Act, terribly named because it can be used to stimulate the economy, but we have to actually acknowledge that will be one of the goals going into 2024. The other thing that I would highlight is that we've now seen a really interesting event where Xi has made the pilgrimage to Mecca, right? Yep. And that, I think, is as we're seeing in the weakness of the Chinese economy, that was something I called for earlier in the year. That's certainly borne out. A lot of people had expected this giant China rebound on a China reopening. We're now seeing that their economy is very structurally weak.
Is that something that continues into 2024, do you think?
Well, that becomes the interesting question, because unfortunately this is a situation in which both Xi and Biden need to stimulate their economy. They need to figure out ways to make sure that we don't go into deeper economic drawdowns that could be proved problematic for each of them. For Biden, it would mean a failure to be reelected, or for the Democratic Party, it would mean a failure to be reelected if Biden doesn't stand. For Xi, it has far more dire consequences. He goes out with his boots on.
And so does that present an opportunity, you're saying, within Chinese equities?
I think it's interesting if you look at some of the Chinese equities. For example, if you look at the large cap Chinese ETFs, or you look at the...
Like the FXI is what you're looking at?
FXI would be an interesting example of that, as would Asher, for example. Those are interesting contrarian opportunities where the pricing is, I would argue, underappreciating the potential for a stimulus-type rebound.
Gotcha. Just to call that out, the FXI has returned a loss of 15% this year in the face of the SPX being about 21%. So
right, without recovering in 2022, right? Yeah. So it's not like it's a reversal from last year. It's been down fairly significantly.
How about just kind of the U.S. versus international versus emerging markets? Where do you see kind of the best, I guess, risk reward here?
Well, China certainly falls into the potential for an emerging market rebound. Yep. And we are kind of at this situation where if I look at things like oil prices, et cetera, they've retreated significantly. Many people were very bullish on it going into this year. Obviously, that's failed to materialize. That suggests that the growing consumption out of places like the emerging markets has been weaker than anticipated. We've seen supply cuts rather than dramatic additions, U.S. production being the notable exception there. If I look at the emerging markets, they clearly have growth potential. India is obviously benefiting from picking up from China there, and I would highlight that is the notable outlier in the emerging market space. But if I look elsewhere around the world, a China slowdown is really problematic for the emerging markets, and so you can get a momentary bounce. But if we're really looking at kind of the much broader picture of how this develops, we're now in this uncomfortable time period where it's about how do we change supply chains as compared to how do we dramatically expand them as we did under the China regime. And so I think emerging markets continue to be challenged. They continue to be in a situation where, particularly with very strong U.S. dollar against emerging markets and high interest rates, it's becoming harder and harder for people to justify investment in many of those regions.
If we can stay internationally, what's your view on the UK and Europe? It just feels like, again, you pointed to Bloomberg TV talking about the IPO market. For all intents and purposes, Europe is nil in that front.
Well, I think something really interesting is happening in Europe in that they're suddenly actually facing the same thing that they did with Japan in 1989, right? So if you look at the 1980s, Europe enjoyed quite a bit of schadenfreude at the idea of the United States becoming, second fiddle to Japan. You saw that exact same type of schadenfreude as it related to China. And what changed it, of course, was Japan began going after the European auto market. Same thing's happening right now. China going after the European auto market, I would argue, has been one of the key catalysts in changing the tenor and tone of behavior towards China. I think that's one of the reasons why China is slowly backing away from some of its aggressiveness on trade. On the flip side of it, Europe itself is just so structurally challenged that it becomes a really interesting question of how far does it have to go before change actually starts to emerge. And we just have not seen an incredible amount of emphasis on growth in Europe. They've effectively tried to limit the amount of damage to the euro, limit the amount of damage to their economy from terrible choices they made around energy in particular over the last decade. And to change that is going to require a radical reimagination of Europe, where they try to go for growth as compared to preserving something that really can't be preserved anymore.
Have you ever gotten involved with crypto, or what is your involvement or exposure to crypto?
Because
that's not my generation, but I mean,
yeah. Well, I think you and I are roughly the same generation, but. Look, I think that there's some really interesting stuff around crypto. It has some of the same positive bubble dynamics associated with, the build out of the internet in the late 1990s.
Yep.
And I think that there's actually an incredible need to move to what I would call digital securities, right? Digitally native securities. The idea of a smart token that has far more information contained in it than a QSIP does, for example, opens up the ideas of creating all sorts of interesting structured products, investment vehicles that people could desperately use, et cetera. But crypto itself is basically a technology now in search of that need. And I think it's a fascinating insight in terms of crypto itself that the only thing we have is speculation after 10 plus years.
All right, Mike, thanks so much for joining us. Appreciate getting you in our studio. Mike Green is portfolio manager, chief strategist at Simplify Asset Management. Right now, let's head down to Washington, D.C. We'll get world and national news with Nancy Lyons.
Thanks, Paul. Hunter Biden says he is ready to speak publicly to House lawmakers about his business dealings, but he will not go behind closed doors as requested by House Republicans. They've said Hunter Biden's demands amount to a request for special treatment. Hunter Biden did make clear while in front of the Capitol today that his father had nothing to do with his businesses.
My father was not financially involved in my business, not as a practicing lawyer, not as a board member of Burisma, not in my partnership with a Chinese private businessman, not in my investments at home nor abroad, and certainly not as an artist.
Biden admitted to making financial mistakes, but says it was the love of his parents that saved him from his addictions. House Oversight Committee Chair James Comer of Kentucky is managing the investigation into the Bidens.
This is an investigation about public corruption at the highest levels. We have accumulated mountains of evidence that's concerning to an overwhelming majority of Americans.
Comer's committee has found no direct evidence, however, to suggest that President Biden was engaged in any misconduct. The House does plan to vote today on a formal authorization for an impeachment inquiry into the president. A major deal has been announced at the conclusion of the COP28 climate summit. It calls for a transition away from fossil fuels, which COP28 President Sultan Al Jaber calls a paradigm shift.
My colleagues and friends, you did step up. You showed flexibility, and you put common interest ahead of self-interest. We have the basis to make transformational change happen.
It's the first time in 30 years of climate talks there's been an international call to move away from fossil fuels. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Nancy Lyons. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 12:40 on Wall Street. We do check markets all day long here at Bloomberg. I'm Charlie Pelleton. We are just over an hour away from the Fed decision and then the news conference from Fed Chair Jay Powell. Little change for the U.S. equity market. Stocks, bonds, and the dollar are seeing mild moves amid bets that the Fed will be holding rates and try to put a lid on expectations for rate cuts of over 100 basis points over the next 12 months. 10-year yield at 4.14% with a 2-year right now, 4.66%. Spot gold up $3 the ounce to $19.82, up 0.2%. And West Texas Intermediate crude oil up 1%, $69.33 for a barrel of WTI. Bitcoin up 2.2% now. Bitcoin is at 42,208, actually 42,008 on Bitcoin. S&P up 3 points, little change there. The Dow higher by 3 points, also little change. NASDAQ up by just about half a point, little changed as well. Carl Weinberg is chief economist at High Frequency Economics, and he was a guest this morning on Bloomberg Surveillance.
Inflation is coming down. The economy is continuing to chug along, and I think he's going to feel that the Fed is in a sweet spot. He may not admit that to the public, but we're not going to get anything scary from them today.
And indeed, 2:30 p.m. Wall Street time is when we do hear from Fed Chair Jay Powell. And you can hear more of the conversation on the Surveillance podcast. You can download it wherever you get your podcasts. Tesla has filed a recall covering more than 2 million vehicles after the top U.S. auto safety regulator determined its driver assistance system, Autopilot, does not do enough to prevent misuse. Shares of Tesla, they are trading lower today. Right now, Tesla is down by about 2.7%. Again, recapping, stocks now trading mixed, little change. That's the key takeaway. NASDAQ down a point, S&P up 2, a gain there of 0.1%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Charlie Pelleton, thank you very much for that Bloomberg Business Flash. Bailey Lipschultz, Paul Sweeney, we're live here with you in the Bloomberg Interactive Broker Studio. We're also streaming live on YouTube, so head over to youtube.com. Search Bloomberg Radio. It is Fed Day today, so we'll get the market. We'll get a lot more information about kind of how this Fed's thinking about the economy, about inflation. And we're kind of seeing that in the trading right now, as Charlie was just reporting, no real change in any of the equity indexes right now. Kelly Kowalski joined us. She's a portfolio manager at Mass Mutual. I see she got her MBA at Carnegie Mellon. That means she's like a math person.
Way smarter than I am.
I was told there wouldn't be math here in this thing. Kelly, thanks so much for joining us here. Mass Mutual, you guys are all over the markets here with your investments. How do you guys handicap what we might hear from Fed Chairman Jay Powell today?
Hi, Paul. Thanks for having me today. It's great to be here. I think we're definitely going to hear first from the Fed a real acknowledgement that they've made significant progress on inflation, and certainly they're feeling good about that. But also we've got this aggressive expectations for rate cuts next year. So we would expect some pushback against that and saying that the Fed's really not thinking about cutting rates in the very near term because inflation is not yet at mission accomplished. But I think, the way Treasury markets are trading right now, they're probably not expecting a super aggressive pushback.
And Kelly, I would say 85% of the people we've talked to are in the camp that the market has gotten ahead of itself. What actually can happen in today's press conference to maybe talk down the market?
Yeah, that's a great question. I don't anticipate that Chair Powell is going to try to do that, but I would expect him to probably reintroduce the possibility of hiking rates at some point next year. That may startle the markets, but again, don't expect that to come from him.
Are you guys at Mass Mutual, what's your kind of economic outlook for 24? Do you see a recession? And if so, maybe how deep, how long, that kind of thing?
Yeah, so the market is certainly pricing in a Goldilocks soft landing case. We're certainly hoping for that. And hey, that's what we're in right now. We really are in the midst of a soft landing. And this year has certainly turned out way different than many people anticipated, but we're not completely writing recession off the table. We do see certain indicators that you typically see leading into a recession, like temporary employment falling, and the breadth of job gains has been more narrow as of late. So we're keeping an eye on those things. I would say we're not as high on the Goldilocks idea as some people, and certainly we focus on downside risk, and that's how we've been able to pay a dividend for over 150 years.
There you go.
And Kelly, I'm looking at some of your talking points. One thing that I don't think I've seen anyone talk about is the possibility of future rate increases. How would that happen in 2024?
I think there's a pretty high bar for that, but there's also this market belief that we're just going to follow this nice glide path back to 2% inflation, and maybe that's, again, biased by what we've had the past 10 years. But I think if we see inflation remain really sticky, or we see, an acceleration in growth, certainly we're expecting a slowdown that's, again, not too hot, not too cold. But if we see a reacceleration in growth and inflation just continuing to remain sticky, I would think the Fed would probably move. But again, I would assign a low probability to that.
How are you guys, I guess, positioned for 2024? I mean, we've seen rates on the 10-year go from 5% to 4.15% today. Just a huge move in such a quick period of time. How do you position yourselves for 24?
Yeah, we're very highly credit focused. As an insurance company, our portfolio is primarily fixed income. And what we look at really as a measure of value or risk in credit markets is credit spreads. And we've rallied 25 basis points, I think, since the last Fed meeting. If you look at investment grade spreads, that's really at the levels where we were right before Russia-Ukraine. So if we say to ourselves, hey, is there more or less risk now in the world, in the markets, in sort of fundamentals versus then, I would say there's at least as much, if not more. So we're positioned, again, hopeful that we achieve this soft landing. And certainly I think the odds have increased. But we are not discounting the fact that we could see either, a quarter or two of bumpy growth or some type of growth scare. And we're really positioned to take advantage of that, making sure we have plenty of dry powder.
And you mentioned the market getting ahead of itself right now, pricing in just north of 100 basis points of cuts. What's the house view for you on timing of cuts and what that would look like in terms of 25 basis points versus 50 basis point increments?
So we think the Fed is probably going to pencil in 50 basis points of cuts next year in the dot plot. A reasonable assumption probably would be that that's going to be sometime in the second quarter if you're sort of in that soft landing camp. I think really to see that magnitude or to see it happen in the very near term, we either have to get sort of this immaculate disinflation, or we see, a substantial drop off in growth, which would cause the Fed to move.
I was looking across the fixed income space in terms of the total returns this year, and I was really surprised to see that by far the best performing place in the fixed income space was high yield with a total return north of 10%. And with all the talk of recession, I wouldn't have thought that. How do you guys think about that?
Yeah, the way we're looking at that is, fundamentals have deteriorated this year. So if you think about the high yield space, but they've held up better than expected. We've seen default rates tick up, but credit stress has remained fairly contained. And if you look at, high yield, even corporate credit as an asset class, we've seen incredible flows into both high yield and investment grade. Just looking at a high yield sort of yield to worst right now is 8%. That's commensurate with sort of a long-term equity return. So a lot of investors are seeing that, and we're seeing, strong demand really for credit product because of the attractiveness of all-in yields.
All right, Kelly, thank you so much for joining us. Really appreciate getting a few minutes of your time. Kelly Kowalski, she's a portfolio manager at Mass Mutual. They're based up there in Boston. I think their offices are kind of near the south part of Boston, if I'm not mistaken. So I guess we're just kind of waiting here, and we'll have the surveillance team, Tom, John, Lisa, Brahmans, 1:30 p.m. Wall Street time. They'll start breaking it down for us, and then we'll get the statement at 2 p.m. and then the press conference at 2:30. And hopefully Mr. Michael McKee, I'm sure he's front and center as always, and get a good question in there.
Yeah, asking the best questions is what Mike does, and really pushing to see where things are going to shape out. Again, so much of a focus is not only on kind of the decision, obviously the decision, but dots and what the man, Jay Powell himself, says, and any kind of foreshadowing of what 2024 can look like.
Just looking quickly at the yield curve right here, we got the 10-year Treasury off about 4 basis points, 4.15%. The 2 years at 4.66%. We're going to have more coming up. This is Bloomberg. Let's get some company news right now with Steve Rappaport.
Paul, Tesla issues its largest recall yet, affecting more than 2 million vehicles after U.S. regulators concluded the EV's autopilot feature doesn't do enough to prevent misuse. Bloomberg News Global Autos editor Craig Trudell has more.
This, in the end, is still not over. The defect investigation that started more than 2 years ago will continue with NHTSA monitoring for whether or not this series of remedies that Tesla is going to do via an over-the-air software update, whether it's going to go far enough to ensure that people pay attention and remain engaged in the task of driving.
Thanks, Craig. Those hot weight loss drugs like Ozempic and Wegovy have some food companies worried about the treatments taking a bite out of business. Not Nestle, though. Just ask CEO Mark Schneider.
It's not so much a threat for us, it's more like a full-blown vindication of the strategy that we've been pursuing very patiently over the years. Take our high-growth categories that are not impacted by GLP-1, pet care, coffee, and our Nestle Health Science business. That used to be 30% of our business in 2016. It is now about 50% of our business. So clearly this is where portfolio rotation prepared us for this lower-calorie, higher-value future that we've been pursuing. So it's not impacting us.
That was Nestle CEO Mark Schneider on Bloomberg TV. And it's a day Pfizer shareholders likely wish to forget, the stock dropping to a 10-year low after the drug maker issued sales and profit outlooks for next year that fell short of Wall Street estimates. And those are the company stories we're following this hour. I'm Steve Rappaport. This is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
Not much happening here in terms of the equity markets ahead of the Fed decision. Most of the indexes are less than 1% movement here on the upside. Yields come in modestly. The 10-year Treasury is down 5 basis points, 4.15% on your 10-year. Bitcoin, it is up higher, 2.5%, 42,100. So back above 42,000. WTI crude oil, it is pretty much up about 1% here, $69.24 for WTI crude oil. Right now, let's head down to Washington, D.C. We'll get world and national news with Nancy Lyons.
Thanks, Paul. Hunter Biden is defending himself and calling out House Republicans who are refusing to allow him to testify publicly on his business dealings. He was subpoenaed to testify behind closed doors today. He chose to address that outside the Capitol.
For 6 years, I have been the target of the unrelenting Trump attack machine shouting, "Where's Hunter?" Well, here's my answer. I am here.
Hunter Biden says his father was not financially involved in his business dealings, and there is no evidence to support the allegations made by House Republicans. The Supreme Court is adding a new complication to the prosecution of former President Trump on charges of he tried to overturn the 2020 presidential election. The justices today said they will hear an appeal from a January 6th defendant who's facing a related charge of obstructing an official proceeding. If the court rules for the defendant, it could impact the Trump indictment. The Senate has a bipartisan compromise bill before it to authorize the next year of defense spending, but there has been still no compromise on the bill to aid Ukraine, Israel, and Taiwan. We get more from Bloomberg's Irv Chapman.
The bill depends on adding provisions to discourage migrants. Majority Leader Chuck Schumer.
Negotiations continue today between Democrats, Republicans, and the Biden administration. Democrats are still trying to meet our Republican colleagues in the middle and reach an agreement.
Republican Leader Mitch McConnell.
I'm hopeful that Democrats, both here and at the White House, are beginning to recognize how committed we are to addressing the crisis at our southern border.
President Biden reversed Trump border policies when he took office. Republicans want him now to reverse himself. In Washington, Irv Chapman, Bloomberg Radio.
Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Nancy Lyons. Now back to you, Paul and Bailey.
Nancy, thank you so much. We appreciate it. All right, Bailey, I'm not going to be here Friday, which means I am going to miss the municipal bond segment with Joe Mysak. So I wanted to flag one of his stories today. This week, an exclusive Connecticut prep school is selling a small bond issue with a big story. It's about the growing demand for admission to elite institutions from parents striving to give what many view as the gateway to the good life for their children. The Loomis Chaffee School was chartered in 1874 and has alumni including KKR co-founder Henry Kravis and George Shultz, Secretary of State during the Reagan administration. It's seeking to raise $13.9 million in revenue bonds via the Connecticut Health and Educational Facilities Authority. Applications for the private high school hit 2,454 for the 2023-2024 school year, an all-time high, while the acceptance rate fell to 17%, a record low. That's according to the bond offering documents. About 15 years ago, that acceptance rate was 45%.
Yeah, fierce competition for the limited number of seats. I guess that's typical for the handful of boarding and day schools that have tapped the municipal market, according to our very own Joe Mysak. Paul, I don't know about you, but the school charges $68,000 for boarding and $52,000 for day students and had about 735 students for the 2023-24 school. Using the financing, the plan is to pay for a new dorm and make campus improvements. All the while, they're taking, by my rough math, close to $120,000 a year.
Yeah, exactly. I went to a peer school of Loomis, boarding school, and the tuition numbers are basically very similar to what they're doing here. It's interesting. So these schools really depend upon their endowments to fund some big capital equipment or fundraising. And most, or not many, choose to go to the municipal bond market, but the municipal bond market is certainly open for these institutions when you see some of those numbers like that. So interesting story. Joe Mysak, municipal bonds, higher education. We got Sound On with Joe Mysak, with, who's that, Joe Matthew. That's coming up right now.
from our nation's capital, this is Bloomberg Sound On.
Two major stories that we're following here developing before our eyes.
What does it say about Trump's influence on the Republican Party?
What can the Biden administration do on its own to support Israel?
Bloomberg Sound On. Politics, policy, and perspective from D.C.'s top names.
The Republican caucus is at war with itself.
Members of Congress would have a press conference every day if somebody would cover that.
There is bipartisan support for Israel.
This is one of the big ones we only see once every decade or 2 decades in the Middle East.
Bloomberg Sound On with Joe Matthew on Bloomberg Radio.
Still no deal on the border, but the Biden impeachment inquiry appears to be moving forward. Welcome to the fastest show in politics. Faster than usual today as we wind up to our special Fed coverage. The start of congressional recess is approaching with a long to-do list, and we're going to talk about it with Congressman Brian Stile, the Republican from Wisconsin, back with us today. Of course, serves on the Financial Services Committee, and we'll have his view as we head into the holidays here. Where's Hunter? Turns out on Capitol Hill today. Hunter Biden will explain why and what's going on with this Oversight Committee hearing. Discuss it all with our signature panel. Bloomberg Politics contributors Rick Davis and Jeannie Shanzano are with us for the hour, or what we have of it. As I mentioned, 1:30, roughly a half an hour from now, we're going to kick things back to New York for our special Fed coverage. Right now, we go to Capitol Hill to talk with the congressman from Wisconsin, Brian Stile, back with us, and it's good to see you, sir. We've been talking for months and months about getting around chaos and dysfunction in the House, and I wonder where your head is now as we head for the holidays without a lot to show for it when it comes to a deal on the border or supplemental budget requests for Israel and Ukraine. Congressman, can this all happen when you come back in January? How's it going to go?
I think I share the frustration with the American people for where we're at right now. Divided government is difficult, and we're showing that to the American people, unfortunately. The pressing issues of the border, of dealing with our broader spending bills, national defense policy, all still remain on the table. I'd love to see us stay here and try to get it done before Christmas. It looks more and more likely, unfortunately, that we're going to be working on these in the new year.
Okay. How about we pick through these one by one here, and I'll start with the border, Congressman. It seemed even a couple of days ago, and I know that negotiations are happening primarily in the Senate, but it seemed like we were getting warmer, maybe closer to a deal, as Democrats acknowledge, even the White House, that they're open to changes to asylum law. Republicans, I realize, in the House are sticking close to H.R. 2, but do you see any wiggle room that might bring both parties to the middle here to make a compromise?
Well, hopefully we can see the Biden administration dramatically change course. The fact that Democratic mayors in cities like New York are calling on the Biden administration to change course, I think adds credence to the argument that the policies of the Biden administration have been disastrous at the U.S.-Mexico border. As you noted, the House of Representatives under Republican control passed H.R. 2, a robust border security package that not only increases funding to secure the border, but also addresses, in particular, the abuse of the asylum laws of the United States, where many illegal immigrants are falsely claiming asylum and then waiting the 3 to 4 years before those cases could be heard. I'd love to see the Senate come to a deal where we can actually secure the U.S.-Mexico border. I, too, was optimistic not that long ago, but my optimism continues to fade by the fact that the Biden administration is not engaging directly in these negotiations.
Are you encouraged by what you're hearing from Democratic lawmakers, though, whether it's Chris Murphy or even, like I said, reporting from Bloomberg that the White House is open to items that weren't even being discussed, Congressman, a couple of months ago, whether it's the parole system, enhancing the deportation process, or, as you mentioned, tightening asylum law? This was not a conversation that we were having until really just weeks ago. Does that not feel like progress?
Well, it's progress, but only because the political pressure is building on the administration. I mean, again, the fact that the governor of New York State, the mayor of New York City, Democrats across the country who are operating at the state and local level are dealing with the challenges of an unsecured border and are getting to wit's end where they're actually calling on the president to change course. Is that building a political pressure which is forcing the administration to begin to come to the table? But there's a long ways to go. Again, the House passed a robust border security bill that I think really should be taken up in the Senate. Let them amend it. Let them have the vote on the floor of the Senate and see where they stand if they want to. But I think on the whole, the American people will look at the Republican-passed H.R. 2 border security bill and will say that's good legislation that we need to secure the U.S.-Mexico border.
I don't want to do this whole talk on the border, Congressman, but we've heard even from Congressman or Senator James Lankford, who's the Republican leader of negotiations in the Senate, remind that H.R. 2 did not get a single Democratic vote. And I know that you see it differently here, but if that's the starting point, won't that likely delay a final product here when we could be talking compromise on some areas that I've already mentioned where it appears Democrats and Republicans see eye to eye?
Well, I think what we have here, though, Joe, is the political winds have shifted pretty dramatically. The problem that conservatives have pointed out in Biden's border policies are now coming to fruition. And we continue to see the challenges being faced at the state and local level across the country. And the fact that Democrat elected officials across the country are calling on the Biden administration to change course, I think actually gives credence to the fact that the Republican policy put forward has a lot of validity to it. Again, if the Senate wants to make amendments to this, put this on the floor of the Senate and allow the amendments to go forward, and we'll see where people are at regarding each and every provision. I think what we'd see is that the Senate would actually move this forward, and I think that's the fear of Chuck Schumer and the Biden administration.
Interesting, something did come to the floor in the Senate just last week, and that was the actual supplemental request. There was a procedural vote on this $100+ billion for Ukraine, Israel, Taiwan, and the money that had first been put forth by the White House for border security. That, of course, failed. And the president talked about that in his news conference last evening with the president of Ukraine. Here's Joe Biden, and I'd love to have you respond.
Russian loyalists in Moscow celebrated when Republicans voted to block Ukraine aid last week. The host of a Kremlin-run show literally said, and I quote, "Well done, Republicans."
How do you respond to something like that, Congressman, knowing that funding for Ukraine, as well as Israel and the others, are on ice until the border can be solved?
Well, I think ultimately, right, it's a little bit of a pump fake there by the president trying to ignore the fact that Republicans have been pretty consistent. Let's secure the U.S.-Mexico border, and let's make sure that we're providing defense funding for our allies around the globe who are facing incredibly serious threats. And so we can play the game of hide the ball, but it's not productive. The answer here is for the Senate to come to the table and to strike the deal to get the border security that's needed for the U.S.-Mexico border such that we can provide funding and in particular provide weapons to the Ukrainians who are working to defend themselves against an unjust invasion from Russia, as well as providing the resources that is needed in Israel so that they can eradicate the terrorist group Hamas.
So you do support funding both as long as there's a border deal?
Well, I think I want to look at any legislation that comes forward to make sure that it's targeted, to make sure that we have accountability for how those funds would be spent, to make sure that we actually have an end game that we're driving forward and as it relates to Ukraine. What I think we've really seen the president do is failure to actually dictate what the end game is in Ukraine. That's a challenge in and of itself. But I think there is a true opportunity here to make sure that we're getting funding for in securing the U.S.-Mexico border and coupling that with the funding for our allies around the globe.
Okay. A few other things that are on the list here. Renewals for FISA and the FAA. I know those have been kicked into the new year, and so has the budget itself. Congressman, are we going to be talking about a shutdown when you come back after the holidays? The first tranche of bills would expire in late January, the next in early February. This laddered CR that we all labored over is actually in place now, and the clock is ticking. Based on all of the other chaos and lack of compromise that we've seen the last couple of months, do you think January will solve these issues, or are we talking shutdown in 2024?
This Congress has been so dysfunctional in a narrowly divided House, a narrowly divided Senate, and a Democratic president that has not been engaging. So I always remain concerned, but I remain consistent. Keeping the United States government open and operational is an absolute priority. Republicans lose and conservatives lose when we shut down the government because at the end of the day, we always end up spending more money in the end. We need to get the top line number completed, meaning what's the total dollar amount that we're going to spend, strike that deal, and allow the appropriators to get to work to determine how we're going to utilize the funds that we're going to allocate. The fact that we're delayed in this between Republicans and Democrats is darn frustrating for everyone. I remain concerned that this deadline is looming on us in the very near future, but hopefully this break that we're going to ultimately have for Christmas and the New Year will allow cooler heads to prevail such that we can get the work done on funding for this year's ongoing federal government.
That would be remarkable, not just based on history, but knowing the threats that could loom for the new Speaker of the House. I guess not so new. Mike Johnson has said no more CRs. So that's going to be the question here, whether there could be a short-term solution. Congressman, would that get the Speaker fired, a la Kevin McCarthy, if that happened?
I think the Speaker has done a good job in unifying the House and moving us forward. The challenge here is in a period of time where you have a narrow majority and you have Democrats in the Senate and in the White House in divided government, it's difficult to get anything done. I think when we hear that there's no more CRs, let's get the actual job done. Let's actually pass the appropriations bills, the work that so much of the House has been done to do that. Passing a CR is not a good answer. It's simply better than shutting the government down. I think many of us are optimistic that we can get the top line number completed, allow the appropriators to get to work to get the final drafts of the bills done and get those passed in both the House and the Senate and signed into law before the deadline.
Have you heard from the Speaker about when everybody's going home, Congressman? I'm guessing that's going to be tomorrow or Friday.
Well, we're scheduled here at the end of the week, but things in Washington change quickly. Again, if there's an opportunity to strike a deal to truly get border security, myself and others are going to stay in town to do that. Again, I would like us to stay here until we get that deal done, but ultimately we'll find out whether or not we're able to get that compromise and that piece of legislation across the line.
Well, that would be a high sign. Otherwise, I guess we're back to this in January. I want to thank you for joining Congressman Brian Stile, the Republican from Wisconsin, another lawmaker here on this program, willing to work overtime through the weekend and up closer to the holiday like the rest of us to make something happen. Congressman, if that's the case, we'd love to talk to you.
Will do.
Good to see you, sir. With us from Capitol Hill Live, Congressman Brian Stile. As we assemble our panel here on the Wednesday edition of Sound On, I'm Joe Matthew in Washington, now joined by Rick Davis and Jeannie Shanzano, of course, Bloomberg Politics contributors. Rick, it does look like they're going to be getting on airplanes on Friday and that there will not be a deal on the border. What do you make of Congressman Stile's idea? Everybody goes home for the holidays, cooler heads prevail, because we've also seen the opposite happen when lawmakers leave town. What's this going to look like?
Well, with all respect to Congressman Stiles, I think great interview, very smart guy, knows what's going on Capitol Hill. But cooler heads never get anything done in Washington. I mean, it's when they're back up against the wall, deadlines are the only thing that gets Congress to act. And so why not use this perfectly good holiday to force these guys to earn a living and do their job? I mean, as he pointed out, there are a lot of appropriations bills that could use some work. It's not like they should be just sitting around waiting for the clock to tick, not to mention Ukraine, Israel, border security, and Taiwan. And everybody forgets about Taiwan, but they got elections in January, and it'd be nice to show our support for the Taiwanese, by passing this legislation. So I think the whole trick here is to jam them by forcing them to stick around until Christmas Eve if they have to. Won't be the first time. And I think the key player in this is Joe Biden, who's got to be willing to make a deal on the border that's probably going to upset his party, but it's the only way to get a deal done. And in 6 months from now, he'll look pretty smart because he was able to fund this war in Ukraine, and they were able to turn the tide in the spring.
Well, the White House is apparently getting involved here in a real way, Jeannie. I don't know if Joe Biden can help to keep lawmakers in town. But we saw a really important meeting take place yesterday. Whether it leads to anything, I guess we'll decide how important it is going forward. But you've got the Homeland Secretary, Mayorkas, there. The Deputy Chief of Staff was there. Legislative Affairs Director, all taking part in a meeting on Capitol Hill with the key negotiators. I'm guessing, Jeannie, you're going to tell me that should have taken place weeks ago, but it's happening now. Is that enough reason for lawmakers to stay in Washington?
I think they should stay in Washington. Of course, we all wished it happened weeks ago, maybe years ago, but it didn't. The reality is, though, the incentive structure here, when you think about it from all perspectives, not just the White House, it's not playing to the advantage of anybody who wants to see border security passed. I mean, just think about it. Yes, the White House is getting pushback from the left. We've heard from Senator Padilla and others, the Hispanic caucus. You've got a lot of folks on the left worried about what the White House may, quote unquote, cave in on. But it's not just the left. This would be a big boon, to Rick's point, if the White House could get something on the border. Do we really think Republicans are incentivized to see that happen as we march weeks away into an election year? The incentive structure on the border issue has been wrong for a long time. In my mind, unfortunately, it continues to be wrong. The one thing I think we had in the favor was seeing Zelensky come over here. People do agree on getting Ukraine aid, Israeli aid, tying those together may push them over that. But so far, we haven't seen movement there. And that's where I think we are held up at this point. And unfortunately, to Rick's point, Taiwan, but also Israel, Ukraine, probably going to have to wait until January if they get done at all at this point.
Rick, CBS News reports the White House has a new proposal, a new border authority to expel migrants without asylum screenings, as well as a dramatic expansion of immigration detention and deportations. Congressman Stiles still talking about H.R. 2. Not a single Democrat voted for that. Is an idea like this attractive, or are you going to say we can't even enforce the rules currently on the books? What are we doing making a new border authority?
Yeah, it sounds like a pretty interesting end run around old Title 42. We spent a lot of time this summer debating that. So, look, I mean, it's creative, right? Last thing we need is another government agency. I mean, that's what Homeland Security was created to do. And the fact that they aren't very good at it doesn't mean we need to replace something, create something new. So I'm generally opposed to government expansion. But look, I want these patriots in Ukraine and Israel to get funding. I want a tighter border security. I'll take whatever I can get that tightens the screening process and doesn't allow illegal immigration at our border, without some kind of controls on it. And if this is one way to do that, not only will Republicans be interested in a deal like that, but big city mayors who are all Democrats, whether they're in Chicago or New York, they are tired of 20 buses a week coming into their cities and unloading immigrants looking for asylum.
Gina, you mentioned the president meeting with President Zelensky yesterday. We didn't have a chance to talk about this because their news conference ran late. It started almost an hour late. Their meeting in the Oval ran late. Was that a worthy visit? It sounds like you thought it had an impact. We may not have a border deal, but it reminded folks of the needs in Ukraine. We heard some lawmakers, though, suggest that they've been seeing a little too much of President Zelensky, not necessarily in person, but the asks keep coming. On his last visit, his attitude rubbed people the wrong way. Does coming here in person help?
It can't hurt. The reality is there is bipartisan support still in Congress to get aid to Ukraine. Arguably, to your point, there are more questions in Congress about the aid, how it's being used, what the end game is here. But the reality is Zelensky came over here and he is being asked to move Congress on something that he has no control over, which is the border. And so, I'm not sure it makes that much of a difference. What was a difference was this year. I mean, last year he comes and there is a standing ovation. This year, we even saw Congress people who weren't even that interested in meeting with him or hearing from him. The ones who support have said that publicly. The ones who don't have been vocal about that. He does have the support needed. But if that's tied to border, it's not going to be something that Vladimir Zelensky, as talented as he is, can impact. And so this is where, I'm not sure that his visit, it's got to have been distressing for him. I'm not sure it's going to be effective in getting him what he needs in the short term.
Was that a smart move, Rick, to come to the United States in the middle of all of this? He knows about the border debate. President Zelensky knows about the funding issues here in Washington, the lack of consensus. He's still parachuted in the middle of it.
Yeah. There is consensus on support for Ukraine, but there are a lot of chirping members in both the House and the Senate. And we've talked about this being sort of a deadline, right? Deadlines are good to get things done in Congress. he took the risk to travel here because he knew that we were entering a deadline. And could we get this done before the end of the year, before the Christmas break? And he was willing to gamble his time and travel in order to get that done. I think he was respectfully received. I think that it probably drew more attention to Ukraine than it otherwise would have gotten without him being here. So I think all those things are positive. Let's see what will come out of it. Let's see whether or not Republicans and Democrats in the Senate can work together to fashion a bipartisan solution, which is being worked on feverishly right now to try and get out before these guys break for Christmas.
Quick gut check before we go to Charlie Pellet for an update on the markets. I haven't even mentioned Hunter yet, and we're going to get there. For Rick and Jeannie, I'll start with you, Jeannie. Is the government going to shut down at the beginning of next year?
I don't think it's in anybody's interest, so I'm going to say no, but with a 3-vote margin, I think it's anybody's guess given where the House is at this point.
You know, the Republicans have an allergy, including the Speaker, Rick, to another CR. What do you think?
Yeah, I think that forces action. It would have had more confidence that if they'd gotten some decent work done on those appropriations bills that are due by that first deadline in January, that it would have been a relatively easy thing to pass those. I think the Freedom Caucus is on their heels, so now's the time to sort of do the government's work while you still have a bit of a honeymoon as Speaker.
Well, if only they listen to our panel more closely, like we do. Where's Hunter? He's here today in Washington. As a matter of fact, we're going to do that next and talk about a looming vote here on what appears to be set to formalize an impeachment inquiry into Joe Biden. It's all happening today in the Capitol. Let's first get you up to date on the markets, though. I want to hear from Charlie Pellet in New York on trading. How's it look, Charlie?
A whole lot of nothing, Joe Matthew. We got just about 38 minutes to go until we get the FOMC decision. We'll be all over it as it drops 2 p.m. Wall Street time. And, of course, Fed Chair Jay Powell's news conference, 2:30 p.m. Wall Street time. Right now, S&P 500 index unchanged on the day. We have got the Dow up 4 points, also little changed, up less than 0.1%. NASDAQ down 12, a decline there of 0.1%. Bottom line here, all about the Federal Reserve, Wall Street gearing up for what is expected to be the most important Fed decision of the year, with traders awaiting any signals on whether the market's aggressive dovish bid may be overdone. 10-year yield, 4.15%, with a 2-year now at 4.66%. Spot gold up $3 the ounce now to $19.82, a gain of 0.1%. West Texas Intermediate crude oil up 1%, $69.26 for a barrel of WTI. Pfizer shares now down 8% after the drug maker gave an adjusted earnings forecast for 2024 that was below the average analyst estimate. So again, recapping, stocks are flat ahead of the FOMC decision. S&P 500 index up now by 0.5 point. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie, thank you. We'll be in our special Fed coverage just about 10 minutes from now with the wind-up, the results, of course, the announcement on rates, and then the news conference. You'll hear it all live here on Bloomberg. I'm Joe Matthew in Washington. You know who else is here? Hunter Biden. Not a lot of folks saw this coming. An interesting decision to actually set up a podium and a microphone right outside the Capitol. First thing this morning, reporters called to the steps of the Capitol again. Here he is.
I am here to testify at a public hearing today to answer any of the committee's legitimate questions. Republicans do not want an open process where Americans can see their tactics, expose their baseless inquiry, or hear what I have to say. What are they afraid of? I'm here. I'm ready.
Ready to testify publicly, but that's not what the committee wanted. The Oversight Committee, led by James Comer, wanted a closed-door testimony from the younger Biden. This, of course, is Joe Biden's son. We knew in advance that he was not going to do that through his lawyers. Hunter Biden already said that he would, in fact, answer the call to testify, but would only do so publicly. Members of the committee not happy, including members of the Judiciary Committee. Here's Chair Jim Jordan.
Disappointed that he didn't show up. I mean, he was just across the way at the Capitol. You'd think he could have come here and sat for questions.
you do it in an open format now, you're gonna get filibusters, you're gonna get speeches, you're gonna get all kinds of things. What we want is the facts.
And all this is leading us to a vote later today. And you can connect the dots on this as you see fit, but it does appear to be a vote on an impeachment inquiry against Joe Biden that'll happen after the closing bell. Let's reassemble the panel for their thoughts on this. Jeannie Shanzano and Rick Davis, Bloomberg Politics contributors. Jeannie, how can you say he's a no-show when he showed? Was that a smart move for Hunter Biden today?
It was a smart move. He is well represented by Abby Lowell. And I have to say, listening to Jim Jordan, since when did the representative oppose speeches and people grandstanding and filibustering? It's not the Jim Jordan used to know.
Fair enough. That's what we thought hearings were for, Rick Davis. But when you listen to Hunter Biden, he's referring to MAGA. He's sounding a lot like a politician here, or at least a political operative, knowing, of course, that some horrible things have been said about Hunter Biden. And he's done some pretty bad things, too, as he acknowledged today in his speech.
They continue to insist that my father's support of Ukraine against Russia is the result of a non-existent bribe.
Lost.
They displayed naked photos of me during an oversight hearing. And they have taken the light of my dad's love, for me, and presented it as darkness. They have no shame.
Rick, Jeannie mentioned his lawyer, Abby Lowell. This sounded like a speech that was written by the White House or maybe the Biden campaign. Should Hunter Biden, well, let me rephrase that. Does Hunter Biden help himself by making references to the ultra MAGA?
Yeah, I think it was actually a speech that would have been more likely written by Donald Trump's campaign. I mean, this is the year of no shame. I mean, so he just pulls a full, Donald Trump and talks about his own foibles and brings up a lot of topics. Nobody in the Biden campaign is going to sit around and say, yeah, let's go out there and talk about your drug addiction and all the problems that you had and all the laws that you knowingly and willfully broke and the years of prison time that you've got coming down as the son of a president of the United States. Yeah, nobody's gonna write that script. But Donald Trump, bring it on. The only thing that was missing was this is not a prosecution against me. It's a prosecution against you, the people of America. I mean, I was waiting for that in the speech and it didn't come through. I was disappointed.
Oh, boy. All right. So let me turn that back around then, Jeannie. Is the Biden campaign cringing right now? Wouldn't they talk to him first?
Yeah, I think I listened to what he had to say and I thought it was well done. And I think the Biden administration is saying, way to go. And while Rick didn't hear them make the case, they're prosecuting you, I certainly did. I mean, that's the case he is making. This is a political prosecution against my father because Donald Trump is worried about running against him. If he wasn't running, do you think Republicans would be spending any time on Hunter Biden? I mean, that's the case he is making. Now, let's set that aside. Hunter Biden has done some really arguably horrific things, illegal, and he should and is in his own mind, in his own words, being held accountable for those. There's no question. The question here is tying it to the president without any evidence so far of high crimes and misdemeanors. That's the problem. This is all political, and he's making that case, and he'll continue to.
Well, I wonder your thoughts on that. Let's go to the big one here, and that's the impeachment inquiry. It looks like there'll be a vote today that codifies this as a legitimate exercise in the House of Representatives. Maybe I shouldn't use the word legitimate. It'll make it official. I don't know. You can save the tweets and emails. But, Rick, we still haven't seen the smoking gun, a document that ties these activities by Hunter to the president, or what Jim Comer refers to as the Biden crime family. Will Republicans regret moving this into an impeachment?
It's going to be a news story tonight. I mean, they're going to try and take this vote. The only thing that makes it an interesting news story is if they actually fail. My guess is it'll be a party line straight up, and they'll have a couple vote margin and claim that they're going to move forward with this inquiry. Many members have already stated that unless there is a smoking gun, as you say, Joe, they're not going to vote for impeachment. And so this could be the longest inquiry in the history of impeachments. It could last all the way through to Election Day next year. And look, I mean, I think Hunter gamed them, right? I mean, they wanted to take this vote tonight on the heels of his testimony. You don't think Comer would have run out of that hearing room that had been locked all day long and say, I've got a smoking gun. We've got to open this inquiry now. I mean, like, of course he would. So he's denied them that satisfaction. They got to take a straight vote now. It's all politics, as Jeannie says. But I've actually seen a lot of surveys where the American public is not backing this inquiry. So, proceed at your own risk, House Republicans. You wouldn't be the first time that when Congress goes after a president that it backfires on him politically. Bill Clinton.
Does Joe Biden come out stronger then, Jeannie?
I'm not so sure if he does or not. I think the reason we're seeing the 18 from the Biden districts, 18 Republicans who look likely at this point to support this inquiry vote, is because they don't see a downside. We've talked about this before. Impeachment has now become watered down political tool to be used. It's stunning to me for a party that claims that it is, committed to the Constitution, that they read the Constitution in a very fair and inconsistent with the way the framers intended it to, are pushing for this because there is zero evidence, again, of high crimes and misdemeanors. So, I'm not sure, though, they see a downside because they think this will gin up their support at the polls. It will gin up contributions and it won't deter independents potentially. So it's just another tool now and they're pursuing it. And this is why people are frustrated with Washington, D.C.
Jeannie Shanzano and Rick Davis, we thank you, as always, for great analysis. Consider what was just said around 5 o'clock when that vote takes place. And, of course, we'll have the latest for you on Balance of Power on Bloomberg TV when that finally emerges. They could coincide. As we kick things back to New York now, our special coverage of today's Fed meeting just about to begin here. The Fed Decides, brought to you by Commonwealth, supporting more than 2,000 independent financial advisors with the solutions they need to grow a thriving business. Commonwealth. Go where you grow. Visit commonwealth.com to learn more. I'm Joe Matthew in Washington, a special edition of Bloomberg Surveillance Now. The Fed Decides with Tom Keene, Jonathan Farrow, and Lisa Abramowitz starts right now.
Live from New York City for our audience worldwide, Bloomberg's The Fed Decides starts right now.
This is a special edition of Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz. Bloomberg Surveillance, The Fed Decides.
From New York City on TV and radio, the Fed decision about 28 minutes away. The last Fed decision of 2023. The pivot for this market is in sight. TK, we're pricing in a ton of rate cuts in this market for 2024. Will we get any kind of endorsement from this Fed chair in the next 60 minutes?
Raging debate around what we're going to go through in the next couple hours over where are we a year from now, with the clarity that we have of looking back when we were 1 year ago, thinking this December meeting would be like this. We nailed that. Same uncertainty today, massive uncertainty about the path.
Hey, TK, never mind 12 months. Where are we 2 hours from now? Where are we 2 hours from now? Yeah. Three-part story. We'll get a statement, we'll get projections, and Lisa, then we get the news conference. And a lot of people have got the same question. We've had a move of 10% on the S&P 500. We've had a monster rally in the bond market. Do we get some pushback from Chairman Powell a little bit later?
We were hearing from Andrew Hollenhorst that he has to be kind of awkward here. He has to push back to some degree, and yet he has a sense that disinflation does open the door to rate cuts. So here's the question, and you really raised this earlier. How does he address the fact that Chris Waller was talking up the potential of rate cuts, and then pair that with a statement of economic projections and their own rate cut projections and when they'll start next year?
Never mind Governor Waller, that's easy. He's on the committee. Let's talk about Chair Yellen, Vice Chair Biden in the last couple of days, weighing in on what the Fed maybe and maybe shouldn't do.
This is a joke at 7 a.m. It's not a joke here at 1:33, 20 minutes away. John, you're right. And the key thing there, historically, the key thing there is Vice Chairman Biden and to see what he does. But the answer is there is some political pressure, some overview. And I'd also point out there's international pressure. All the people we talked to today says a massive devaluation in Argentina, off the radar, Sri Lanka off the radar. My answer is global slowdown is on the radar.
We joked about President Biden. Here's the quote. We're in a sweet spot following that jobs number. This is the line from Friday, Lisa. A sweet spot that's needed for stable growth and lower inflation, not encouraging the Fed to raise interest rates.
That's that's what we heard from Chair Yellen, our Treasury Secretary. And she spoke earlier today, and she was talking about how she is going to let the Fed do their thing and that she has confidence they're going to do things well, but that you could cut rates just as a de facto step should inflation come down, because if you didn't, there would be a de facto tightening in financial conditions, even with the disinflation. So she's going to the Chris Waller school of thought at a time when there is the pace of inflation coming in, but prices are still rising. And this is what is such a difficult and awkward thing to talk about.
That's the tricky dance for many of these policymakers. Let's start with the scores this afternoon. On the S&P 500, coming off the back of a 3-day winning streak on the S&P. Equities right now just about unchanged, struggling to make it day 4. In the bond market, yields are lower by 3 or 4 basis points here, Bramo, 416.23.
This is the state of play coming up in the lead up to the Fed rate decision. JP Morgan's Priya Misra and Deutsche Bank's Matt Lazzetti will be joining us at 2 p.m. We do get what that rate decision is. They will be on hold, but the key will be the statement of economic projections, and any language changes. We'll get immediate reaction from KPMG's Diane Swank, PGIM's Greg Peters, Bank of America's Michael Gapin, and SocGen's Subhadra Rajappa. We'll get the press conference, breaking it all down. Chair Powell's every word will be former New York Fed President Bill Dudley and BlackRock's Jeff Rosenberg, as we try to understand how the market's going to take what he says.
It's going to be interesting to see. Let's get right to it now. We begin strong with Priya Misra, fixed income portfolio manager, JP Morgan Asset Management. You know, Priya, I got 8 ways to go here, but what I got is 8 different outcomes of this meeting today. You have a shocking outcome of substantially lower interest rates, of a 10-year yield driving down well into the lower 3% range. Is that Fed-induced or growth slowdown induced?
I think it's a combination of both. You know, interest rates move based on fundamentals of the economy and the Fed response function. And that reaction function is what you're going to get from the Fed today. I mean, I think, you know, the market's going to look through the economic projections because the Fed, like all of us, looks at the data and has to revise as the data comes in. But if the Fed reaction function today suggests that they see that as inflation comes down, they need to cut rates, and I do think they're going to suggest that. You know, I think the debate is it 50 basis points of cuts or 75? In a soft landing scenario, if they're cutting 75 or 50 basis points, how much do they cut in a hard landing? Are we talking 200, 300 basis points? I mean, my view is that with real rates this high, the lags are kicking in and the economy is slowing down. Global growth is anyway slowing down. So in the hard landing camp, I do think long end rates have a lot of room to decline. Even in the soft landing case, the Fed's cutting rates. The Fed catch up, hiking 75 basis points, getting rates up to 5, you know, getting real rates high into restrictive territory, tightening financial conditions. That's behind us. The market's forward looking, and now it's all about when do the cuts start and how much in totality are they going to cut.
Priya, as Lisa suggested, this is a really delicate dance. How does the chairman signal in the news conference the work's not done when the dot plot might imply 2 or 3 rate cuts in 2024?
Sure. So I think 2 o'clock is going to be really tricky because they have the statements and the dot plot. And I think it's going to be hard for them to sound hawkish at 2. At 2:30, I think Chair Powell will have his chance. I think should take a bit of a victory lap. You know, remember inflation was transitory. Well, it's looking like it's coming down. And so he can actually address and acknowledge that it's coming down, but stop short of saying mission accomplished. And then talk about rate cuts in a normalization sense, as opposed to let the market run away with rates are going back to 0. Start the talk of maybe you have to recalibrate policy and get, you know, rates, normalize rates as inflation comes down to keep real rates constant. I think that's how he's going to try. It's a very delicate balancing act. I think that's where the press conference is going to be important. So I would look at the 2 o'clock reaction, and then the 2:30 reaction might be a little different because I think he might try and say, not so fast. We're not ready to start cutting all the way down. You know, it requires a lot of things to go right. So I think he's going to try and finesse it, but it's a challenge for the Fed today.
Priya, we've been hearing from some of the Fed speakers. They're concerned about anecdotal evidence showing a faster slowdown than what we currently see. Do you expect that to be reflected at all in the statement of economic projections, where growth's been upgraded and unemployment expectations have been downgraded?
I think it's hard for the Fed to show that, especially when you're looking at average numbers like the unemployment rate, which is going up because participation's going up, for example. So I think it might be harder, but I am curious to see how much they move the unemployment rate, next year. If they do have, if you look at the underlying labor market data, I know Friday was a strong payroll report, but you look at the underlying, you strip out the strikers or the government jobs, it's really coming from two sectors. There is slowdown in the labor market. But I think it's hard for the Fed to finesse that. I think all they want to say is we'll be mindful, we'll watch data and respond accordingly. But I don't know where you can see that very clearly in the statement of economic projections beyond just the unemployment rate. Perhaps a 4.2 or 4.3 is where they can get it up to. I think anything higher would be an odd move by the Fed because we don't really see it clearly in the aggregate data. The cracks are developing, and I think Chair Powell can hint at it at the press conference rather than show up clearly in the forecast.
Where's the asymmetry in market positioning right now heading into this meeting? In other words, where's the biggest response potentially going to come from with a surprise, either with a more hawkish or dovish type of tone?
So I actually think a more dovish tone will have a bigger reaction. I think a lot of people missed buying the 10-year at 5%. And then they've been waiting. We've been waiting. When you get back up, we'd like to come in and buy. There's a sense of a FOMO move, just buy everything rally going into year end. So I think if the Fed suggests that in soft landing, they can cut 3 times, 75 basis points or 100 basis points next year, the market's pricing in 100, well, you should price in some probability of a hard landing. So I think you'll get a much more reaction to lower rates in a dovish Fed commentary, either nervousness about growth or this idea that they can cut a lot more rates. If you get a hawkish Fed, I think the market almost is going to disbelieve the Fed because the Fed can change its mind. It's done that before. Yeah. It's responsive to data. So I think that's where the asymmetry is.
It's so true. Priya, stick with us. Stay close. Priya Misra there of JP Morgan with less than 20 minutes to go until that Fed decision. What Priya said there, Lisa, is so important. Sequencing matters here. So at the top of the hour, in about 20 minutes' time, you'll get the statement and the projections. 30 minutes later, you get the news conference. And I would say it's kind of like getting earnings. You get the earnings, and then you get the earnings call. Do you really want to make a move on the earnings before you've heard the call? And we have a real potential here to be whipsawed by Chairman Powell 30 minutes after the decision drops.
She was saying basically that's the base case right now, that we're going to get whipsawed because it's going to sound dovish, and then he's going to come out, Jay Powell, and have to be hawkish. That is the expectation, and then it'll be a wash.
I'm going to go all Italy good on you over at BMO Capital Markets. The most interesting number here into this Fed meeting and through the conversation, the press conference, is a 10-year yield. We have come so far so fast, John. I got a 4.54 upper range on the 10-year, and where it gets interesting is 4.06%. So if we come in 10 basis points lower yield, that's demonstrative at this moment today.
What's interesting, TK, as well, is where the 10-year was the last time they met.
Yeah, it's technically elegant.
70 basis points higher. The conversation continues. Deutsche Bank's Matt Lazzetti with JP Morgan's Priya Misra. Your equity market on the S&P 500 is totally unchanged. The Fed decides. The decision just around the corner.
That's me, Max. What's up? How are you? I have been writing about Wall Street for almost 15 years. And what that means is I write about feuds and rage and rises and falls and comebacks. And every now and then, I also write about a couple of villains. Thank you so much. And now, I am about to do something new and very, very scary. We are making a show, and it's based on Bloomberg Businessweek magazine. So what is this show about? It's a show about money, power, culture, pop business. We're gonna ask complicated and profound people about their ideas, their careers, their lives, their risks, their failures, their imagination.
It's so incredibly liberating not to care what other people think.
I was giving my tools to other communities. I wanted to bring those tools home.
Tune in. Please, really actually tune in. I desperately need an audience.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
It's a Fed pivot party, and we're all invited.
There will be a eventual pivot, towards easing.
Traders right now are pushing this dream of 4 rate cuts next year.
Markets have been celebrating this idea that there's disinflation in the pipeline.
And inflation's coming down faster than many thought.
Things are at least directionally on track for the soft landing.
The market has been overly optimistic on when the Fed has cutting.
Is running too far ahead of Jay Powell and team.
They will definitely fight back.
Push back hard on cuts next year.
On where the market is, where it's gotten a little bit ahead of itself.
We still need to respect the fact that the last mile of the inflation journey is often the most difficult.
They have to keep some vestige of this tightening bias. I don't think that that's a message that's going to be believed by markets.
The market is like, we don't believe you.
It's up to Powell how much he's going to push against that market pricing.
Live from New York City this afternoon. Good afternoon. Good afternoon. Alongside Tom Keene and Lisa Ravitz, I'm Jonathan Ferro. That Fed decision 15 minutes away. The scores look like this on the S&P 500, totally unchanged on the session. But since the last time this Fed met, we've rallied hard by about 10% on the S&P and more on the NASDAQ. Check out the bond market. Switch up the board. 2-year, 10-year. Think about where the 2-year was. The morning, the last time the Fed met. 5.08% that morning before that Fed decision. The 10-year that morning, TK, 492 is where we opened on the 10-year that morning. And here is where we are right now. 466.96 on a 2-year, down 6 basis points today. On a 10-year, 416, down 4 basis points this afternoon.
I'm watching the 10-year just by chance today. I think it's technically very eloquent and really derives to a lower. I just want to say with the work that our team does to put together, the only reason I do this show is all those different voices at the beginning of the B block of the Fed decides.
It's the only reason you're here?
It's the only reason I'm here. I mean, it's hilarious. All the different opinions, the language, the opine. How many of his questions today is he going to read off a piece of paper? Almost precise.
Well, he should know what's coming based on that. Yes. That captures the consensus almost perfectly. This is about pushback. How much pushback we get in this news conference a little bit later, if any, at all. I want to finish on foreign exchange, Lisa. Important. The tug of war that's set to take place. We're talking about the Fed in isolation. You need to talk about the Federal Reserve versus the ECB versus the BOE, and think about the FX market, the dollar index, stable, just about unchanged. The euro going nowhere, Lisa, 107.86. The other side of the trade, it gets interesting in the next 48 hours.
All I can say is, why would, to your point, anyone trade right now on this trade, this currency pair ahead of the Fed meeting and then the ECB meeting tomorrow at a time when they're largely expected to cut rates first?
12 minutes away. We've got to get to Matt Lazzetti. He's got to get to his Deutsche Bank clients and representatives across all of the Deutsche Bank world. He's their chief U.S. economist. Priya is with us as well. Matt Lazzetti, I really got to go to the real economy because of your claimed, there'll be a slowdown, but it's out there somewhere. You nailed that this year. Let us reframe the importance of slowing economic growth to Chairman Powell here in 10 minutes. How does slowing American GDP filter into today's event?
Yeah, I think the bigger story for Powell and the Fed has been how quickly inflation is coming down, and certainly whether or not they can cut rates purely on an inflation story. And that's what Governor Waller was getting at 2 weeks ago within his comments, is what's driven the market dynamics over the past 2 weeks to price these substantial rate cuts. So I think from the Fed, from Powell, we'll continue to hear that they do want to see some slowing in the economy. They do want to see a labor market that continues to come into better balance. But I think first and foremost, the most important development has been inflation coming down faster than anticipated from the Fed's perspective, and the scope that gives them to cut rates next year.
Does the job economy exist in today's analysis?
Yeah, no, I think the labor market is, the fact that has come into better balance very quickly over the past 6 months or so is really important in that assessment. But I think given where we are on the unemployment rate, the quits rate, job openings coming down, the labor market is not an additional reason for the Fed to sound hawkish at the moment. I think that they can kind of transition away from the labor market and the concern around that it's too tight and driving inflation, and then pivot towards focusing on the inflation data, which just undeniably is showing a lot of progress over the past 6 months.
The Fed has two mandates, right? One of them is to bring down inflation, and then there's also this question of making sure they avoid some sort of hard landing going too far. Where is that balance of risks right now, given the fact we have seen disinflation, but there's still a lot of questions about how sticky that is?
Yeah, no doubt. Over the past 18 months, the Fed has leaned heavily towards doing too much potentially in terms of tightening, because the risks were that inflation becomes sticky, becomes embedded, and it's more difficult for them to get down over time. I think what we've seen, particularly over the past 3 or 6 months, is a pivot towards and a transition towards concerns on the growth and labor market front, and that'll continue. It's quite natural that continues as inflation comes down. You become a little bit more worried about the growth side of the dual mandate, the labor market side of the dual mandate. And I think we'll continue to hear that from Chair Powell today, that they are concerned about upside inflation risks, but that balance of risks from their perspective is coming into better balance.
That said, we've been talking a lot about the easing in financial conditions over the past month and how this goes exactly counter to some of the goals. How much do you think that Jay Powell needs to push back on that to keep the gains that they've made with respect to bringing inflation down?
I think for the Fed, financial conditions are completely context dependent. So if they were not achieving progress on inflation, if the labor market was still extraordinarily tight, if we were still seeing growth that was well above the potential growth rate, that the Fed would want to lean back on that and kind of push back on the financial conditions tightening that we've seen. But in the context of seeing a lot of progress on inflation, being a little bit concerned about downside risks to growth in the labor market, I think the Fed is a lot less prone to push back on that. I think what you'll hear from Chair Powell is what we've heard from his colleagues is that financial conditions, even though they've eased a lot over the past 6 weeks, do remain tighter than they were earlier this year. And I think just the underlying reality is they don't need them to be as tight as long as they're getting progress on the inflation front.
Let's break some rules. Let's put some numbers on it and some dates as well. Matt Lizzetti, when do you think they start cutting, and by how much?
So we have had for a long time an expectation that they start cutting rates in June and that they cut rates by 175 basis points next year. Certainly that was, I think, a lot more aggressive than market was pricing, certainly 6 weeks ago, 3 or 4 weeks ago. The market has come far more in line with that expectation. I think critically for today, Chair Powell will probably somewhat push back on the market pricing, perhaps say that it's premature to talk about rate cuts. But unless he does that explicitly and explicitly rules out that rate cuts are not going to happen early next year, I think the market is going to look through that. The market will look through the underlying trends, which is that inflation's coming down. The Fed is transitioning forward in a way which rate cuts probably become more likely. And I think it's going to be really hard for him to push back on market pricing and the underlying dynamics in markets at the moment.
Priya Misra still with us from JP Morgan. Priya, let's get to you. You sit on the buy side. When you hear those kind of calls, 175 basis points of cuts next year, starting in June, what do you think?
I hear a lot of optimism that these rate cuts will actually allow the soft landing to continue. But I think what it somewhat misses is if the economy is slowing down, the lags work both ways. So even if the Fed does start to cut rates, financial conditions may ease, but does that actually help the economy that quickly? It might take a while. So I think, I think owning duration makes sense here. I think the curve is a little bit more tricky. Do your credit work or understand exactly what companies you're buying or what balance sheets or business models, because even if the Fed starts to cut, I think it's too optimistic to think that can engineer a soft landing. If the economy is slowing and you have non-linear, increase in the unemployment rate, it takes a lot of rate cuts. It takes rates into accommodative territory for that to actually turn growth around. So I think we may be in for another volatile year next year, as I think the economy, we parse through the economic data as well as how the Fed responds, and when do they transition from normalization rate cuts to actually accommodative rate cuts. I think that's going to be a tricky one for the Fed, because they have to realize, well, we have to actually cut a lot more than just normalize.
But to be clear here, Priya, the big shift in the last 6 months is to move from some level of restriction to now a shocking accommodation, right?
I think in real rate terms, it's harder to see that because inflation's come down a lot. So if you think about the real rate framework of how the Fed, I think, operates, policy went from very restrictive to slightly restrictive because, you've had that big decline in inflation and the Fed hasn't, nominal rates have declined, but a lot of that has been inflation. So I think some of these rate cuts that are getting priced in are all inflation induced. I think for it to be accommodative, you have to have real rates decline. 10-year real rates are still at 2%. I think that's still well within restrictive territory.
Matt, before we let you go, I know that you did work at the Treasury Department, and I'd love you to weigh in on the awkward kind of dance between the discussion from the Treasury Department head and the head of the Federal Reserve. How much credence do you put into what we heard from Yellen about the potential of just sequential rate cuts in response to disinflation and this optimism of a soft landing, and pair that with the likely agreement with Fed Chair Powell?
Yeah, I think, the comments that we hear from Secretary Yellen in some ways are very much in line with what we heard from Governor Waller, which is that as inflation comes down, in order to ensure that policy doesn't become too tight over time, the Fed, certainly could cut rates. It's a separate question about how do you message that, when do you message that, and how do you kind of deal with the risk balance about how worried they might be about inflation picking back up again. At this meeting today, I think it's too early for Chair Powell to completely embrace that story. I think he will want to say that it's still premature to really have these discussions. The dot plot will show rate cuts, but expectations that that's not going to happen for some time. But I do think that conversation within the Fed can kind of transition relatively quickly. I think by Q1, if they continue to get positive inflation data, they could begin to more actively talk about what conditions do they need to see to cut rates, and that might be quicker than what many people think.
I think Priya was happy she didn't get that question, and Matt Lazzetti did. Hey, Matt, it's good to catch up. I know you've got to run. Matt Lazzetti over at Deutsche Bank. We are about 4.5 minutes away from that Fed decision. The state of play looks like this. Equities going absolutely nowhere. Looking for changes in the statement, changes to the projections, and looking for the tone in the news conference with Chairman Powell. Priya, I want to talk about how one-sided things have become in the last 4, 5, 6 weeks. All of a sudden, 99.9% of the people we speak to are on the same page. They're looking for rate cuts in 2024. We can have disagreement about the start time, the amount they do end up cutting, but ultimately, they're all on the same page. Priya, 6 weeks ago, it was a very different story. Do you find that unsettling?
I think end of cycles are always tricky because the data doesn't point to one clear direction, and we're all used to a forward guidance Fed, and there is no forward guidance here, and I would discount any forward guidance you get from them. So it is. Yeah, I think the narrative shifted very quickly. Remember, nobody wanted to buy treasuries to now everyone sort of falling over themselves to buy treasuries even with the move. It is disquieting, but I think it tells you that price action can be driven by positioning often, and so we have to be careful. But I think you take a step back. Is monetary policy restrictive? Yes. Is the economy slowing down? Yes. Inflation is declining. I think that's a good environment for fixed income. All the money sitting out in cash is going to start to come out and look for value.
Well, that's right where I wanted to go. Is your stunning call of price up and yield down, down, down? Is it that wall of $6 trillion cash?
There is some of that, yes, because I think, that money has it's been good to sit in cash. You earn 5%. As the Fed starts to cut rates, what about their reinvestment risk? And if the Fed's cutting 50 basis points, or, the market should price in the total amount of cuts, if we're talking 200, 300 basis points of cuts, that cash is not going to look that attractive. And that's why I think you're seeing people now thinking about where do I move out, and you start looking at valuations. I would say, high quality fixed income now is a very strong competitor to all risk assets. Yeah, and you get liquidity, you get high quality, and you get positive real rates, 2% real rates in treasuries. I think that's attractive, and I think that's one of our big calls for why, the next year, 24, is going to be a good year for fixed income as the Fed starts to cut rates. So that's why I think the narrative around Fed easing, and I think the dot plot will confirm that, is key to why money starts to move out of the front end into bond funds.
Priya, let's wrap it up. 2 minutes to go until the decision. You're going to run away back to the Bloomberg terminal in just a moment. When all this drops, what are you looking for first?
I'll be looking for number of, you mean from the Fed, right? I'll be looking for number of rate cuts that they're looking for next year, and the inflation, what is their forecast for inflation and growth? So sort of to get their response function.
I meant the Fed, not the bar cart, but you can go there too. Priya, thank you. Priya Misra, JP Morgan, appreciate it, Priya. I knew where you were going, TK, that's for sure. We are about 90 seconds away from that Fed decision. Equities going almost absolutely nowhere. TK, this is an interesting one for Chairman Powell.
Precisely right. This is interesting. He's really boxed in here. Talk about degrees of freedom, which is fancy for what's his choice set. What is his optionality forward? Nada this time around. He is framed in tight.
What I'm curious about is the statement of economic projections. At the previous one, they expected the next year to end at 2.6% for core PCE. UBS did a study derived from PPI and CPI that we got this week and found that the 6-month annualized rate of that core PCE was 1.9%. So do they downgrade their expectations of where inflation is? And then how do they then pair that with a GDP call and an unemployment call? Do they then make those also more rosy? It's just, that's really
where we got to get to the announcement. When I hear the word expectations, all my radar goes up. They don't expect, they react to the data. They react to what we're going to see in 20 seconds, John.
And then Chairman Powell's got to try and clean it all up in about 30 minutes time and 20 seconds. 20 seconds away from the Fed decision. The scores look like this going into it. The equity market just about positive by 0.1% on the S&P 500, up 0.1% on the NASDAQ. In the bond market, your 2-year yield shaping up as follows. The 2-year 4.66, the 10-year 4.15. With your Fed decision, here's Mike McKee.
Doves fly at the Fed as officials signal they are done raising rates, instead raising the number of rate cuts they see next year. Officials left the overnight rate unchanged at 5.25% to 5.5%, but they essentially confirmed that's it. The money quote from the statement gets a one-word addition in determining the extent of any additional policy firming that may be appropriate to return inflation to 2%. The dot plot, meanwhile, sees 75 basis points of cuts next year, one more move than they saw in September. The dispersion is wide, however, with 8 seeing fewer than those 3 cuts, 5 seeing more than 3. In 2025, they see an additional 4 rate cuts, 1 down from September, and 2 more in 2026. The longer-run neutral rate remains at 2.5%. Their move comes as they significantly lower their median headline inflation forecast this year to 2.8%. As the statement notes, inflation has eased over the past year, but remains elevated. In the median forecast, it falls further in 2024 to 2.4%, 2.1% in 2025, and 2% finally in 2026. Core PCE inflation, 3.2% this year, down from September's forecast of 3.7%. It keeps falling, hitting 2% also in 2026. The statement says, quote, growth of economic activity has slowed from its strong pace in the third quarter, but they still revised their median forecast for GDP growth this year significantly to 2.6% from 2.1% in September. It falls to just 1.4% next year. Potential growth in the longer run is seen at 1.8%. No change in their unemployment forecast of 3.8% this year, which implies the jobless rate moves up in December because it's 3.7% right now. The next 3 years, the median unemployment rate will come in at 4.1%. The decision, guys, again, unanimous.
Mike McKee, thank you, sir. Let's make it very simple. The 2024 dot, implying 3 cuts next year from this Federal Reserve. It doesn't meet the market, but it closes the gap and endorses the direction of travel over the last 4 to 6 weeks. In the bond market, this is what's falling right now. Yields and falling hard. We're down 19, call it 20 basis points lower at the front end of the curve. On a 2-year, 4.53. On a 10-year, down 13 at 4.07%. Once you figure out where the bond market is, take a guess where the FX market is. The dollar looks a little something like this. Against the euro at the moment, weaker. The euro stronger, 108.45. And if you're looking at equities, we endorse a move higher, up by 0.5% this morning week on the S&P 500, up again this afternoon on the NASDAQ by 0.4%. Lisa, the rally moves on.
We could end up getting a sub 4% 10-year yield by the end of this trading session as people parse through this. To me, the fact that this is unequivocally dovish, that they endorse the Fed's idea, that the market's idea of rate cuts and then some, really speaks to a question of, is there going to be cleanup act on aisle one, or is this going to be Fed Chair Powell saying, we're just responding to the data in front of us and it looks pretty good?
Well, we talk about, Tom, the risk, the potential of being whipsawed by Chairman Powell at about 27 minutes' time. The early take, and we'll see if it sticks, the early take is this. Ultimately, you're looking for 3 cuts next year. Our 4 or 5 cuts no longer sounds that ridiculous. Now you come closer and closer to where we were before.
No hedging here. I was going back and forth with a professor at the University of Cambridge, and 2 standard deviations down on 10-year yield. John, we almost came to it. We came very, very close at 4.08%, 4.07 at 4.6. We'll have to see what plays out with the press conference, but this is frankly more than we expected. We also expect wonderful conversation at this moment with Diane Swank. She's chief economist at KPMG. Diane, you know the interest space is the litmus paper of our economic and our Fed system. Are we seeing a constructive reduction in yields, or does this signal slower economic growth?
Well, I think what we're seeing is that the bond market is leaning into the concept of the fact that inflation has plummeted so rapidly. I think this is a full inflation story. There's no question that the Fed has showed its cards here. They're very excited about the fact that inflation has come down at its fastest pace outside of World War II, the Korean War, and the Volcker recessions. That is really stunning, given we've not seen a major increase in unemployment with that, and they're feeling good about it. And I think you're going to see some of that euphoria from Chairman Powell as well. It's more than we expected. It is important to remember last time they had a rate hike before the end of the year. So just by removing one rate hike out of it, that puts one more cut into 2024 as well. And I think that sort of nuance is lost in translation, but it is part of the story as well, is they're not really backing off higher for a period of time. The next question is higher for how long?
Some big moves.
I think we might be close to higher for long enough.
Some big moves in this bond market right now. We're down 17 basis points on a front end on a 2-year at 4.56, on a 10-year down 11 to 4.09%. Alongside Dan Swank, I'm pleased to say, Greg Peters of PGIM jumps in front of the camera. Greg, let's talk about it. In about 24 minutes' time, Chairman Powell has an opportunity to clarify some of this. Do you think he needs to?
Well, I'm not sure there's much he can do at this point. I mean, the market just absolutely loved this result. I thought the market was already leaning a little too much. Evidently, that wasn't the case. We weren't leaning enough. So, doves fly and bulls run after this. And I think it's really hard for Powell to put that genie back in the bottle.
Does that give you a sense, doves flying and bulls running, the idea of FOMO and just how much that's taken over the market after so many people missed out in 5% 10-year yields?
I think that's just an artifact of the current market, right? I mean, the markets are much more volatile. They move much more powerfully. I think that's just the construct, right, with CTAs and algos and other sorts of things. And I think this is the world that we live in, honestly. So I don't think this is a unique feature anymore. I think this is quite commonplace.
Diane Swank, I did the nominal GDP math here on the inflation guesstimate and the growth guesstimate, and boy, it sure looks to me like a 4% nominal GDP, even south of that, modeled out over the next 24 months. How do our viewers and listeners react to that if our animal spirit post-pandemic diminishes down sub 4%?
We know what's interesting about it is that also the part that we didn't talk about in the SEPs is that the Fed's long-term estimates of what the neutral rate on the Fed funds rate, if you look at their ranges, that has actually continued to move up. And so I think what you're seeing here is that an economy that the Fed expects to cool below potential, unemployment to come up a little bit, although we might not, the consumer's really taken everything the Fed's tried to deal them and, taken it with stride and kept on going. And I think that may mean some upside risk to the economic growth side of this situation. But it's really interesting that the Fed's terminal rates now look like they're starting to move up even more than they were last time. And that seems to have gotten lost in translation. That's not what the market's focused on right now, but I think the Fed is looking at an economy that's more resilient and that will take off more rapidly as rates come down.
Does that cohere with what you think, that basically we're talking about a higher neutral rate as we have no landing or a very, very soft one?
Exactly. I think we are at a higher non-inflationary rate, and I think that's something you see it just in the slowness with which the Fed puts out its cuts and not getting back. The descent on rates is not as rapid as the ascent on rates, and the need, you see it in their long-term forecast. Even as all this good news has come in, and it's really shifted the narrative in terms of, we were trying so hard to get up to an inflation target for so long. The Fed does still believe that we're in a world, and it sort of was illustrated by the volatility in the bond market we were just talking about, that we're in a world that's more susceptible to external shocks than it once was. We've also gotten incredibly good news on oil prices coming down, helping to spill over into inflation. All of that's great. It doesn't mean that we're going into the world of subpar growth, of inability to get inflation up that we left in the 2010s. We have healed balance sheets, except for the federal government, quite significantly since then. And I think that's where the paradigm shift is.
Diane, let's go through the projections together. The median for 2024, GDP 1.4%, unemployment 4.1%. Core PCE, 2.4, Fed funds, 4.6. Dan, not so long ago, you and I used to talk about this being aspirational. How realistic is it now?
It now seems entirely possible, and you know what? More things than I can list have surprised me about this economy, and this is not where we thought we'd be, but how glorious it is that we're here. It's not been easy. It's not as if interest rate sectors aren't feeling pain. They are. The housing market is still stuck in a mortgage winter, even though rates are coming down. This will help unlock some demand, but prices are still too high, and the supply of homes is still too much in a shortage, especially in the single-family home market. So we know there's still strains in this economy, but the good news is we didn't have to get here without the kind of pain that, I think back on that speech, 8 minutes, 34 seconds, August 2022. It was like a bucket of ice, when the Chairman Powell really believed we would have to go through a recession in order to rid ourselves of this inflation. And that's just not been the case. Much more of it was supply chains uncurling and the problems that we had there, along with some time to let the production pick up with demand. And I think that's important.
Otherwise known as transitory, just not called transitory. Greg, can you buy into this? This sense that we're
transitory over a much longer period of time.
Greg Peters, can you weigh in a little bit on whether you think this is plausible, or whether you would lean against this right now, or whether you would actually even sell and wait for a better buying moment?
I mean, I do think the markets are really pushing the limits here. There's so much good news being priced in, whether it's inflation, whether it's growth. The yield curve is still inverted, right? And so, how do you reconcile the fact that investors are feeling really good about the growth outlook, inflation's coming down, and the curve's inverted? And so I think there's still some repricing ahead. I think there's still quite bumpy elements in the road ahead, and so I'm kind of thinking the market is really taking this to the brink here, and I would be inclined to go the other way.
Greg, I'm looking at money market funds 5% and all the other stuff we blather about each and every day. And I know we get convexity in the stock market. Do we get convexity in the bond market when I got a 10-year real yield pop into 1.91? I got the 10-year yield on minus 2 standard deviations right down on 4.06%. Can there be such a thing as momentum in the bond market, price up, yield down?
Yeah, I think you're seeing it, Tom. I mean, if you look at the total return in the bond market over the past month or so, it's been, quite astounding, right? Anywhere from 5 to, 8%. That's real money, right? And so you've seen it. And so there has been some quote unquote positive convexity just given the low level of prices, right? But the real question is not what happened, but where are we going? And so, once again, I worry about, the current market really squeezing a lot of the total return out of the market way too soon.
Well, look at the move this afternoon. It's a monster move. We're down almost 20 basis points at the front end of the curve. Allow me to share a quote with you. It would be premature to conclude with confidence that we have achieved a sufficiently restrictive stance or to speculate on when policy might ease. Chairman Powell, not even 2 weeks ago, on December 1st, Diane Swong, in 15, 16, 17 minutes' time when we hear from the chairman again, why would the message be any different?
Well, I think he's still going to be cautious in his messaging, but you saw a little bit of the lightness in his step when we saw the bond market rally November 1st, even though we had what was a hawkish set of, in September, a hawkish outlook. By November 1st, you saw the market unwind significantly since then because of how euphoric and a little bit excited that Chair Powell was in that press conference. And so I think it's going to be hard for him to walk back a lot at this point in time. I think it would do him good to be cautious and to be a little bit, contingent on, we're excited, but here's the risks. But I think it's going to be hard given they signed off on this statement and they signed off on this forecast, and this is it's about as dovish as we could have expected. This is more than I expected in terms of dovishness, and I think it's hard for him to walk it back, and I don't think he would be walking it back all that much given the fact that they all signed off on it.
Which is the reason why you're seeing
he's not going to add to it, but he's not going to push back too much.
Which is the reason why, and it's a good point, that you're seeing an 18 basis point drop in the 2-year yield as time goes on, 4.54%. Greg, you said you'd push back against this. The market's really taking this to the brink. What makes you feel that way? And what could you hear from Chair Powell that could change your mind?
Well, so I'm not sure I'm going to hear much from Chair Powell. As I mentioned, I think the genie's out of the bottle. I think it's hard to walk this back. I think at some level he is quite pleased, and rightfully so, right? They've seen a tremendous amount of disinflation come through during the course of this year, and that's something to be proud of. But I guess just from a market pricing fixed income perspective, do we really want to be in an environment where we're taking down yields so aggressively, where we're basically have to see these rate cuts come through and then some in order to achieve total return? So, to me, it's just a balance about risk reward and what's embedded in the price. And I think, quite frankly, there's a lot of good news embedded in the price. And that's always something that you should, take a step back.
A ton of good news priced in over the last month. Greg Peters, Diane Swong, two of the very best going into this Federal Reserve news conference with Chairman Powell in about 14 minutes' time. Thanks to both of you. Let's talk about these moves. No big changes to that statement. No change in the decision, but some monster changes to the projections. Take 2024, for instance. Fed funds, median dot, now 4.6%. Back in September, that was 5.1. This is a Fed, it's a median dot, implying that maybe 3 cuts are in our future from this Federal Reserve. The market may be 50 basis points lower than that, but ultimately, Lisa, we've closed the gap and we've endorsed the direction of travel over the last 6 weeks, which is why you've got this monster move again on a 2-year by 19 basis points of 453. So if you don't stop the direction, if you don't stop the momentum, what happens? You do more of the same, don't you, Lisa? Isn't that what's happening?
Which is what Priya Misra said, that this was the asymmetry. And this is what Greg Peters, as well as Diane Swong, both said, which is it was more than they expected and certainly more than the market expected, and the market is cheering. Basically, this message is that Chair Powell cannot walk this back. The rest of the Fed members put this in, so he either leans in, he either gives an explanation of weakening in the economy that isn't seen in the projections, or he kind of equivocates and basically is, circling around with his tail.
Neil Dutta, Renaissance Macro, super modest. Do you want the quote? Complete vindication of a March cut. 95 is a good analog. Surgical cuts are coming. Buckle up. Risk appetite has room to run. Wow, did he nail it? He nailed it for sure. Check out the scores going into the news conference on the S&P 500, fourth day of gains on the cards. Unless Chairman Powell messes that up for you. On the S&P 500, up by 0.6% on the S&P into the bond market. I know we've seen some big moves in fixed income, but these are big moves again. We're down 20 basis points on a 2-year, 453.53. We'd seen big moves coming into today's decision. We're down large again. We're down 12 on a 10-year at 4.08%. Let's continue the conversation with Bank of America's Michael Gapin, Subhadra Japa of SocGen. Subhadra, first to you. You've had some time to chew over this one. What's your take on it?
Yeah, definitely the dovishness in the dots caught me by surprise. But I think it seems like they're looking at inflation starting to come down. Maybe they're looking at 3-month and 6-month moving averages and doing exactly what they did a couple of years back when they were looking at 3-month and 6-month moving averages, which were running a lot harder than the market, and so they had to come in and start hiking. So I think you're looking at a very similar scenario here, where they're willing, it seems, to adjust policy given the data that we have right now on inflation.
Michael Gapin, thrilled to have you with us, particularly with the reach of the Bank of America across all of America, the consumer, the pulse of our 70% consumption. Do you buy this idea of the massive potential GDP slowdown of the next 2 years, sub 2% real GDP, inflation that's quiescent, nominal GDP that's 4% if we're lucky? Is that the evidence that the Bank of America sees?
On balance, yes. Our B of A card data has been showing resiliency in consumer spending and pretty good holiday spend. So our view is the slowdown, if we get one, is going to come in your non-consumer related components, business spending, the fiscal drag, and so forth. We think it's possible. We think the narrative around the idea that you don't need as much labor market pain to bring inflation down, the data is kind of confirming that, and it matches with what we're seeing from our card data and around the health of the consumer. So yes, the economic activity should moderate, even personal consumption spending should slow. But we've gotten a lot of evidence here now over the past few months that maybe we don't need to crimp demand as much to return inflation to 2%, and we can allow some of these supply side factors, whether it's supply chain or the rebound in the labor force, to help us out.
Michael, could this rip-roaring rally go against that? Could it make it more difficult to achieve the actual end of the soft landing by rejuvenating certain demand and rejuvenating animal spirits?
Possibly, but I think, the Fed kind of modulates demand, right? That they don't really control the supply side as much. And so I think what the balance here is to say, okay, maybe demand picks up a little bit, but that's probably more about the timing of the cuts and the pace of the cuts and that end terminal rate rather than the direction of travel. So yes, there's a risk that things would ease too quickly. The Fed prejudges this and they have to come back later and backtrack. That's going to be around the wait and see and how much confidence that they have in order to start a cutting cycle. But I think that's more about the timing and the pace of cuts than it is about having to backtrack.
Subhadra, you and many other people were expecting hawkish pushback. That was actually the consensus belief coming into this meeting. Does anything about this statement make you rethink how you would respond to this? That basically, load the boat, FOMO is on, let's go.
Yeah, no, definitely. I mean, I think the FOMO trade's already happened, right? We've had 10 yields decline from 5% all the way down to now close to 4% in a very short amount of time. I think I would have to agree with the statement you read from Neil Dutta earlier, which is maybe the market is looking towards a much more of an adjustment in policy as we go along, modus operandi from the Fed. I mean, that's not our view. We still think that the Fed is going to keep policy on hold at least till May, till they see a very clear signal that inflation is trending towards their 2% target. And we think that the economy, broadly speaking, should hold up until that point. because it's, I mean, once we get to that point, I think the Fed can very quickly cut rates in a very short amount of time if there is a meaningful slowdown. The risk is that if they deliver these cuts too soon, then you could see perhaps a resurgence of this sort of services side inflation that we've been experiencing over the last couple of years.
John, I'm going to predict that everybody's going to go in and they're going to blow up their call. They're going to blow up their year-end outlook. I hear all this good talk. I think Michael Gapin is absolutely dead on.
You think it gets more bullish than it already is?
It's not that it's bullish. This is really, really important. This goes back to Diane Swank, Gina Martin Adams, and others. This, to me, is far more a real economy analysis, redounding back to these dynamics. In the last 2 minutes, John, I got a 407 retest of the 10-year yield down 13 beeps. If that puppy breaks through 4.06, that is a massive signal that everybody has to rip up the script this afternoon.
We joked earlier this morning that if the party started at the end of October, Governor Waller bought the tequila in the last couple of weeks. Yeah. It's not him I don't think we need to talk about. I think we need to be talking about New York Fed President John Williams. Mike, I remember when President Williams, a number of months ago, engaged a conversation about reducing interest rates as inflation continued to fall, just to keep real rates stable and to ensure that things didn't become tighter over time. Is it too early, too premature for Chairman Powell to engage in that type of conversation in this news conference?
I don't. I mean, maybe I'm a bit of a contrarian here because we thought the median dot would come in at 4.6. We expected a shift in communication. So what I'm hearing today so far is in line with what I thought. So I do think it would be a proper first step to get out of a hawkish bias and a hiking bias, and then start getting into a world of, talking at least about a more balanced reaction function, not ruling out hikes, but also talking about conditions under which you might ease. You have to start moving in that direction. Inflation, at least at the moment, is decelerating fast enough where it's not crazy to think you could cut in March if you're a committee member based on inflation alone. So there's not a lot of time to prepare between now and then. So it's something I think you do need to entertain.
Subhadra, I'm curious your view on something we were hearing from Diane Swank, that this sort of soft landing implies actually a higher long-term neutral rate, that essentially there is more strength in this economy that can handle rates at a higher level. Are you seeing that within some of these projections and kind of adjusting your expectation just for that base of where the Fed's going to ultimately cut to?
Yeah, that's, I completely agree with that. I mean, our view is that the Fed will cut rates by 150 basis points next year, and there will be more cuts in 2025 with the Fed funds rate getting a little bit north of 3%. So that's, pretty much getting down to where they have their long-run neutral rate of 2.5%. So that sort of trajectory makes sense. The question really is, what does the curve do under those circumstances? Right. And that's really where I feel like there's the story of the rebuild in term premium is still very much in play, because the demand dynamics are still very skewed. We still have a decent amount of supply, and I think that could lead to a meaningful steepening of the curve while the cutting happens.
Subhadra, to the heritage of derivatives at SocGen, where I have no idea where this happens, but if we have what is it, Lisa? The money market fund now, 5 point what?
Well, 5.33 is 5%, right?
At what point, Subhadra, if we bring the money market fund down, does a wall of money try to find a new warm place?
Yeah, that's the risk, right? We have almost $6 trillion in money market funds. That money, if the returns are not attractive, are going to try to migrate towards other parts of the yield curve, or perhaps
give me a level. I mean, Subhadra, this is so important. Is this going to happen at 4.8%? Do we got to wait for 3.8%? When is the money market game over?
Well, when the curve disinverts, perhaps. At the current time, 2-year yields are still higher than where 10-year yields are. And so you're going to see money continue to flow into the very front end of the yield curve. At some point, I think that when the market, when cuts have been, sufficient cuts have been delivered and it's been stimulative, I think that you're going to see that money migrate towards risky assets or other higher yielding assets. But at the current time, with the curve inverted, I think that the front end still looks quite attractive to us on a duration adjusted basis.
Let's play questions for Chairman Powell. The news conference about 3 minutes away. Michael Gapin, what would you ask today?
I mean, I would ask kind of one question would be what you're referencing, essentially, what's the purpose of the cutting cycle? To get policy easy, to track a real rate of interest that you think is appropriate? If so, what's that rate? The second I would ask him, is policy really restrictive? What evidence outside of housing do you have to suggest that policy is currently restrictive? So that'd be a bit of a counterfactual to his view. And otherwise, the third question I'd ask is, is it feasible, just to make it clear, is it feasible to cut on the inflation data alone, or do you need to see weakness in activity in the labor market? Those are three I would pose.
You don't get three, Mike. You're lucky if you get two. If you're Mike McKee, you're lucky if you get one. Subhadra, give us the final word. What would you ask today?
I'd be curious to see if the Fed would be inclined to deliver sort of, adjustments in policy like they did back in the 90s, because that's something that the market is looking towards, is perhaps they adjust, they stay on hold, and then they cut some more if needed. So it's not sort of your conventional cycle. I think, to me, that's a very underpriced risk in the market, is a 90s-style rate cut cycle.
Subhadra Japa, Michael Gapin, to the two of you, thank you. Just brilliant, as always. Michael Gapin over at Bank of America, back in a seat and good to see. Absolutely nailed it. Looking for 3 cuts to go into that median dot in 2024. And Lisa, I think he's right to talk about not just dates, but thresholds. What is the bar? Where is the bar for when you start to deliver those cuts? What are you looking for? And now you've priced that, implied that in your projections. Haven't they got to engage in that conversation over the next hour?
Yeah, is lower inflation enough, right? Just by de facto, or do they have to see some other sort of weakness? And what are the parameters? What are the levels? These are important questions. I also just think that right now, what's he going to say other than just read it? And we've got some sort of new sense that we are disinflating, and it's a positive thing, and we'll be vigilant and watch it and go with where we think it's appropriate.
As I heard from our guests, they did not expect this. I did not expect this. This is a sea change shift back to the regime pre-pandemic, and John, you nailed it, bringing up John Williams and the idea months ago of a shocking reset to the R-star before the pandemic. And today is a massive shift, a sea change moment in terms of getting beyond the pandemic.
I went over this quote a little bit earlier this morning. And as we take the pictures and wait to see Chairman Powell enter that room in Washington, D.C., I want to reflect on the quote of Chairman Powell's not even 2 weeks ago. It would be premature to conclude with confidence that we have achieved a sufficiently restrictive stance or to speculate on when policy might ease. Lisa, you wonder what changed in the last 2 weeks?
Omar Sharif of Inflation Insights actually put out that quote just moments ago, and it says, it turns out it wasn't premature at all. And so if that's the case, what has shifted? Was it the CPI and the PPI data? Can he say there just has been enough cumulative data to suggest that this is a trend and not necessarily a one-off?
I'm watching for Chairman Powell here on Bloomberg Radio, and I would say, Lisa, that what's so important here is the massive street short cover of many different asset classes of people that got this wrong. We have, as we speak, in this press conference, many 2 standard deviation moves. That's not expected.
You think we're still covering those shorts after the move we've seen over the last month?
This is a reshort, precisely right. John, somebody's stepping up.
The chairman of the Federal Reserve. Let's take a listen.
Good afternoon. My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. As we approach the end of the year, it's natural to look back on the progress that has been made toward our dual mandate objectives. Inflation has eased from its highs, and this has come without a significant increase in unemployment. That's very good news. But inflation is still too high. Ongoing progress in bringing it down is not assured, and the path forward is uncertain. As we look ahead to next year, I want to assure the American people that we're fully committed to returning inflation to our 2% goal. Restoring price stability is essential to achieve a sustained period of strong labor market conditions that benefit all. Since early last year, the FOMC has significantly tightened the stance of monetary policy. We've raised our policy interest rate by 5.25 percentage points and have continued to reduce our securities holdings at a brisk pace. Our actions have moved our policy rate well into restrictive territory, meaning that tight policy is putting downward pressure on economic activity and inflation, and the full effects of our tightening likely have not yet been felt. Today, we decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Given how far we have come, along with the uncertainties and risks that we face, the committee is proceeding carefully. We will make decisions about the extent of any additional policy firming and how long policy will remain restrictive based on the totality of the incoming data, the evolving outlook, and the balance of risks. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that growth of economic activity has slowed substantially from the outsized pace seen in the third quarter. Even so, GDP is on track to expand around 2.5% for the year as a whole, bolstered by strong consumer demand as well as improving supply conditions. After picking up somewhat over the summer, activity in the housing sector has flattened out and remains well below the levels of a year ago, largely reflecting higher mortgage rates. Higher interest rates also appear to be weighing on business fixed investment. In our summary of economic projections, committee participants revised up their assessments of GDP growth this year, but expect growth to cool, with the median projection falling to 1.4% next year. The labor market remains tight, but supply and demand conditions continue to come into better balance. Over the past 3 months, payroll job gains averaged 204,000 jobs per month, a strong pace that is nevertheless below that seen earlier in the year. The unemployment rate remains low at 3.7%. Strong job creation has been accompanied by an increase in the supply of workers. The labor force participation rate has moved up since last year, particularly for individuals aged 25 to 54 years, and immigration has returned to pre-pandemic levels. Nominal wage growth appears to be easing, and job vacancies have declined. Although the jobs to workers gap has narrowed, labor demand still exceeds the supply of available workers. FOMC participants expect the rebalancing in the labor market to continue, easing upward pressures on inflation. The median unemployment rate projection in the SEP rises somewhat from 3.8% at the end of this year to 4.1% at the end of next year. Inflation has eased over the past year, but remains above our longer-run goal of 2%. Based on the Consumer Price Index and other data, we estimate that total PCE prices rose 2.6% over the 12 months ending in November, and that, excluding the volatile food and energy categories, core PCE prices rose 3.1%. The lower inflation readings over the past several months are welcome, but we will need to see further evidence to build confidence that inflation is moving down sustainably toward our goal. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. As is evident from the SEP, we anticipate that the process of getting inflation all the way to 2% will take some time. The median projection in the SEP is 2.8% this year, falls to 2.4% next year, and reaches 2% in 2026. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We're highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. As I noted earlier, since early last year, we have raised our policy rate by 5.25 percentage points, and we have decreased our securities holdings by more than $1 trillion. Our restrictive stance of monetary policy is putting downward pressure on economic activity and inflation. The committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25 to 5.5%, and to continue the process of significantly reducing our securities holdings. While we believe that our policy rate is likely at or near its peak for this tightening cycle, the economy has surprised forecasters in many ways since the pandemic, and ongoing progress toward our 2% inflation objective is not assured. We are prepared to tighten policy further if appropriate. We're committed to achieving a stance of monetary policy that is sufficiently restrictive to bring inflation sustainably down to 2% over time, and to keeping policy restrictive until we're confident that inflation is on a path to that objective. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. While participants do not view it as likely to be appropriate to raise interest rates further, neither do they want to take the possibility off the table. If the economy evolves as projected, the median participant projects that the appropriate level of the federal funds rate will be 4.6% at the end of 2024, 3.6% at the end of 2025, and 2.9% at the end of 2026, still above the median longer-term rate. These projections are not a committee decision or plan. If the economy does not evolve as projected, the path of policy will adjust as appropriate to foster our maximum employment and price stability goals. In light of the uncertainties and risks and how far we have come, the committee is proceeding carefully. We will continue to make our decisions meeting by meeting based on the totality of the incoming data and their implications for the outlook for economic activity and inflation, as well as the balance of risks. In determining the extent of any additional policy firming that may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Thank you. Chris Rugaber at Associated Press. I wanted to ask, how should we interpret the addition of the word any before additional firming in the statement? I mean, does that mean that you're pretty much done with rate hikes and the committee has shifted away from a tightening bias and toward a more neutral stance? Thank you.
So, specifically on any, we do say that in determining the extent of any additional policy firming that may be appropriate, so any additional policy firming, that sentence. So we added the word any as an acknowledgement that we believe that we are likely at or near the peak rate for this cycle. Participants didn't write down additional hikes that we believe are likely, so that's what we wrote down. But participants also didn't want to take the possibility of further hikes off the table. So that's really what we were thinking.
Mr. Chairman, the microphone, sorry. Steve Leisman, CNBC. Happy holidays, Mr. Chairman. Fed Governor Chris Waller said that if inflation continues to fall, then the Fed in the next several months could be cutting interest rates. I wonder if you could comment on whether you agree with Fed Governor Waller on that the Fed would become more restrictive if it didn't cut rates if inflation fell. Thank you, sir.
So, of course, I don't comment on any other officials, even those who work at the Fed. But I'll try to answer your question more broadly. So the way we're looking at it is really this. When we started out, right, we said the first question is how fast to move, and we moved very fast. The second question is, really how high to raise the policy rate, and that's really the question that we're still on here. We're very focused on that. As I mentioned, people generally think that we're at or near that, and think it's not likely that we will hike, although they don't take that possibility off the table. So that's when you get to that question, and that's your answer. there's a naturally it begins to be the next question, which is when it will become appropriate to begin dialing back the amount of policy restraint that's in place. So that's really the next question, and that's what people are thinking about and talking about. And I would just say this. We are seeing, strong growth that appears to be moderating. We're seeing a labor market that is coming back into balance by so many measures, and we're seeing inflation making real progress. These are the things we've been wanting to see. We can't know. We still have a ways to go. No one is declaring victory. That would be premature, and we can't be guaranteed of this progress. So we're moving carefully in making that assessment of whether we need to do more or not. That's really the question that we're on. But of course, the other question, the question of when will it become appropriate to begin dialing back the amount of policy restraint in place, that begins to come into view and is clearly a topic of discussion out in the world, and also a discussion for us at our meeting today.
Can you give some color as to the nature of that discussion today? Thank you.
Sure. So it comes up in this way today. Everybody wrote down an SEP forecast, so many people mentioned what their rate forecast was, and there was no back and forth, no attempt to sort of reach agreement, like this is what I wrote down, this is what I think, that kind of thing, and a preliminary kind of a discussion like that. Not everybody did that, but many people did. And I would say there's a general expectation that this will be a topic for us looking ahead. That's really what happened in today's meeting. I can't do the head count for you in real time, but that's generally what happened today.
Go to Rachel.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. At this point, can you confidently say that the economy has avoided a recession and isn't heading for one now? And if the answer is no, I'm curious about what you'd still be looking for. Thanks.
I think you can say that there's little basis for thinking that the economy is in a recession now. I would say that. I think there's always a probability that there will be a recession in the next year, and it's a meaningful probability no matter what the economy is doing. So it's always a real possibility. The question is it? So it's a possibility here. I have always felt since the beginning that there was a possibility because of the unusual situation that the economy could cool off in a way that enabled inflation to come down without the kind of large job losses that have often been associated with high inflation and tightening cycles. So far, that's what we're seeing. That's what many forecasters on and off the committee are seeing. This result is not guaranteed. It is far too early to declare victory. And there are certainly risks. It's certainly possible that the economy will behave in an unexpected way. It has done that repeatedly through in the post-pandemic period. Nonetheless, where we are is we see the things that I mentioned.
I'm curious if you're looking back on the past year, you talked about navigating by the stars under cloudy skies. Can you talk about some of the ways in which the economy surprised you most this year, where you thought it would behave in one way and had to pivot to respond? Thanks.
So I think forecasters generally, if you go back a year, were very broadly forecasting a recession for this year, for 2023. And not only did that not happen, that includes Fed forecasters and really essentially all forecasters. A very high proportion of forecasters were expecting very weak growth or a recession. Not only did that not happen, we actually had a very strong year. And that was a combination of strong demand, but also real gains on the supply side. So this was the year when labor force participation picked up, where immigration picked up, where the distortions to supply and demand from the pandemic, the shortages and the bottlenecks really began to unwind. So we had significant supply side gains with strong demand, and we got what looks like a 2.5% plus or a little more than that growth year at a time when potential growth this year might even have been higher than that just because of the healing on the supply side. So that was a surprise to just about everybody. I think the inflation forecast is roughly what people wrote down a year ago, but in a very different setting. And I would say the labor market, because of the stronger growth, has also been significantly better. If you look back at the SEP from a year ago, there was a significant increase in unemployment. that didn't really happen. We're still at 3.7%. So we've seen strong growth, still a tight labor market, but one that's coming back into balance with support from the supply side, a greater supply of labor. It's that's what we see, and that I think that combination was not anticipated broadly.
Thanks, Howard Schneider with Reuters, and thanks for taking the questions. I wonder if you could give a little more color or detail on what motivates the lower rates next year, whether it's a coincidence, for example, that the spread between PCE inflation, core inflation, and the federal funds rate stays constant over the year. Are you simply calibrating against the fall in prices, in the price level that you're expecting, in the rate of inflation that you're expecting, as opposed to supporting the economy?
Nothing quite that mechanical is happening. The SEP really is a bottoms up, built from the bottom up, right? So I think people are looking at what's happening in the economy, and I think if you look at the big difference from September in the SEP, the expectations for inflation this year, both headline and core, have come down, really significantly in 3 months. That's a big piece of this. At the same time, growth turned out to be very strong in the third quarter, is slowing, we believe, as appropriate. And we've had several labor market reports which suggest, again, significant progress toward greater balance across a broad range of indicators. You're seeing so many of the indicators coming back to normal, not all of them. But so I think that people look at that and they write down basically each individual writes down a forecast and a rate forecast that goes with that forecast. We tabulate them and publish it. And so it isn't, you ask about real rates, I take it, that is something that we're very conscious of and aware of and monitor, and it's certainly a big part of, it's a part of how we think about things, but really it's broader financial conditions that matter, and as you well know, it's so hard to know exactly what the real rate is or exactly how tight policy is at any given time. So you couldn't follow that like it was a rule and think that you would get the right answer all the time, but it's certainly something that we're focused on. And indeed, if you look at the projections, I think the expectation would be that the real rate is declining as we move forward.
It sounds like the discussion over that, if I could follow up, has already kind of begun. I'm wondering, just related to Steve's question, how the tactics of this play out, given the slowing of inflation and the fact that the deeper you get into 2024, the closer you get to a presidential election. Do you want to front load this, in other words?
Yeah, no, we don't think about political events. We don't think about politics. We think about what's the right thing to do for the economy. The minute we start thinking about those things, we just can't do that. We have to think, what's the right thing? We'll do the things that we think are right for the economy at the time when we think is the right time. That's what we'll always do. So I mentioned we're moving carefully. One of the things we're moving carefully about is that decision over that assessment, really, over whether we've done enough, really. And you see that people are not writing down rate hikes. That's us thinking that we have done enough, but not feeling that really strongly, confidently, and not wanting to take the possibility of a rate hike off the table. Nonetheless, it's not the base case anymore, obviously, as it was, 60, 90 days ago. So that's how we're approaching things. And as I mentioned, we wrote down this SEP, and it talks about people have individual assessments of when it will be appropriate to start to dial back on the tight policy we have in place. And that's a discussion we'll be having going forward, but that's another assessment that we're going to make very carefully so as time goes forward.
Nick Timmeros of the Wall Street Journal. Chair Powell, you've argued over the last year that policy tightening started before you actually lifted off because the market anticipated your moves and tightened on your behalf. The market is now easing policy on your behalf by anticipating a funds rate by next September that's a full point below the current level, with cuts beginning around March. Is this something that you are broadly comfortable with?
So this last year has been remarkable for the sort of seesaw thing back and forth we've had over the course of the year, of markets moving away and moving back and that kind of thing. So, and what I would just say is that we we focus on what we have to do and how we need to use our tools to achieve our goals. And that's what we really focus on. And people are going to have different forecasts about the economy. And those are going to show up in market conditions, or they won't, but in any case, we have to do what we think is right. And, in the long run, it's important that financial conditions become aligned or are aligned with what we're trying to accomplish. And in the long run, they will be, of course, because we will do what it takes to get to our goals. And ultimately, that will mean that financial conditions will come along. But in the meantime, there can be back and forth, and I'm just focused on what's the right thing for us to do, and my colleagues are focused on that too.
The markets seem to think inflation is coming down credibly. Do you believe we're at the point where inflation is coming down credibly?
Listen, I welcome the progress. I think it's really good to see the progress that we're making. I think if you look at the 12-month measure, look at the 6-month measures, you see very low numbers. If you look at 12-month measures, you're still well above 2%. You're actually above 3% on core through November at PCE. That isn't to say I'm not calling into question the progress. It's great. We just need to see more. We need to see continued further progress toward getting back to 2%. That's what we need to see. So. It's our job to restore price stability, and it's one of our two jobs along with maximum employment, and they're equal. So we're very focused on doing that. As I mentioned, we're moving carefully at this point. We're pleased with the progress, but we see the need for further progress. And I think it's fair to say. There is a lot of uncertainty about going forward. We've seen the economy move in surprising directions, so we're just going to need to see more further progress.
Gina Smilik, New York Times. Thanks for taking our questions. In the SEP from today, growth is notably below potential in 2024. If growth were to surprise us again in the way that it has for years now by being stronger than expected next year, would it still be possible to cut rates? Or put another way, is below trend growth necessary to cut rates, or would continued progress on inflation alone be sufficient?
So we'll look at the totality of the data. Growth is one thing. So is inflation, so is labor market data. So we look at the total as we make decisions about policy changes going forward. We're going to look at all those things, and particularly about as they affect the outlook. It's ultimately all about the outlook and the balance of risks as well. So that's what we'd be looking for. If we have stronger growth, that'll be good for people. That'll be good for the labor market. It might actually mean that it takes a little longer to get inflation down to 2%. We will get it down to 2%. But if we see stronger growth, we will set policy according to what we actually see, and so that's how I would answer.
I guess the question I'm asking, if you don't mind a quick follow-up, I guess the question I'm asking is above trend growth itself a problem?
It's only a problem it's not itself a problem. It's only a problem insofar as it makes it more difficult for us to achieve our goals. And if you have growth that's robust, what that will mean is probably will keep the labor market very strong. It probably will place some upward pressure on inflation. That could mean that it takes longer to get to 2% inflation. That could mean we need to keep rates higher for longer. It could even mean ultimately that we would need to hike again. It just is. It's the way our policy works.
Hi, Chair Powell. Neil Irwin with Axios. How do you interpret the state of the labor market right now? And in particular, you've referred even today to evidence that it's coming into better balance. What would you need to see to conclude that it has reached that balance?
So on the better balance side, there's just a lot of things. It's you see job growth still strong, but moving back down to more sustainable levels given population growth and labor force participation. The things that are not quite, but let me go on with that list. Claims are low. If you look at surveys of businesses, they're sort of the era of this frantic labor shortage are behind us, and they're seeing a shortage of labor as being significantly alleviated. If you look at shortages of workers, whereas they thought job availability was the highest it had ever been or close to it. That's now down to more normal levels by so many measures: participation, unemployment, so many measures, the unemployment, job openings, quits, all of those things. So wages are still running a bit above what would be consistent with 2% inflation over a long period of time. They've been gradually cooling off, but if wages are running around 4%, that's still a bit above, I would say. And I guess there are just a couple of other, the unemployment rate is very, very low. And these are, but I would just say overall, the development of the labor market has been very positive. It's been a good time for workers to find jobs and get solid wage increases.
Claire.
Claire Jones, Financial Times. I'd say the mood among economists at the moment seems to be one of cautious optimism, which is somewhat corroborated by your forecast, by this sense that we are going to have a soft landing. Yeah, when we hear from the general public, there's a lot of discord about economic conditions. What do you think explains this disconnect, and does it matter for policymakers?
It may be. A common theme is that while inflation is coming down, and that's very good news, the price level is not coming down. Prices of some goods and services are coming down, but overall, in the aggregate, the price level is not good. So people are still living with high prices, and that is something that people don't like. And what will happen with that is wages are now, real wages are now positive, so that wages are now moving up more than inflation as inflation comes down. And so that might help improve the mood of people. But we see those public opinion surveys. The thing that we can do is to do our jobs, which is to use our tools to foster price stability, which has such great benefits over such long periods of time, and which is the thing that really enables us to work for and achieve an extended period of high employment, which is so beneficial for families and companies around the country.
Victoria.
Hi, Victoria Guido with Politico. I wanted to ask, on the flip side of if things start to deteriorate rapidly, if we do fall into a recession, if we do start to see unemployment rise at sort of the levels of inflation that we're seeing now, how would you all think about that in terms of rate cuts? Would that be a sign that you've done your job demand-wise?
Sorry, if
the economy looks like it's starting to fall into recession, if the jobless rate starts to rise?
That's not something we're hoping to see. Obviously, we're hoping to see something very different, which is continuation of what we have seen, which is the labor market coming into better balance without a significant increase in unemployment, inflation coming down without a significant increase in unemployment, and growth moderating without a significant increase in unemployment. That's what we're trying very much to achieve, and not something we're looking to see.
But would you take that as a signal that you should cut rates?
Obviously what we'll do is we'll look at the totality of the data, as I've mentioned a couple of times, and certainly the labor data would be important in that. And if you can describe a situation like that where if there were the beginning of a recession or something like that, then yes, that would certainly weigh heavily in that decision.
Michael McKee from Bloomberg Television and Radio. Mr. Chairman, you were, by your own admission, behind the curve in starting to raise rates to fight inflation. And you said earlier, again, the full effects of our tightening cycle have not yet been felt. How will you decide when to cut rates, and how will you ensure you're not behind the curve there?
So we're aware of the risk that we would hang on too long. We know that that's a risk, and we're very focused on not making that mistake. And we do regard the two, we've come back into a better balance between the risk of overdoing it and the risk of underdoing it. Not only that, we were able to focus hard on the price stability mandate, And we're getting back to the point where, which is what you do when you're very far from one of them, one of the two mandates. You're getting now back to the point where both mandates are important, and they're more in balance too. So I think we'll be very much keeping that in mind as we make policy going forward. And the things we'll be looking at, I've already described. You know, we're obviously looking hard at what's happening with demand. And what we see the same thing other people see, which is a strong economy, which really put up quite a performance in 2023. We see good evidence and good reason to believe that growth will come in lower next year. And you see what the forecasts are. I think the median participant wrote down 1.4% growth, but you know, we'll have to see. It's very hard to predict. We'll also be looking to see progress on inflation and you know, the labor market remaining strong, but ideally without seeing the kind of large increase in unemployment that happens sometimes.
When you begin the cutting cycle, will it be essentially run the same way you do it now with raising rates, where you basically do trial and error, cut and see what happens, or will you tie it to some particular measure of progress?
We haven't typically tried to articulate, with one exception, really specific target levels, which was, some of you will remember the thresholds that we used in, I guess, 2013. The answer is these are things that we haven't, you know, really worked out yet. We're sort of just at the beginning of that discussion.
Thank you, Mr. Chairman. Edward Lawrence with Fox Business. So if the Fed cuts rates, as the dot plot is showing, about 75 basis points, does that signal or that there's a belief of weakness next year in the economy?
It wouldn't, if that were, first of all, let me just say, that isn't a plan. That's just accumulating what people wrote down. So that's not something, you know this, but allow me to say it again. We don't debate or discuss what the right, you know, whose SEP is right. We just say what they are, and we tabulate them and publish them. So it's, you know, it's important for people to know that. But it wouldn't need to be a sign of, it could just be a sign that the economy is normalizing and doesn't need the tight policy. It depends on, the economy can evolve in many different ways, right? So, but it could be more what I just described.
And you focused on core inflation. We've heard from in other meetings. How sticky is core inflation right now?
Well, that's what we're finding out, and we've seen real progress in core inflation. It has been sticky, and famously the service sector is thought to be stickier, but we've actually seen reasonable progress in non-housing services, which was the area where you would expect to see less progress. We are seeing some progress there, though. In fact, all three of the categories of core are now contributing. Goods, housing services, non-housing services, they're all contributing at different levels, you know, meeting by meeting, or rather report by report. So, yeah.
Okay, let's go to Katerina.
Katerina Saraiva, Bloomberg News. Thanks for taking our questions. I just wanted to ask a little bit about, you know, we had some pretty positive data this morning and yesterday. I'm assuming those were not incorporated into the forecasts we see today. But I just wanted to ask, you know, how that kind of adds to your thinking, you know, on the inflation outlook.
Right. So we got CPI the morning of the first day, and we got PPI the next day, which informs the translation into PCE. So it's very, very late in the game, you know. But nonetheless, participants are allowed to, encouraged to update their SEP forecasts until probably mid-morning today. After that, so staff has to accumulate all of that and create the documents that you see. So until about mid-morning, a little maybe late morning, it's okay to update. And I believe some people did update their forecasts based on what we saw today.
Okay, and you see, I mean, how are you, when you think about, you know, starting to think about the rate cuts next year or whenever they come, how do you think about the economy we're in now, kind of post-pandemic? Do you think that there's been significant structural shifts, and is that going to change how you look at a rate cut path?
The question of whether there have been fundamental structural shifts is really hard to know the answer, and a very interesting one right now. The one that would affect one that comes to mind, though, is just the question of where the neutral rate of interest is. And so, for example, if it's risen, and I'm not saying that it has, but if it were to have risen, that would mean that interest rates would need to be a little bit higher to convey the same level of restriction. The thing is, we're not really going to know that. You know, people will be writing papers about that 10 years from now and still fighting about it. So it's just that it's going to be uncertain. So we're going to be making policy in this, you know, difficult, uncertain, really unprecedented environment. Someone once said that you know the natural rate of interest by its works, and that's really right. But that's very difficult because policy operates with a lag. So it's one of the reasons why we slowed down this year. We started slowing down at this meeting last year, reducing the pace at which we were adding restriction. And over the course of this year, we really slowed down a lot to give those lags time to work. In terms of demand, has demand shifted more away from services into goods? You can make a case for that the shift back into services has not been complete, and it doesn't look like it's ongoing, but I don't know if that's right. Maybe people just bought so much stuff that they temporarily don't want any more stuff. They haven't got any place to put it.
Let's go to Jennifer.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You said back in July that you needed to start cutting rates before getting to 2% inflation. As you mentioned, PCE inflation is now running at 3.5% on core. On a 6-month annual basis, core PCE is running at 2.5%. Though when you look at super core and shelter, they are, of course, stickier. So in looking at the different components of the data, how much closer do you have to get to 2% before you consider cutting rates?
I mean, the reason you wouldn't wait to get to 2% to cut rates is that policy would be too late. I mean, you'd want to be reducing restriction on the economy well before 2%, because before you get to 2%, so you don't overshoot. If we think of restrictive policy as weighing on economic activity, you know, it takes a while for policy to get into the economy, affect economic activity, and affect inflation. So I can't give you a precise answer, but if you look at what's in the SEP, and you know, I think you'll see a reasonable estimate of the time lags and things like that it would take.
Do you think below 3% would be reasonable?
I wouldn't want to identify any one precise point, because I would be able to look back then and probably find out that it turned out not to be right. But we'll be looking at it and looking at the broad collection of factors.
Hi, Chair Powell, Jean Young with Market News. Wanted to go back to the stickiness of inflation question. Over the past couple of years, a lot of central bankers have talked about the more difficult last mile of getting inflation back down to 2%. Yet it's also been surprising how fast inflation has come down this year. I'm curious, do you think something has changed in our understanding of inflation? Or do you subscribe to this notion still, or is it something different about the U.S. economy? Thank you.
I think this, you know, we felt since the beginning that it would be a combination of two factors. The first factor is just the unwinding of what happened in the pandemic, the distortions to supply and demand. And the second thing would be our policy, which was weighing on aggregate demand and actually making it easier for the supply side to recover because of lower demand. We thought those two things were going to be necessary. Sorry, say the last part of your question again.
If there's something different about the U.S. economy.
Yeah, so it's not that. It may or may not be about the U.S. economy being different. I think that this inflation was not the classic demand overload, pot boiling over kind of inflation that we think about. It was a combination of very strong demand, without question, and unusual supply side restrictions, both on the goods side but also on the labor side, because we had a participation shock. So this is just very unusual. And, you know, we had the view, my colleagues and I broadly had the view, that we could get a lot of, you know, you had essentially a vertical supply curve, because you ran into the limits of capacity at very low levels because there weren't workers and because people couldn't, the supply chains were all broken. So we had the view that you could come straight down that vertical supply curve to the extent demand reduced, and something like that has happened. It happened so far. The question is, once that part of it runs out, and we think it has a ways to run. We definitely think that the sort of supply chain and shortages side has some ways to run. Does labor force participation have much more to run? It might. Immigration could help, but it may be that at some point you will run out of supply side help, and then it goes down to demand, and it gets harder. That's very possible. But to say with certainty that the last mile is going to be different, I'd be reluctant to suggest that we have any certainty around that. We just don't know. I mean, inflation keeps coming down. The labor market keeps getting back into balance. And it's so far so good, although we kind of assume that it will get harder from here, but so far it hasn't.
Okay, we'll go to Megan for the last question.
Hi, Chair Powell. Thanks for taking our questions. Megan Casella with Barron's. I want to ask about the balance sheet, given the Fed's focus now on proceeding carefully and considering rate cuts. And can you talk us through what the latest thinking is, and has there been any consideration of altering the pace of quantitative tightening at all?
We're not talking about altering the pace of QT right now, just to get that out of the way. So balance sheet seems to be working pretty much as expected. What we've been seeing is, that we're allowing runoff each month. That's adding up. I think we're close to 1.2 trillion now. That's showing up. The reverse repo facility has been coming down quickly, and reserves have been either moving up or as a result or holding steady. At a certain point, there won't be any more to come out of, or there'll be a level where the reverse repo facility levels out, and at that point, reserves will start to come down. We still have, that we intend to reduce our securities holders until we judge that the quantity of reserve balances has reached a level somewhat above that consistent with ample reserves. And we also intend to slow and then stop the decline in size of the balance sheet when reserve balances are somewhat above the level judged to be consistent with ample reserves. We're not at those levels. With reserves close to $3.5 trillion. We don't think we're at those reserves. There isn't a lot of evidence of that. We're watching it carefully, and so far it's working pretty much as expected, we think.
Adjusting that thinking at all by the time you're considering or moving forward with rate cuts? Is that time to rethink, or are you still going to follow that thinking?
So I think they're on independent tracks. So you're asking, though, the question, I guess you're implying the question of can you continue with QT at such time, QT, which is a tightening action, at such time as policy is still tight? And the answer is it depends on the reason. If you're cutting rates because you're going back to normal, that's one thing. If you're cutting them because the economy is really weak, so you can imagine you have to know what the reason is to know whether it would be appropriate to do those two things at the same time. Thanks very much.
Chairman Powell wrapping up 2023 and unleashing a monster rally. From New York City this afternoon, good afternoon, good afternoon. Alongside Tom Keene and Lisa Brabitz, I'm Jonathan Ferro. Here are the scores in the equity market right now. On the S&P 500, up by more than 1%. On the NASDAQ, up by 1.1%. The words of Emily Rowland of John Hancock Investment, it's a pivot party and everybody's invited. Chairman Powell just turned up the music. In the bond market, 2-year, 10-year, 30-year, look a little something like this. We're down 26 basis points on a 2-year to 4.47. On a 10-year, we're down 16 to 4.04%. We all had a big question coming into this news conference. Would Chairman Powell push back against these big moves in this bond market, these big moves in this stock market? He said, we still have a ways to go. Nobody is declaring victory. That would be premature. Then just seconds later, he said this.
A question of when will it become appropriate to begin dialing back the amount of policy restraint in place. That begins to come into view and is clearly a topic of discussion out in the world, and also a discussion for us at our meeting today.
We discussed the timing of rate cuts at today's meeting. Lisa Ramitz, that was not the pushback some people were looking for.
If this was pushback, he might as well have screamed, "We did it," and popped champagne, right? If you're talking about a party, he basically endorsed the view that we have of the market. What I'm looking at right now is the expectation of 140 basis points of rate cuts being priced into Fed funds futures for next year. This is basically an endorsement of that by Fed Chair Powell, who had ample opportunities to push back and did not.
To me, it's beyond this to the real economy. This is truly an historic meeting. I did not expect that. I went back to March of 2020. Let's call it the pandemic meeting, certainly with that impact. But I think you've got to go back 25 years. What was unspoken there is everybody plays the Fed parlor game and this and that and the other. Is this is a resounding vote in the American real economy and in the productivity of the country. That's going to all be in the research over the next 48 hours.
It's seduced by engineering that soft landing.
To me, it's immaculate productivity.
Really
That's my new phrase.
Really leaning into that in a big way.
Yeah, this is, I can't, I got goosebumps right now, folks. I can't emphasize how unique this meeting is. I have no idea how Lagarde and Dudley respond to this. I have no idea what Christine Lagarde does tomorrow.
I like your phrasing, seduced by the idea that they could potentially get a soft landing. And the response to the question about the easing of financial conditions and whether that worked against their goal was not particularly, I don't want to say satisfactory, but didn't really give me a sense of what the answer actually was, right? Because we're looking at a situation where people are just all in, endorsing bonds, endorsing stocks, endorsing the soft landing, and it is very rare. It is a unicorn. And so how much does this start to push things in the opposite direction?
John, I'm going to frame this. I wrote to Mohammed El-Arian, I think it was out on Twitter like 20 minutes before, and I said 2 standard deviations is 4.06%. That's right where we went. I did not expect that. We blew through that and almost hit the Bramo line, which is 3.99XX. We didn't get there. We did not get to the land of Bramo, but we were really quite close.
You have to remember, Tom, at the end of October, when people put together their year-ahead outlooks for the end of 2024, targets like 5,200 was 20% upside from where we were. And now you wonder, TK, is it bullish enough? And that's going to make people really, really uncomfortable as we start to bring forward a ton of gains into year end.
I'll be quick here. We got some two special guests for you right now on radio and television. But John, what I saw there is what I'm going to call non-log convexity, which is a curve to the Russell 2000, which is an acceleration of money in. And I just wonder to year end how traditional money reacts. And if you get what Greg Peters talked about, which is some legit convexity here.
What's the bet? I think the bet right now, Tom, is that growth doesn't get hit hard. This Fed's going to cut based on what we've just been told by Chairman Powell, or rather what we weren't told, and what's implied already in market pricing. But Lisa, what would upset the bet? What would upset the bet right now is you get a real downturn in the economy. That's not part of this story that's been priced in at the moment.
And there's dissonance when the Fed statement is saying that there is a lagging effect, a lagging impact of Fed rate hikes that hasn't yet been played out. If that's the case, where is that in the statement of economic projections?
We have a terrific lineup for you, and we start strong here after this historic press conference with William Dudley. He's a former New York Fed president, a student at California, Berkeley years ago of our monetary history, and of course, Bloomberg Economics senior advisor. As I said, Bill, I got goosebumps. It just seems to be a massive statement that even if we have nominal GDP of 4%, we have immaculate productivity and will somehow get through this. Do we sustain this market reaction, this belief in America, or are we set for some titanic disappointment?
Well, I think that Powell's press conference made clear that he's really pleased by how the economy's performed. The fact that you could get inflation down without the unemployment rate going up, if you had some moderation in wages, he thinks everything is going really, really well. And I think that's true. The question is whether it's going to continue or not. And there are definitely things that can go wrong. One thing that can go wrong is the Fed keeps monetary policy too tight for too long and we have a weaker economy. Another thing that can go wrong is the Fed can ease policy prematurely, or the market itself can ease financial conditions prematurely, which will stimulate the economy and make it so that the Fed can't cut rates as quickly as the market expects. I think the market's getting a little ahead of itself here in the sense of taking the Fed's optimism and translating that into very large reductions in short-term rates in 2024.
Bill, what do you think happened to the Chairman Powell of only 2 weeks ago?
I just think that they're very happy with how the economy's performed. I mean, basically, they've had decent growth, unemployment rate's stable, and inflation's come down a lot. And that's basically, as good as it can get. And that's what's summarized in the summary of economic projections. Now, summary of economic projections shows a very modest increase in the unemployment rate from here and essentially a soft landing kind of forecast. Now, soft landings are really difficult to pull off, and they're particularly difficult to pull off when you've been very late to tighten monetary policy. And what's allowed this to happen is that there were supply disruptions, there was reduction in labor supply. Both those things have reversed, and that's made the Fed's job a lot easier.
Bill, the prospect of getting sticky inflation into next year, getting stuck at 3. It's amazing because 6 months ago, Bill, we were told that the last mile was difficult. It was hard. Then Secretary Yellen starts sounding like the Fed chair again, saying it's not that hard. You hear it from Chairman Powell, didn't get any indication it would be particularly difficult into next year. Do you think that is the prudent approach to what 2024 could look like?
I think he's telling you what he really thinks. I think he's very happy with how things have performed. And he didn't say it would necessarily continue, but he also said that he was hopeful that these trends would continue into 2024. My own view is that the Fed is going to be cutting rates in 2024. We're clearly done in terms of rate hikes. The possibility of another rate hike is really low at this point. The question is really just timing of rate cuts and magnitude, and that's going to basically be driven by the strength of the economy, pressure on resources, and what actually happens to services inflation at this point.
Bill, do you think that Jay Powell did a good job? Do you think that it was right for him to say what he thinks and not push back at all against the market party?
I always think it's good to say what you really think, but I think the problem with doing so is it's basically added fuel to the fire. Powell talks about the long legs of monetary policy, but financial conditions are much, much more accommodative than they were just a few months ago. And if you look at the Fed's own assessment of financial conditions back at the end of October, the impulse from financial conditions to the economy based on the Fed's own model was pretty neutral. So financial conditions now are actually adding impulse towards economic growth going forward.
I look, Bill, at where we are, and it's clearly beyond the pandemic. We've had a number of conversations all across a long surveillance day about how goods are goods, and we've got some deflation and service sector inflation's coming down. Is this economy beyond the pandemic? If you were to talk to Mary Daly in San Francisco, to John Williams at the New York Fed, can we say our economy is beyond the pandemic?
I think mostly in the sense that the conditions today are very similar to where we were in February 2020 when we had a very tight labor market. The difference is wages are a bit higher, inflation's a bit higher, and monetary policy is considerably tighter. But it does feel more like February 2020 than it does between any period after that.
Bill, sit tight. I want to bring in Mike McKee down in Washington, D.C. Michael McKee, you were in that news conference. Were you surprised by the approach from Chairman Powell?
Well, I wasn't surprised by the approach once we'd heard from the Fed and in their statement and what we saw in the dot plot. But it is a rather dramatic change from what he said just 12 days ago about it not being time to talk about rate cuts. Obviously, they did today. They're feeling much better about the overall state of the economy. As one analyst put it today, if good inflation report is Jay Powell's idea of a good time, then his party has turned into a rager because inflation is coming down very quickly. And then the next question becomes, as I asked him, when do you cut? And that's the part they're not ready to get into yet or describe. And so we're probably still in for a few months of the markets watching the data and trying to guess when the Fed is going to respond.
Michael, within all the blur of the data and all the guesstimates forward, did they frame out a subpar GDP, either real or nominal? Did they frame out subpar growth?
Well, basically, that's what Powell said we're going to get because the direction of the economy is slower and the lagged effects of their rate increases have not yet completely been felt. But that the economy will start picking up again and growing to potential. And he also admitted the possibility of a surprise there, that the economy grows faster than expected, is also very real. So I think they're, at this point, working on the models that they have, but admitting that they have been wrong before and we could see faster growth. But the interesting thing was, other than a sort of perfunctory caution, he wasn't suggesting that we are down, that they would go back necessarily to rate increases.
Mike McKee, thank you, sir. Great job today, as always. The reaction pouring in this afternoon, this line from Steve Cheverone over at Federated. Initial take is he wants to cut. He always saw inflation as transitory. Bram, maybe your favorite. It's come down on the supply side. He smells a soft landing and wants to cut to stick the landing. He had no interest in pushing back against market expectations. Right or wrong, it's bullish for now. That's a takeaway from Cheverone this afternoon.
That's exactly where I wanted to go, and I wanted to get Bill Dudley's opinion about whether we did get basically confirmation of transitory. Do you think when we look back, the Fed won't have been wrong when it came to transitory inflation? They just were premature.
I think that most of the inflation pressure we had was transitory, but not all of it. I mean, I think some of the services inflation is due to the tightness of the labor market. I think what's really interesting about Powell's press conference today is he talked also about the risk of being too late to cut. So he actually admitted the possibility that if we stay tight for too long, we could actually have a economy that's too weak relative to what we desire. And that's something new from Chair Powell.
That's a very important point, the ex-postedness of it, if you will, Dr. Dudley. They've got to wait after the fact. So let's take something coarse like the unemployment rate. How many months do they have to wait until they get real confidence that the labor economy is caught up with our immaculate disinflation?
I think they're going to be looking at what happens to the unemployment rate, the tightness of the labor market, and what the consequences of that are for wages. Powell did admit that wage inflation is still a little bit too high to be consistent with 2% inflation. But boy, the Fed is pretty close to where they want to be in their outlook at this point.
Bill, you've been on the committee before. You can look at this from the outside now. It's a tricky game, this one, to get into someone's head, and I think maybe one we shouldn't play, but I think on this occasion we should. 2 weeks ago, I heard from a very different Fed chairman, and I'm trying to work out what happened today, whether that was just a man who was representing his own views and this was a man who was representing the committee's view, or whether, like we've indicated, he's being seduced by this idea of netting a soft landing, and the guy who was trying to act like Volcker was never really Volcker. What is it? What do you make of who Chairman Powell is and what he ultimately thinks about things?
Well, the fact that he's worried about keeping monetary policy too tight for too long tells you that he's not thinking like Paul Volcker. So there is a risk to the Fed cutting rates prematurely. But I think what's coming across is the fact that he's just really, really happy with how things have evolved, and that optimism is showing through, as it has shown through from time to time in past press conferences.
Bill, it's maybe not your remit, but it's certainly the New York Fed's remit. They're going to keep track of flows off of declining interest rates. What is the stability or instability that you observe in $6 trillion of cash, let's say most of it loaded in money market funds? As that yield comes down, is our system going to be able to handle it?
Yeah, I don't think there's going to be any problem. I mean, the Federal Reserve sets the short-term interest rates, and then money market rates trade off that. If money market rates, firm up a little bit, then money will flow back into the money market mutual funds. I'm not worried about that at all at this point.
Bill, just to wrap it all together, do you think that the chance of a hard landing has gone down materially over the past month, or do you think that it's about the same or even has gone up?
Well, I think it's gone down materially over the last 6 months. I mean, over the last month, I don't think things have changed very much. But definitely the prospects of a soft landing are the best they've been in the last year or two.
Something changed in the last 2 weeks for Chairman Powell. That's for sure. Bill, good to catch up. Bill Dudley there of Bloomberg Opinion, former New York Fed president. Let's recap the price action. Some wow moves across the board in the equity market and in bonds since the start of November, the end of October. This afternoon at 1%. 0.5% on the S&P. The gains fade a touch, but big gains nonetheless. On the Nasdaq, up by 0.9%. How about the Russell? The small caps up by 2.7%. We're talking about gains of more than 10% since early November on the S&P 500. A year in a month. In the bond market, 2-year, 10-year, 30-year, 2-year, 4.47. When the Fed met in November, the morning of that meeting, on the second day of that meeting, 4.92 on a 2-year. Right now, 4.47.25. What a turnaround, TK. Close to 5% and all the way back down again.
Yeah, there's anything we're always looking at. I mean, it's something as idiosyncratic as the Turkish lira is on a bid today for the first time since the time began. But yeah, you can look across all of the equities, bonds, currencies, commodities and see the effect of this. John, I want to go on 1 week. I want to go on 2 weeks. Every strategist out there has to republish and readjust. And let me tell you, you got your outlook to bed December 5.
Yeah.
Let's go in this weekend. We're rewriting it. I mean, this is that dramatic.
I have to correct what I said. I was quoting the 10-year. The 10-year was a 4.92. The 2-year, back in early November, was 3.5%. These are massive changes. Back down to 4.47 on a 2-year. On a 10-year, just above 4%. Bramo, in the FX market, I think we've got to talk about this. The tug of war that we're going to see play out now, off the back of what we've just heard and into tomorrow with the ECB. The euro at the moment looks like this, 108.68. That currency pair positive by 0.7%. Given the moves we've seen in the bond market, that dollar is a whole lot weaker. Where does this leave President Lagarde in tomorrow's meeting?
Hold my beer. I mean, essentially, is this what she's going to say is, okay, I'll take that and I'll raise you by saying, I think we should cut rates in March. This is going to be a bigger question. Did the whole world experience pandemic era inflation that has largely subsided and that was ultimately transitory, or is there something else at play? Jay Powell did not want to embrace the question about financial conditions loosening and what that means. Are we going to hear the same thing from Christine Lagarde?
There was a moment in that news conference, just a moment, where he reflected on how wrong so many people have been in 2023. And I think before we go home for Christmas, the holidays, and look ahead to 2024, Tom, we need to reflect with some humility about what went wrong in 2023. Last year, 12 months ago, looking out 12 months, we were talking about the prospect of recession, of much higher unemployment. We called the Fed's forecast aspirational. TK, we had bank failures, some of the biggest bank failures we've seen in decades, not just in this country, but around the world. And yet, a couple of quarters later, we had GDP north of 5%.
That's the key point.
So when we talk about netting a soft landing, getting all these rate cuts the Fed is talking about without the economic weakness, I think we've got to remember this has been a very, very, very difficult economy to forecast, and the next 12 months might be equally as tricky.
We're repiecing the show together for tomorrow, folks. This is so profound. Our team's going to work all evening to give you the best tomorrow morning that we can. And Amy said to me, who do we talk to? And, you know, the usual names. You mentioned Bob Michael, J.P. Morgan. I think to see a bank like J.P. Morgan recast their view forward. But I looked to Urian Timmer at Fidelity with decades of experience of real economy analysis. And this is the Lagarde distinction. If we do 4% nominal, what's the character of that American 4% growth versus whatever number you have in Europe? They don't have the technological pop that we have.
Can we introduce some politics into this?
Did you speak with Vice Chair Biden?
This gets really, really difficult. Going into next year, okay, let's say we get 75 basis points of cuts. Where are they landing? And does the political calendar shape where you think that comes, Lisa? Given that we're going to have campaign in full flow going through next year, are you telling me they're going to wait until June? We had Matt Lazzetti at Deutsche Bank on the program a little bit earlier, Lisa, and he said they start in June and they go 175 basis points. They start in June and go 175 into the election.
Right now, there is a 74% chance of a rate cut at the March meeting for the Federal Reserve. That is what I'm looking at in terms of what people are expecting. If the Fed is currently talking about cutting rates, why would they wait until June? For politics, they could be accused of political interference either way, deciding on when they move.
TK, that's the question. Why wait?
Well, there's the why wait, but there's also look at the further data. And again, I'm skewed towards a study of the real economy. We finished strong here. Jeffrey Rosenberg with his portfolio manager, BlackRock, systematic multi-strategy fund. He will be systematically reviewing everything after this historic meeting. Jeff, you know, at gunpoint at Carnegie Mellon, you were required to read both volumes of Alan Meltzer and get out the 60s, the 70s in Fed meeting. And what Dr. Meltzer would say is it is, at the end of the day, about the real economy. What did Jerome Powell today say about the American economy with this stunning statement, the dots in the Q&A?
Yeah, it was overall a validation of the transitory view. And, you know, what was a little bit feared going into the press conference was whether he would push back. He got the softball from Nick Timiraos on financial conditions.
Now be nice.
And clearly, you know, chose not to hit it out of the park in terms of pushing back on financial conditions. And that was a green light to continue the initial reaction from what we got in the statement of economic projections and the dots, and the 75 basis points in the dots is clearly the surprise. So, you know, this is a green light for investors. I think Nick's question and this question of financial conditions, and Bill Dudley mentioned it a minute ago, this is the problem, is that this can go on for a while and it can get overdone in terms of how much easing the market does before the Fed. But the message today is the Fed is very happy with what they've seen. What changed? You know, clearly it's the validation on the inflation story. And they're very pleased that after getting it wrong for so long, they're really getting the validation in getting it right.
So, Jeff, what do you do? Stay on the ball, hold on, grip tightly, don't let go? What do you do?
I mean, the short term is you can't really fight this until there's some kind of fundamental data from the economy side that pushes back. And there hasn't been. It's all been coming up. Soft landing, inflation declines. Yesterday, you can squint at core. Nobody seems to look at core anymore. He mentioned it very briefly. It actually popped up. So there are some, you know, vulnerabilities, but the message and the concern, no one's looking at the vulnerabilities. They're looking at the validation. And so with that validation, this bullish sentiment can go on for a while until we get a new round of economic data. And until then, I think the message is pretty clear that the Fed is more than willing to see an easing in financial conditions, won't step in the way of that.
Kathy Jones of Charles Schwab, put this out on X or Twitter. With that, I have to revise my 2024 outlook. Happy to do it. Are you revising your 2024 outlook after this meeting?
You know, I've done this for so long that I don't do the whole, you know, Christmas in July, outlooks in October kind of thing, because you end up with this problem. So, no, I don't have to revise it because I just haven't put it out yet. So that's a good plan.
It's a bold strategy. You know, I looked, Jeff, at where we are, and I just looked up one of the BlackRock money market funds, 5.2491%. Where's all that money going? I mean, this is right up your wheelhouse. Where's all that money going when that yield comes down?
You know, you asked this question in the pre-segment to one of the guests, and I was listening in, and, you know, this is the change. This is the turning point.
I agree.
Last year, it was all about you're rewarded for staying in cash when the cash rates are going up. When the cash rates start going down, now your rate of return starts going down in cash. So it is the signal to start moving out of cash into more term rates, in fixed income, to lock in rates at their highest yields if you're going into a cutting cycle, to move back into risk as we talked about earlier, the lack of a hard landing, the over forecasting of recession fears, the legacy of the damage of 2022 that's kept people happily in cash, all of that dissipates. And I think that's what I was referring to before. You got to be careful as to how big that easing in financial conditions can become and how that can undo some of what the Fed thinks is the right stance. But that being said, this is a turning point, and I think you do start to see that money move out of money markets into riskier assets, into more term rates, to lock in higher rates. As the cash rates start to come down, you're penalized now in 2024 for holding cash because the rates and the prospect of the rates is to go lower.
Jeff, what would you advocate for? You're sitting in cash, you've missed the rally of the last month, you see yields drop and you get nervous. Reinvestment risk is not just something to worry about, it's real. You see the moves in a single day of more than 20 basis points. What are you advocating for?
Well, I think there's lots of different ways to step out of cash into, it depends on the risk perspective, but in fixed income, you know, that movement into the front end of the curve, you can step out a little bit more into the belly. It's going to lock in not only some yield levels, but you'll pick up a bit more price appreciation in a total return context in a falling rate environment. I think you can go further. The soft landing, the lack of economic recession, stirs yield and yield pickup in terms of income and credit risk. That credit risk, it's priced in, but it's not going to collapse. And so if you avoid the recession, investors can step out on the risk spectrum in fixed income, increase yield levels relative to cash, lock those in. And as long as that recession outlook is avoided, and that's not a guarantee, but that seems, again, with what the data is showing to be the more likely scenario, you know, you'll lock in those yields and achieve a higher return than what you're going to get out of sitting in cash.
I want to just point out that we're down now about a percentage point in less than a month on 10-year benchmark yields. This is full faith in credit, the most liquid market in the world, and we're seeing fluctuations that we have never seen before. Does that raise any concerns for you that we are seeing such incredible volatility in just the market's psychology on not that much different in terms of news, as you pointed out earlier?
Yeah, it's a really good point. When thinking about what the fixed income market looks like from a portfolio context, we just have to get more used to this higher level of volatility. You know, the ag index, the benchmark for fixed income used to be a 3 to 4% volatility instrument. Today, it's about double that. So when you're balancing out portfolios, there's just a higher level of risk. You can mitigate that by being shorter in terms of duration. Some of the more attractiveness in the front end of the curve is you've got still the highest yields, and with the lower duration, less volatility, but a bit less price appreciation too. So there's a little bit of a trade-off there. But it is, to Lisa's point, you gotta expect this isn't the old fixed income market. It's a newer fixed income market. It means higher volatility, better yields still in the front end until we normalize.
Hey, Jeff, one final question. Torsten Slok at Apollo had out a stunning chart today of the spike in bankruptcies. Within all this, and I mean from a political economic standpoint, the history of this meeting, the shock of this meeting, is this a meeting that just benefits the haves of America? Half this country's flat on their back, and the others are living large. The Dow's up 460 points. Is this just about almost a financialization and advantage of the elite in America?
So I love Torsten, love his work. You know, what he's highlighting now, and he's done this for a while, is there's a distributional aspect of our economy that gets lost in these aggregate statistics. And so there is an impact of rising interest rates. There is an impact of the significant tightening in interest rate policy. But you don't see it as much in the aggregate. You see it when you disaggregate and that distributional side. So the bottom end of consumers, the bottom end of credit is more vulnerable, and you're starting to see that. But it's still a distributional story. It's what you would expect to see in the tails, and it is showing the effect of that. But that doesn't necessarily mean that story is exacerbated, extrapolated into the aggregate view. It's part of the story. It's an important part. Credit cycles begin from the bottom, and so you got to watch that. But the counterpoint is that the rest of the distribution has created a lot of immunity, if you will, not permanent immunity, but a lot of reservoirs to buffer the increases in interest rates. On the consumer side, that's from savings. On the corporate side, that's from fixing maturities and terming out interest rates. And the reason is we had such a prolonged period of zero interest rates, so that the shock of interest rates isn't as much of a shock as it appears. It can be, and we have to watch it. And you're certainly seeing it, as Torsten's highlighting, you know, in some of the tails, but it's not really the aggregate story yet.
Jeff, I've got a few seconds. Pick a month for the first rate cut. I know you're not going to give us an outlook, but just pick a month, Jeff.
I'm going to give you June. You know, sometime in the summer. I think the March, and I know Neil, maybe a little bit early. What's the rush? They still want to make sure. they've nailed the inflation story.
Got to leave it there, Jeff. Good to catch up, buddy. Always is. Jeff Rosenberg there of BlackRock. The Federal Reserve Chair does not want to declare victory. Let me tell you, this market already has. In the equity market right now, on the S&P 500 approaching a close, we look at a little something like this, up 1.2% on the S&P, the NASDAQ up 1%, the Russell up 3.5%, and Lisa in the bond market, a monster rally.
So maybe the Fed Chair Jay Powell didn't want to declare victory, but President Biden does, and we'll hear lots about it, and he's putting out on Twitter about prices coming down. This is going to get political very quickly.
I agree with
People try
that.
to message
Yes.
around an economy where the story has not been told yet.
Yeah, we're going to just have a killer show tomorrow. I've been taken by surprise with this. I knew it'd be like, okay, but this is stunning.
Absolutely amazing. Coming up on the close, look out for this, more reaction to the Fed with Stanford's Professor of Economics, John Taylor, former Fed Governor Betsy Chu. From New York City this afternoon, that does it for us. Thank you for our audience worldwide. I reflect on the words of Emily Rowland of John Hancock Investment. It's a pivot party, and everyone's invited. And what a party it is right now. From New York City, this is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 3:46 on Wall Street. We do check markets all day long here at Bloomberg. I'm Charlie Pellet. Doves fly, bulls run as Fed Chair Jay Powell says the Fed is just at the start of policy easing talks.
A question of when will it become appropriate to begin dialing back the amount of policy restraint in place. That begins to come into view and is clearly a topic of discussion out in the world, and also a discussion for us at our meeting today.
And a massive rally underway into the close, with the S&P up 55 points right now, an advance of 1.2%, extending the year-to-date gain for the S&P 500 index to 23.3%. Dow Industrials up 450 points, up 1.2%. The NASDAQ Composite Index up 165, higher now by 1.1%. 10-year yield 4.02%. We've got the 2-year yielding 4.45%. Gold surging $41 the ounce to 2020, up by 2.1%. And West Texas Intermediate crude oil up 1.6%, 69.69 for a barrel of WTI. So again, recapping, stocks are surging. Apple on track for a record close. Apple shares up now by 1.2%, 197.10 for Apple. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no. Who's gonna drive you home? Honey, please, I'll do the driving. Drive on. Excuse me, I want to drive. It's
the question that drives us.
This is the Drive to the Close.
The funky music will drive us till the dawn.
On Bloomberg Radio.
Hello, live from the Bloomberg Interactive Brokers studio. We're streaming on YouTube and at Bloomberg Originals, Wednesday, December 13th, 2023. A happy Fed Day to everyone, and especially to Fed Chair Jay Powell, who pretty much could have done a song and dance up there. Seemed like he was pretty excited about the direction that things are moving. We're seeing stocks higher. We're seeing yields go down. That was certainly the Fed meeting heard around the world. I'm Tim Stanovic, along with my co-host, Bloomberg News' Mike Regan, who's also now the leader of the crypto team. Mike, what did you think of that?
Well, it's interesting, Tim. I mean, a lot of times when the Fed comes out with a statement that's interpreted one way by the market as sort of dovish, Powell sort of appeared to intentionally talk the market out of that reaction.
Didn't see that today.
Did not see that today at all. The S&P up more than 1%. All the major indexes up more than 1%. I mean, these moves after a Fed press conference oftentimes can be volatile and sort of not necessarily indicative of what to expect tomorrow and for the rest of the week. But boy, for the moment, everyone seems very happy with this statement in press conference.
Yeah, they certainly do. It's a fascinating day, and I think everyone's going to remember who pays attention to this stuff where they were, because it does seem like that the Fed has declared victory, although he came out and said we haven't yet declared victory. The market's saying that they've declared victory when it comes to the war on inflation.
Right, and that Fed dot plot so important, really telegraphing, the likelihood of 3 rate cuts of a quarter point next year. So much closer to what the interest rate market was expecting. It's off to the races in both stocks and bond markets today. Pretty remarkable move.
Well, let's see what Sarah Ponczek has to say about all this. She's financial advisor at UBS Private Wealth Management. She's somebody who our audience knows well, and somebody who, Mike, you know pretty well because she was your co-anchor of the What Goes Up podcast for so many years here at Bloomberg before she went over to UPS. Sarah, good to have you with us. How are you?
I'm great. And yeah, I was just about to say, Mike's come a really long way, head of the crypto team, since the two of us hosted a podcast together. You're doing big things, Mike.
You're going to put all your clients in crypto, I assume, this year?
Yeah, I can't discuss that due to compliance reasons.
Sarah, what do you make of what we just heard from Fed Chair Jay Powell? I mean, markets certainly loving it.
It really is remarkable. I mean, the Fed essentially came to the table today. Powell came to the table and they patted themselves on the back, saying that, look, inflation has eased and economic growth has slowed, but, it's still looking pretty good. And it's really remarkable because the Fed had every option after this last month and a half to push back against the bond market. We had seen in November the best month, the largest rally for the bond market benchmark, since 1985. And that had really undone a lot of the tightening that the Federal Reserve had done. They had even said previously, oh, well, the market's done some of our tightening work for us. So again, they had every option to push back against the bond rally, and they didn't, which is really telling the fact that, the median dot next year is now showing 75 basis points of cuts. Sure, that's the median. Some expect more, some expect less. But just the fact that the Fed did not push back against the market's easing over the past month and a half is something that's big for the market, as clearly we're seeing in the rally in both bonds and stocks today.
Sarah, I think one thing that has a lot of people nervous about a year like this is, at least for much of the year, it was such a top-heavy rally. Those big, famous tech stocks, whether you call them the Magnificent Seven or the FANGs, whatever the latest, whatever the kids are calling them these days, really drove the bus on this market rally this year. How are you thinking about that going forward? And what are you telling your clients? I mean, is it time to maybe diversify into everything else? Does that make sense at this point?
It does make sense, and we've seen that trade work. If you look at the month of November, for example, the equal weight version of the S&P 500, which gives every single company in the index the same weight as those Magnificent Seven, or like you said, whatever the kids are calling them these days, same exact weight. The equal weight version actually outperformed. We saw small caps outperform. We saw cyclical industries that had lagged all year long outperform. And what's interesting is if you look at the trade today, if you look at it by sector and you look at your best performers, I'm looking at it right now. Your best industries are utilities up 3.6%, real estate up 3.5%, staples up 1.7%, healthcare up 1.6%, and your worst sectors are tech and communication services. So we're seeing a complete flip of what we've become accustomed to throughout this year, where the best performers are now the laggers. Yes, they're still in the green. Everything is rallying today, but we're seeing the laggards from this year really start to lead the way.
Anything make you nervous, Sarah?
There's always something that makes me nervous.
I've never seen Sarah nervous. I don't think she gets nervous.
Deep inside, Mike. Look, I mean, things are pretty good right now. One, on the bond side of the equation, and I would honestly say that one of the most difficult things for our clients over the past couple of years has been understanding that bonds can drop in value. Your bonds are still performing, they're still paying you income, but on paper, you're going to have losses because, rates are now higher than they were when you bought those bonds. So that was really difficult. And now something to be optimistic about is bond holdings and bond performance. As we really saw take off in November, and it seems like it's continuing to, and we do expect bond returns over the next year and going forwards to be pretty strong. Now, when it comes to stocks, it's interesting because when you look at the fundamentals, there are reasons to be optimistic going into next year, one being corporate earnings. When you look at 2023, corporate earnings for the S&P 500 were flat. We didn't see any growth. We didn't see any declines, but they didn't go anywhere. Now, into 2024, our chief investment office is expecting that we should see about 9% profit growth, which, you know, stocks follow earnings. So that would bode well for the market. But at the same time, when the market is now pricing in as many cuts as they're pricing in 2024, usually when the Fed starts cutting, it's not a slow grind. They start cutting pretty quickly because something's gone wrong. Now, that could bode well for the bond market, could be a rocky one for the stock market. So I'm always worried about something. But yeah, sometimes things just seem too good to be true. And even though we're still projecting positive returns in the bond and stock market, you know, next year, it could be a rocky ride. And the fact that everyone now seems to believe in this soft landing narrative, yet the Fed's going to potentially have to cut 5 times next year, according to the market, something doesn't necessarily add up there.
You know, Sarah, I remember a year or two ago, I feel like half of the stories that came out of markets coverage were about how 60-40 is dead. You know, bond yields are at rock bottom interest rates, stock valuations are high. You really need to rethink that. I can't help but wonder, though, now, is it 60-40? Are the kids in a 60-40 these days? Is it back?
The kids are into 60-40 these days. 60-40 is back, at least for the month of November. What was it? In the month of November, it was the best month for the 60-40 portfolio since the early 90s. So that just goes to show. But much of that is predicated upon the fact that the 60-40 portfolio was claimed to be dead. And don't get me wrong, the 60-40 portfolio has gone through many tribulations over the past couple of years because interest rates were at rock bottom. You know, you really couldn't get much income from the bond market. And with the rise in bond yields and the rise in interest rates, we were going to see negative returns, a bear market in bonds when that day came, which we saw over the past couple of years. Now, stock returns should continue to be pretty strong. And on the flip side of that, when you look at the 40% side, the bond side, well, if you are locking in bond yields, then you should. If you're someone still sitting in cash, now's kind of the time. The flag's been waved to go ahead and lock in yields further out on the curve. Well, now you can actually get income from that 40% in bonds, and you can also potentially get capital appreciation when interest rates do come down over the next couple of years. So yes, Mike, I think the kids would say 60-40 is back, but I would also add to that, we do believe in for the majority of our clients, we typically take a portion of that 40 or 60, depending on the client's time horizon, risk tolerance, and we allocate that to private markets as well. So I wouldn't say just vanilla 60-40, but maybe spice it up and add in a little bit of alternative investments as well.
All right, Sarah Ponsick, we love it when you join us. I think we'll have to do a remote down in Boca Raton, Florida, and we can all hang out there this winter. Sarah Ponsick, financial advisor at UBS Private Wealth Management, joining us on a Zoom from Florida this afternoon. Taking a look, just a quick data check. The Dow up 1.31%. The S&P 500 surging 1.26%. The NASDAQ up 1.23%. Don't go anywhere, because coming up next, we're joined by our Bloomberg TV team for our cross-platform coverage. Radio, TV, YouTube. Bloomberg's Beyond the Bell starts right now.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic alongside Scarlett Fu and Katie Greifeld. We're counting you down to the closing bell. You're here to help take us beyond the bell. It's a global simulcast with Tim Stenovic and Mike Regan. Welcome to our audiences in full on this Fed day here. A day where the Fed did not give any real change in their policy position, but they certainly gave us a big shift here in their outlook.
Yeah, it's certainly a day when the market said the Fed has officially, or I think the market has officially declared that the war on inflation has come to an end. Rate hikes have come to an end. And the Fed, Mike, is going to start easing. I mean, look at the rally we're seeing. Not just the decline in bond yields, but also what we're seeing in the equity market right now. I mean, this is a historic day.
Yeah, absolutely. And I keep thinking about what we just heard from our guest, Sarah Ponsick of UBS, saying, if everyone's excited about rate cuts, it makes you wonder what will cause, what in the economy will actually cause that to happen with the Fed. So it is a great day. It's a celebratory day. We've got the NASDAQ NASDAQ 100. I love round numbers, Scarlett. NASDAQ 100 up more than 40% on the year today, as of today. And really, it's not so much a rotation. It's every index is up more than 1%. So people are just buying everything at once with both hands.
Yeah, the everything rally just got another kick up in gear. And of course, the Russell 2000 up 3.5% right now. I believe this might just be the beginning of the January effect.
Okay, how about the Dow Jones, though? I mean, we're talking about small caps. Let's also talk about the Dow Jones as well, hitting a record high, just like you said, everything rally. Amazing moves, particularly in the bond market.
Yeah, the Dow right now looks like it's going to close at a record high. Remember, that's on the back of what is already really about a 12% rally since the end of October. You're hearing the bells here in New York, and let's walk through the numbers as we wait for the numbers to settle. But it's going to be green across the screen with the Dow up more than 500 points, or about 1.4%. The S&P 500 cracking above that 4,700 level, its highest level going back to mid-January 2022. And if you just do the math, you're now less than 100 points away from reclaiming that record high. That means it only needs a move of less than 2% in order to get there, a 1.4% move here on the day. The NASDAQ composite up about 200 points, or 1.4%. And the Russell 2000, that was your outperformer here on the day, a 3.5% gain on the Russell that now has it flirting with 2,000.
Yeah, look at that. Broad-based. We're seeing a lot of green on the screen, and I got to tell you, if you peel back the layers of the S&P 500, hard to find decliners in there, Scarlett. 458 stocks moving to the upside today. Only 44 stocks moved lower. On the Dow, it's 27 stocks moved higher, and 3 declined.
Well, okay, that's Mike Regan's job to look for some decliners. But in the meantime, let's look at the sector performers here. You have 24 industry groups, 22 of them finishing higher. Utilities, real estate investment trusts, and banks leading the way, each up by more than 2.5%. And the only sectors to fall are telecom services and insurers.
All right, actually, and before we move on, too, I just had to double check this here. The NASDAQ 100 also at a record high on the day.
Okay, look at that. Well, speaking of record highs, we got Apple closing at a record high this afternoon. That's my first gainer, finishing the day up by more than 1.6%, 197.96. It has been higher intraday back in July, but this is a record high for closing. It closed a previous all-time high was 196.58 back in July. Finishing the day higher right now by 1.7%, up another $3 today. Stock up more than 50% so far this year. Also got to look at the best performing stock in the S&P 500 today, Vertex Pharmaceuticals. This company absolutely surging on the day today as a result of the company saying its non-addictive drug helped patients with chronic nerve pain from diabetes. Up more than 13.2%, closing and rallying to a record high. This drug was generally well tolerated at all doses, and Vertex is planning to actually move the drug into the final phase of human testing. And finally, we're back to, prices might be coming down a little bit, or the rate of increases prices might be coming down a little bit, but we could see more expensive eggs out there. Let's check out Cal-Maine Foods. COMUS is the ticker symbol. The nation's largest fresh shell egg producer and marketer, rose the most intraday. What's that?
Just spit it out, because I'm fascinated by this
10.3%.
This broke yesterday after the close. Yeah. And the shares plummeted because everyone said, oh, avian flu, that's bad. But then everyone woke up and realized, well, if you're taking 600,000 chickens out of production here, that means prices are going to go up. So a net positive. How does that work?
Well, that's supply and demand, my friend. It's the basics, right?
Can I ask one question? What is a fresh shell egg? What is the distinction there?
I'm guessing it's an egg that's not already been cracked.
Okay, very good. Thank you.
That should be what we're all aiming to purchase, no?
I mean, you have to make these distinctions.
How much are the cracked eggs? Because I don't think I can afford a fresh shell.
I hope we don't see a return to these high egg prices. But Romaine, you did talk about the news that we saw yesterday. The company coming out and saying that it has to close one of its Kansas facilities after it tested positive for the avian influenza. One analyst wrote that the virus has started to ramp back up across the U.S. Cal-Maine Foods up by 10.3% today.
Well, I did find a few decliners for you, Tim. Not many, or downers, as I like to call them. But big drop for Pfizer. Down about 6.7%. That's the most since June 2020. It was actually down as much as 10% at one point, which would have been the worst drop since 2009. But Pfizer lowered their full-year revenue forecast to a range of $58.5 billion to $61.5 billion. So well below the $62.9 billion that analysts were expecting. It turns out that the sales of the COVID vaccine, not a bright outlook for those, as well as there was hope that their takeover of Seagen, the big cancer drug maker, would help their forecast, but not enough to counteract that drag from lower vaccine sales. So big drop for Pfizer. Also, Southwest Airlines down 3.8%. They actually did slightly raise the low end of their fourth quarter revenue forecast, but not the high end, and investors were hoping for more after JetBlue's forecast last week really raised sales and profit expectations for the quarter and the full year. So a bit of disappointment from Southwest here. And finally, Etsy down about 2.3%. They were down almost 9%, so this rally in the market is sort of cutting the losses in some of the stocks that were down. Etsy came out and said they would cut about 11% of its marketplace workforce. Now, sometimes job cuts can boost a stock, but not this time. Etsy down about 2.5% on that news.
All right, let's get to the bond market because that's really where a lot of the action is today. You look outside of the equity market and you take a look at 2-year Treasury yields right now. Just a fantastic plunge on the 2-year, down about 30 basis points. That is the biggest move since March, of course, when we had that little bit of a banking meltdown. A lot of that is more cuts getting priced in to 2024. That's really where all the drama is. But then you take a look out of the curve, and you also see a lot of double-digit, I don't know if you can call that if we're talking about basis points, but the point being pretty big moves as well. You take a look at the 2s-10s curve continuing to march towards positive territory, but still about negative 42 basis points inverted, with that 2-year yield leading the plunge lower.
Yeah, and of course, the Fed really driving this market right now. Of course, there are still some idiosyncratic stories out there, particularly when it comes to earnings. And we are getting earnings crossing the wire right now. This on the software company Adobe. Shares moving lower here in after-hours trading after the company said that in its most recent fiscal quarter, EPS came in, well, above estimates, but revenue came in line. $5.1 billion in revenue in the most recent quarter, $4.27 on EPS. But here's your guidance going forward. The full year 2024 guidance, EPS expected to be in a range of $17.60 to $18 a share. The street was looking for $18 a share on average. And revenue for the full year, actually I don't have the full year revenue forecast before the current quarter, the current fiscal quarter here, they're looking at revenue of 5.1 to 5.15 billion. That high end of that estimate is slightly below the average of street estimates.
Yeah, go to the press releases. We continue to see Adobe move lower, down by 7.6% in the aftermarket. Dan Duren, Executive Vice President and CFO, saying that the company's performance in the fiscal year 23 drove world-class margins and operating cash flows of $7.3 billion. He calls out the scale, the speed of execution, and profitability position that the company for years of sustained success. But investors in the after hours certainly not buying this.
Just wanted to point out that the full year revenue forecast came out 21.3 billion to 21.5. Analysts were looking for 21.74 billion. But notable that these forecasts don't include Figma, which of course is still pending that purchase as the EU and the UK oppose that acquisition.
All right. Well, reminder that we're still in earnings season, even though we're close to wrapping up the final quarter of the year, guys. That is going to do it for Beyond the Bell, our cross-platform coverage of the market close right here on Bloomberg TV, on radio, Bloomberg Originals, and YouTube. Meantime, catch us tomorrow, same time, same place. Happy Fed Day, everyone. You know, I was all set to talk about Tesla shares actually falling on the day today, but they ended up moving higher by just fractionally, well, actually a full percentage point, but they were down for most of the day today until we saw this late day Fed-induced rally. Big part of the reason was because news broke that the company is recalling more than 2 million cars. This would be its biggest recall ever. The National Highway Traffic Safety Administration determining that its driver assistance system, Autopilot, doesn't actually do enough to guard against misuse. For that and more on Elon Musk and also SpaceX, we got Ed Ludlow, the co-host of Bloomberg Technology on Bloomberg TV. He joins us from our San Francisco bureau. Ed, good to see you this afternoon. We got a lot to get to, but I do want to start with this big news coming out of Tesla, the biggest recall ever. And we got to, remind people that when we talk about a recall when it comes to Tesla, oftentimes this stuff can be solved over the air with software. Give us some details here.
Yeah, and that's the case here. It is a recall as a technicality, or in the technical sense, a recall in name only. But what NHTSA found which is the main kind of highway safety regulator, is that there aren't enough kind of visual prompts on the display screen of a Tesla, on the dash screen as well as the main monitor, to remind the driver to keep their hands on the wheel and their eyes on the road. That might seem obvious to you, but it's not a hard recall. Like, Tesla doesn't have to take back any of the cars. It has to address NHTSA's concerns with an over-the-air update, which is doing voluntarily with objection based on what NHTSA told it. And it's so important to be absolutely clear here. We're talking about autopilot, which has been standard on all Tesla cars since 2015. We are not talking about full self-driving beta, which is kind of the next level up, something nearer to autonomous driving technology.
Well, I do wonder, when they do a recall like this, and it's a great point, I think, that we're not talking about having to supply parts and labor, really. It's some software code update. Does this still cost Tesla anything material, to do this, or is it just tweak a few lines of code and they're done with it?
Can you assign a value to the PR behind it?
Yeah.
I mean, that it is a recall on a technical basis. And today the headlines were 2 million vehicles recalled, the biggest US recall for Tesla ever. There were only 2 million Teslas on the road anyway, so it's basically all of them. And as Tim pointed out before the start of the segment, the stock did recover, but at a session low, I think we were down 3%. And so there's that impact. But in terms of the cost of addressing or fixing the issue, it's negligible. That said, the experience of lots of Tesla owners that I've spoken to today hasn't been that smooth. It is supposed to be as simple as pressing the touch screen, running the update, but sometimes that can be problematic for a small part of the customer base.
There are a few certain things in life that we just can count on each and every lifetime or each and every year. One of them is death.
Fed meetings,
taxes, and that full self-driving is going to come this year. And
right.
That's something that Elon Musk says every single year, and he's been saying it every single year. And here we are in 2023, years after he first said it, without a fleet of robo-taxis as I walk out of 731 Lexington Ave this evening.
Right.
How does this play into the idea that the world that Elon Musk wants is one where we're not actually behind the wheel in the sense of driving a Tesla?
I apologize profusely for interrupting, because to your credit, it's just spot on that every year, every month, Elon Musk makes a prediction that often does come true, just not on the timeline that he sets out. So the recall today was not to do with full self-driving beta. It was to do with the most basic driver assistance tool. But we do care about full self-driving beta, which is a software suite that allows the car to drive itself to all intents and purposes. But legally speaking, if you read the small print on Tesla's website, it says the car is not capable of driving itself. It still requires the driver to have their hands on the wheel and their eyes on the road, because those are the laws of the land, at least in this nation and in many other main jurisdictions. The future is one where Tesla plans to sell a much lower price point mass market vehicle to build up the number of Teslas around the world. In that time, based on the Tesla vehicles on the roads today and that future model which will grow the volume of Teslas out there, they're using the software to gather data, to train the neural nets behind their autonomous technology, with the end goal being, and everyone forgets this, but Musk has spoken about it so many times, the end goal is where Tesla operates a fleet of vehicles that drive themselves. Right, and takes back ownership of those models in the future. But what I just outlined is the arc of what Tesla plans to do to get there. The problem is that is real-world testing on roads with other traffic and other road users, and that is the risk that the regulators are concerned about.
And it's very early days for the Cybertruck, but I wonder what you're hearing. Is it going well, or is it being received well by the first batch of customers to receive one?
Yeah.
What do we know?
Yeah, I mean, from the customers that received one that I was spoken to, they're absolutely delighted, but those customers are part of a very clear demographic of high net worth individuals who have very high spec versions, and we're talking just a handful at this stage. The big shock was that when they did the big unveil last week or the week before, the lowest price point Cybertruck was $61,000, $20,000 more expensive than when they first announced it in 2019, and that lowest cost variant is not going to be available until 2025. So it's very much targeting the early adopter or first adopter market right now. It's an incredibly expensive product, and we expect the ramp of their output to be really slow.
And I said there's a few things that I want to get to. We got a couple more. One is this story that crossed by Sophie Alexander and Dana Hull about Elon Musk planning a new university in Austin with a $100 million gift. So he's got Neuralink, he's got X, he's got X.AI, he's got the Boring Company, he's got Tesla, he's got SpaceX, and now he's got a university too?
Yes, and this is a philanthropic effort, so it's different from his business lines. Dana Hull and Sophie Alexander reported this because they got hold of the IRS application that Musk had made for tax exemption. So he plans to make a $100 million gift to set up a university in Austin in competition to all the other universities that are popping up in Austin right now, initially focused on STEM subjects, but then broadening it out. And, you know, Elon Musk does regularly conduct philanthropic donations and exercises. He has previously set up a school, which in the first instance many years ago was for his children, at kind of K through whatever level. And now he wants to focus on academia and the highest level of education. But it's a fantastic report by my colleagues.
You know, Ed, I feel like whenever the name Elon Musk comes up, there's about 12 different stories floating around. He's moving in so many different directions. But obviously the other big one lately is SpaceX and this opportunity for insiders to sell some of their equity in the company. Talk us through how that's going, what we know about it.
Yes, the latest that I reported last night with my colleagues, Katie Roof and Lauren Grush, is that there was so much demand to buy shares in this tender that they actually upped the price a little bit. So when we reported it last week, it was $95 a share. These are employees selling their shares to outside investors. And the price has now been upped by just $2 to $97 per share. But based on the volume of shares they plan to sell, around $500 to $750 million, that would give SpaceX a valuation of about $180 billion. The last round that it did in the summer valued it at $150 billion. So this is a big jump. You know, SpaceX is the clear most valuable US startup. It's the second most valuable private company globally behind ByteDance. And these are big numbers for a company that I've reported is on track for revenues of between $9 and $10 billion this year, maybe $15 billion next year. But the valuation's eye-watering, and investors are just clamoring to find a way to invest in SpaceX.
And give us the details, Ed, about a potential IPO, not just of SpaceX as a whole, but potentially spinning off Starlink as an IPO in the last minute that we have with you.
Yeah, this is part of the logic, right? So it's important. These are employees selling shares. They work there a long time. They want some liquidity for the reward of working for Elon Musk. But the opportunity for investors is to get in before it's too late, because we've reported at the end of 2024, beginning of 2025, Musk says more like 2026, they could spin off Starlink in an IPO, which would be a big market and investor event. And if you're already sitting on the cap table, then you're well positioned for that big moment if and when it comes.
So make a prediction. What happens first, full self-driving or a SpaceX IPO?
I am not in the market predictions, but based on what Elon Musk has said / what we've reported, I think a Starlink spin-off's more likely.
Okay, there it is. Hey, Ed Ludlow, thanks so much for joining us. Check out his coverage and all the Elon Musk coverage on the Bloomberg Terminal and at Bloomberg.com. Ed Ludlow, co-host of Bloomberg Technology on Bloomberg TV. He joins us from our San Francisco studio. Hey, we're just getting started on this Wednesday afternoon, this Fed Day. It's Tim Stenivek and Mike Regan in for Carol Massar this afternoon. You're watching, you're listening. Bloomberg Business Week.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 4:21 on Wall Street. We do check markets all day long here at Bloomberg. Fed Wednesday's stock surge, the Dow at a record. Moments ago, we heard from Adobe. It forecast adjusted EPS for the first quarter. The guidance did beat the average analyst estimate, but after ours, we're looking at Adobe shares down now by 6%. Big day for the U.S. stock market. The Dow, the S&P, and NASDAQ all surged. Federal Reserve held rates steady for a third meeting and gave its clearest signal yet that its aggressive hiking campaign is finished by forecasting a series of cuts next year. Here's Fed Chair Jay Powell.
Today, we decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Given how far we have come, along with the uncertainties and risks that we face, the committee is proceeding carefully. We will make decisions about the extent of any additional policy firming and how long policy will remain restrictive based on the totality of the incoming data, the evolving outlook, and the balance of risks.
S&P 500 index up 63 to 4707, a gain today of 1.4%. Dow Industrials up 512, up 1.4% to a record 37,090. NASDAQ, the composite index, up 200 today, a gain of 1.4%. 10-year yield 4.02% with a 2-year 4.43%. Spot gold up 2.3%, 2025 on gold, while West Texas Intermediate crude up 1.7% today, $69.80 for a barrel of WTI. So again, recapping, stocks higher, the Dow at a record, S&P up 63, a gain there of 1.4%. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
Thank you so much for that update, Charlie Pellet. Really do appreciate it. Well, maybe if you've been traveling internationally, you've seen these ads in airports, or maybe in some international cities you've been going around in. The campaign features some of the most well-known French athletes, chefs, scientists, designers, and more. They chose France, and they're telling you to do the same. It's all part of an international marketing effort aimed at attracting interest in and investment to France, of course, the 7th largest economy in the world, and one that right now is trying to distinguish itself from its European peers. Olivier Becht is the Minister Delegate for Foreign Trade, Economic Attractiveness, and French Nationals Abroad. It's quite the title you have there, and that's not even your full title, I should say. He joins us here in the Bloomberg Interactive Brokers studio. Olivier, how are you?
Yeah, fine. Good afternoon, everybody.
Yeah, it's good to have you with us. Why is now the right time to launch such a big campaign internationally?
Well, first of all, because we had a very pro-business agenda with President Macron governance since 6 years. And then we are the most attractive country in Europe for foreign investments for 4 years in a row. And I think it's a particularly good time just after the World Rugby Cup and just before the Olympics next year in Paris, to make this nation branding campaign for choosing France and say to all investors around the world that they are really welcomed here in France. I think it's time to face tremendous challenges in IT, in space, in health, and France is a very good place to do it.
You know, Olivier, when you talk about attracting investment capital and businesses to France, sort of prioritize for us, what's at the top of that list? What would you really love to see come into France as far as investment flows?
Well, we don't have really priorities. I think we have a France 2030 investment plan for innovation. Mm-hmm. The first priority in this plan is to decarbonize industry, but we also have priorities in artificial intelligence, in quantum, in biotechs, to invent together 20 new biomedicines to 2030 and 10 to 2025. We already have 4. We wanted to invest also in new energies. like solar panels, like wind farms, like hydrogen, and we wanted to use the new energies in mobilities to invent together the new plane. Maybe tomorrow hydrogen plane, electric plane, or with other propulsions, sustainable aviation fuel. So I think there is a lot of money in this plan to help businesses to invest in, and we will be very happy if new American companies will be part of this venture.
What would you say to somebody who says, you know, it would be great for us to be investors in France, but we're intimidated by the regulatory environment, not just by the regulatory environment of the EU, but also of the French government, and then also, let's be frank, the labor laws in the country.
I will tell to this person that they missed something during the last year. We really transform France. We reduce the tax burdens. For instance, for corporate taxes, it was 33.5%. It's now 25%. We cut 10, maybe 15 now billion euro on tax production. We reform the labor law. It's more flexible now. It's very secured, especially for job. And I think we also reduce all the complexity. We simplify the administrative procedures. We have key turn sites to implant a factory in 9 months now in France. So I think that France in 2015, it's not France in 2023. So it's really time for choosing France.
Well, and 2023, kind of a strange year. I mean, I feel like we've had a few very strange years when it comes to global trade, geopolitics. I mean, starting with, you know, the trade wars with the U.S. and China under the Trump administration, then the invasion of Ukraine, now Israel. And I think, you know, from where we're sitting, I think the assumption is that all of this has perhaps brought the U.S. and Europe and France closer together, tightened their bonds. But I'm curious how you see it. How does France and trade and investment in France fit into this really dramatic shift in geopolitics that we've seen over the last few years? Are there opportunities, more problems than opportunities? And, you know, how do you navigate all of these shifting
I think you're right. We are living in a time of shocks. Sanitary shocks with COVID-19, then the invasion war in Ukraine from Russia, now in the Middle East, and also climate shocks and maybe technological shocks. But in this time of shocks, I think it's good first to restore the multilateralism, and I think we have a real issue next February in the MC13 in Abu Dhabi for the WTO. We should restore the dispute settlement mechanism. It was one of the topics I spoke about with American officials yesterday in Washington, and we have also to reinforce the links between France and United States, Europe and United States. We should now have permanent agreement on our dispute on sustainable steel and aluminium with Airbus Boeing also. I think we really have to change our trade. We need more sustainable trade with new standards, and I think WTO is a good place to do it. But we must also reinforce the links between United States and Europe, because it's not only trade, it's friend shoring. It's also nearshoring. It's a place where we can build together value chain in the field we need for energy transition, for instance.
After all, the U.S. and France are very close allies. Hey, just in the last minute that we have with you, I want to talk politics a little bit. You're here in the U.S. We're about to be in a presidential election year.
Really?
Oh, yeah.
Next year?
Yeah, next year.
You haven't heard about that, huh?
Yeah, I heard about it.
How are you and your government watching what happens here next year? A potential Trump 2.0.
Well, so you're right. France and United States, we are oldest ally. We are friend. I'm coming from Alsace region. On the border is France, and the border and Germany and Switzerland. And I personally know what we own to United States. Just our liberty. My grandparents lived 2 world wars. So we really have this link, and we don't forget, of course, that Lafayette and the French troops participated to the War of Independence in Chesapeake or in Yorktown. So I would say that, of course, we are really working well today with Biden administration, but we respect, as a foreign government, we respect the democratic decision of the American people. And we will work, of course, with all the American governments. We just hope that we will remain open. Isolation is not for us a solution today to face the challenges.
We're going to have to leave it there. Really appreciate you joining us. Olivier Becht, Minister Delegate for Foreign Trade, Economic Attractiveness, and French Nationals Abroad here in the studio. Let's go to Washington, D.C., check in with Nancy Lyons in the 991 Newsroom. Hey, Nance.
Thanks, Tim. The House is taking a vote later today on a formal authorization for an impeachment inquiry into the president. The focus so far has been on Hunter Biden and whether the president was involved in his son's business dealings. Hunter Biden showed up on Capitol Hill today and said he was ready to speak publicly to House lawmakers, but he refused to go behind closed doors as requested by House Republicans. They've said Hunter Biden's demands amount to a request for special treatment. Hunter Biden did make clear his father had nothing to do with his business.
My father was not financially involved in my business, not as a practicing lawyer, not as a board member of Burisma, not in my partnership with a Chinese private businessman, not in my investments at home nor abroad, and certainly not as an artist.
Biden did admit to making financial mistakes. A major deal has been announced at the conclusion of the COP28 climate summit. It calls for a transition away from fossil fuels, which COP28 President Sultan Al Jaber calls a paradigm shift.
My colleagues and friends, you did step up. You showed flexibility, and you put common interest ahead of self-interest. We have the basis to make transformational change happen.
It's the first time in 30 years of climate talks that there's been an international call to move away from fossil fuels. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Nancy Lyons. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 4:40 on Wall Street. We do check markets all day long here at Bloomberg. The Dow, the S&P, and NASDAQ all advanced today. Indeed, a record for the Dow Jones Industrial Average. Wall Street's great cross-asset rally got an extra dose of encouragement today as dovish Fed signals pushed the S&P 500 closer to its record while sinking bond yields. Sarah Ponzik is a financial advisor at UBS Private Wealth Management, and she was a guest right here on Bloomberg Business Week.
It really is remarkable. I mean, the Fed essentially came to the table today, Powell came to the table, and they patted themselves on the back, saying that, look, inflation has eased, and economic growth has slowed, but, it's still looking pretty good.
And you can hear more of that conversation on the Bloomberg Business Week podcast. You can download it wherever you get your podcast. Dow Industrials at 37,090. That is a record, up 512 points today, a gain of 1.4%. S&P 500 index also up 1.4% today with the S&P at 4707. The NASDAQ Composite Index up 200 points, higher by 1.4%. 10-year yield 4.02% with a 2-year that's yielding 4.43%. Spot gold up 2.4%, up $47 the ounce to $2,056. And West Texas Intermediate crude now at $69.79 a barrel, up today by 1.7%. After hours, keeping an eye on Adobe shares. They're down 6.4%. The software company gave a full-year forecast that was weaker than expected on key metrics. So again, recapping here, Fed Wednesday, big day for the U.S. stock market. Dow Jones Industrial Average now at a record. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Thank you so much for that update, Charlie Pellet. Really do appreciate it. Well, Bitcoin has been on a tear this year, Mike Regan.
It really has.
It's not NVIDIA or Meta platforms, but it's
Not quite.
It's still up close to 140% so far this year. And you're the crypto guy now. What's going on?
Well, and it's funny because we talked about everything else moving after the Fed, but look at Bitcoin today, up another 4%, knocking on the door of $43,000 a token again. And
I'm sorry, is it 2021?
It's starting to feel like it. It's starting to feel a little bit like it.
Yeah.
But I think the main thing is anticipation of these ETFs being approved. There's other more technical things, the halving next year, and really the prospects for lower interest rates, more liquidity from the Fed, I think is helping too. But don't take it from me because we've got a much better expert on this topic to walk us through everything going on in the crypto market. His name is Jason Urban. He is the global head of trading at Galaxy Digital. He's joining us over Zoom from New York City. Jason, thank you for joining the show.
Thanks for having me. This is great, and I'm glad I could be here on a day when it's good news and not bad news.
And well, Jason, we mentioned that ETF, and I think it's pretty much the consensus that optimism about finally, what's it been over a decade since the first application for a Bitcoin ETF? We're finally potentially near the finish line where the SEC might actually approve one. But I think a lot of question on people's minds is, is that a sell the news event? Is all the hype before the ETF is actually launched? Or will we continue to see a bull market in Bitcoin once we do get an ETF?
I think it's going to continue to be a bull market, and it's structural. At the end of the day, if you think about the crypto ecosystem, one of the things that we've been missing for a long time is a steady supply of assets, an actual pathway for money to get in. And you can see that in how the basis trades, especially when the markets are going higher. That just means that there's less dollars in the ecosystem. With an ETF, you're going to release that because people are going to be able to pledge it as margin. They're going to be able to buy it on margin. And so that is going to push it higher. It actually unleashes a lot of the value that has been very difficult. And I think we saw some of the darker days of crypto in 22 when a lot of these lenders who had extended leverage in an irresponsible way. But that leverage was what was fueling it. I know we kind of, you joked at the onset that 21 was, is this 2021 again? Well, the ETF is going to do that, but it's going to be able to happen in a more responsible, appropriate way, and that's what's going to pull it up. I mean, we're here at Galaxy on the trade desk, we're seeing real buyers come in, people who are not fast money, but who are buy and hold, who believing in it, and they're not, the usual people that you would normally see. And quite frankly, it's really encouraging, because when I come on the desk and they say XYZ just bought, I'm like, really? We've been talking to them for 2 years, and finally, they've decided to pull the trigger. And so I think the ETF only one, makes them more comfortable, and then two, structurally allows more money to flow into the ecosystem. So I think it really is a big positive.
Oh, Jason, if only you could tell me who XYZ is. I have a feeling you won't, but
XYZ wouldn't be a client anymore if I could.
Exactly. But, Jason, obviously, if we do think back to 2021, it was such a different market then, in that we weren't just talking about Bitcoin. We were talking about, Dogecoin and all these other fringe tokens, altcoins. But really, the other big story then was this lending, crypto borrow and lending operations that really, some eye-popping yields back in the days when there was no yield to be found anywhere. And of course, it all sort of blew up spectacularly last year. But I can't help but wonder if that lending and borrowing market will have a rebirth, given what crypto prices are doing now. We saw some news, Sam Altman, the OpenAI co-founder, starting a Bitcoin private credit fund. Where is that element of the market, the lending and borrowing and yield farming? Where is all that? Are we coming back in that space as well?
Not as quickly as I think we'd like. I mean, here, Galaxy, we have a lending business. Now, we've always lent oversecured and have been responsible with it. I think that what you're finding is that will come back, but you need to find the structure to allow that to come back, because the days of, I think the true Bitcoiners, not your keys, not your coin, were proven right in the aftermath of 21. And so, as we look at our business and what the inbound we're getting, people are looking for leverage, and there aren't a lot of places that are equipped to give it. One, and two, have a structure in place that allows for that to happen. Prime is a true prime, or a real prime, is something that the ecosystem generally needs. We have a product that we're rolling out, G1, that hopefully addresses some of that, but it really, on a full scale, it's not there, and we're not getting there yet as a community. And so that's why I think, again, back to the ETF, why that is important is because that is an equity that fits into a system that everyone is comfortable with. And a lot of the traders and a lot of the trading desks that are in the space will just use that, and they'll do a delta replacement. They'll buy the ETF, they'll sell their Bitcoin, release cash, use the cash to buy more Bitcoin or some of these other coins that actually are that serve a purpose, right? I think that when we looked at altcoins and, some of the names on that historically, people forget that that's a technology, and there's a need for that.
Hey, Jason, I got to ask you a more basic question here, and it's one that just comes down to sort of fundamentals and beliefs here. I got to get you to react to what Jamie Dimon said last week. And for those who don't know what he said, the only true use case for crypto is criminals, drug traffickers. He talked about tax avoidance, money laundering. He said, if I was the government, I'd close it down. We have a minute left. What did you make of that?
He's talking his own book. I mean, if I could look at how I would protect my brand or my ecosystem, crypto and blockchain is a disintermediating action, right? And so at the end of the day, of course he's going to say that. Physical dollars are used more for illicit activity than crypto. It can be traced everywhere. It's immutable. The whole purpose of an immutable blockchain is that it can be tracked all the way back to its origin. So if you're a bad guy doing bad things, you're not using crypto. You're going to use other things that can't be tracked. And so I think that he's just talking his own book, quite frankly.
All right.
Very interesting. Very interesting.
It's the gift that keeps on giving, Jamie Dimon, when he talks about crypto, I have to say.
Yeah. Well, they do have their own coin,
He's sticking to it. Jason Urban, Global Head of Trading at Galaxy Digital, the Michael Novogratz founded-led crypto firm. Thanks so much for joining us. This is Bloomberg.
Your company news headlines on Bloomberg Radio.
From Bloomberg World headquarters, I'm Charlie Pellet. Apple closed at a record today amid a broad rally in tech stocks, spurred on by bets that the Fed will soon begin cutting rates as inflation slows. Apple today up by 1.7%. Southwest Airlines has lifted its outlook for fourth quarter revenue. And with more on that story, here's Bloomberg's Kimberly Adams.
Travel demand over the year-end holidays. In a regulatory filing, Southwest said travel demand over the year-end holidays. In a regulatory filing, Southwest said revenue for each looking for signs of a travel rebound over the crucial holiday period after domestic-focused carriers struggled in recent months with weakening demand for U.S. routes. Charlie?
And that's Kimberly Adams reporting. Today we did see shares of Southwest lower by 3.6%. Other airline stocks did advance, though. UAL up 1.2%. Shares of American Airlines up today by 0.4%. Delta down 0.2%. JetBlue advanced today by just about 1.4%. Pfizer shares declined by 6.7% today after the drug maker gave an adjusted earnings forecast for 2024 that was below the average analyst estimate. Those are our top company stories at this hour, and this is Bloomberg.
This is Bloomberg Business Week with Carol Masser and Tim Stenovec on Bloomberg Radio.
It's Bloomberg Business Week. Tim Stenovec and Mike Regan in for Carol Masser this afternoon. Let's get a check on the latest world and national news. For that, we go to Nancy Lyons, who's standing by in the Bloomberg 99.1 newsroom in Washington, D.C. Hey, Nance.
Thanks, Tim. The House is taking a vote this afternoon on whether to allow 3 of its committees to pursue their impeachment investigation of President Biden. Bloomberg's Irv Chapman with more.
Fellow Chairman Tom Cole of the Rules Committee, who was not one of those proposing the inquiry, to be the first to defend it.
This will ensure that the House can enforce its subpoenas and ensure that the Biden administration can no longer refuse to cooperate with the investigation.
Ranking Democrat Jim McGovern.
Every single one of their crazy claims has been exhaustively debunked.
Republicans cite checks from Hunter Biden's accounts to the president, whose people say they were repayment of legitimate father-to-son loans. In Washington, Irv Chapman, Bloomberg Radio.
The Supreme Court is adding a new complication to the prosecution of former President Trump on charges of trying to overturn the 2020 presidential election. Bloomberg's Greg Storr, who covers the court, says the justices will hear an appeal from a January 6th defendant who is facing a related charge of obstructing an official proceeding.
This is a charge under a law that was passed in the aftermath of the Enron collapse. It has to do with things like destroying documents. And prosecutors in the January 6 cases said that one provision in the law that has to do with obstructing an official proceeding could be used against the January 6 rioters for obstructing the session of Congress that was going to certify Joe Biden's election victory.
Bloomberg's Greg Storr says if the court rules for the defendant, it could impact the Trump indictment. Also today, the judge handling Trump's election obstruction case granted the former president's request to pause proceedings, while the Supreme Court and other appeals courts determine whether he has sweeping immunity against criminal charges. That trial had been set to begin March 4th. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Nancy Lyons. Now back to you, Tim and Mike.
Thank you so much for that update, Nancy Lyons. Really do appreciate it. Well, Mike, even though the Fed meeting today was the meeting heard around the world, the Punch Bowl is back, Fed, the pivot party, whatever you want to call it, there's other stuff going on, okay?
Absolutely.
There is actually other stuff going on. This is one that I saw earlier today, a story among the most read on the Bloomberg terminal, and I've been watching this closely because it has to do with a big layoffs at in a restructuring at one of the biggest banks. Citigroup is now offering to pay some staffers a portion of their bonuses early if they agree to depart as executives continue with their restructuring of the Wall Street giant.
Yeah, that's something that happens after bonus season on Wall Street every year. People are reluctant to leave that job until they cash that bonus check, or else, a good portion of your yearly compensation is just forfeited. But so Citigroup this time is making the offer to a limited number of staff, according to people familiar with the matter. In addition to the bonus awards, employees who accept the offer would also be allowed to keep all their deferred stock awards. And staffers cannot volunteer for the offers because they're being made to people impacted by Citi's ongoing reorganization. So a bit of an offer you can't refuse, I suppose.
As they say, right? This is interesting. The CEO, Jane Fraser, back in September announced that she would undertake the biggest restructuring of Citigroup. So this is what's the background to this, right? This is the biggest restructuring in decades. She's looking to make the company more efficient. She wants to eliminate layers of management. There's a 240,000 person workforce at this bank, Mike, and the bank has said that it's expecting to record a charge of $200 million associated with the moves in the fourth quarter. I think not everybody at this point knows who's affected.
Right. Yeah. It doesn't sound like it. But I guess you'll get a tap on the shoulder. And executives, according to the story, hope that offering them a portion of their bonus will basically coax more of them to move on.
Yeah, rather than having to lay people off, right? It's better to sort of do this stuff voluntarily. We got a ton of coverage of Citigroup and all the big banks, not just on the Bloomberg terminal, but check it out at Bloomberg.com. This particular story by Harry Wilson and Ben Stupples, available online and, of course, on the Bloomberg terminal. You're listening to and watching Bloomberg Business Week. I like the 2-hour show, Paul. everyone. Welcome to our final hour of Bloomberg Business Week. We continue our coverage this afternoon on this Fed Wednesday. We're live in the Bloomberg Interactive Broker Studio. We're streaming on YouTube and on Bloomberg Originals. I'm Tim Stenovec. Carol Masser is out. Mike Regan from Bloomberg News is in. He's the head of the crypto team. He's a news editor. He's been at Bloomberg for a while, and he's also been my co-host quite a few times. Good to have you back with us, Mike. We got a great show coming up this hour.
Yeah, absolutely. Looking forward to it. Hearing about some of the big Business Week stories coming up. No spoilers. I'll wait till the guests arrive.
Okay, I'm going to give a little hint, though, to this one. It's about the reign of BlackRock coming to an end. We're going to explain what exactly that means, and that, of course, is in the upcoming issue of Bloomberg Business Week magazine. We've also got back with us the U.S. venture capital leader for EY. He's going to tell us on what 2024 looks like for VC and VC-backed firms. I want to know if this exuberance that we're seeing in the equity market is going to play out when it comes to loosening purse strings for VCs, because we've seen quite a decline since 2021. And this one might appeal to you because you've got a kid in college, Mike. Remember a couple years ago when graduating seniors were getting multiple job offers to boost their salary?
Oh, yes.
Well, yes. A lot has changed since then.
I know. Let's hope it's 2021 again when my kid graduates.
Yeah, let's hope. Fingers crossed. Hey, first up, let's get a check on the day's trade and top business stories. Here's Charlie Pellet.
Thank you very much. Right to the exuberance. Dow at a record up 512 today, 37,090 on the Dow Jones Industrial Average. I'll say it again, a record up 1.4%. S&P up 63 points today. That was a gain of 1.4%. NASDAQ up 200, a gain there of 1.4%. Fed Wednesday, 10-year yield now 4.01%. 2-year 4.42%. Spot gold 2,027 the ounce, while West Texas Intermediate crude was up 1.3%, 69.47 a barrel on WTI. Wall Street's great cross-asset rally got an extra dose of encouragement today as dovish Fed signals pushed the S&P 500 closer to its record while sinking bond yields. Here's Fed Chair Jay Powell.
We are prepared to tighten policy further if appropriate. We're committed to achieving a stance of monetary policy that is sufficiently restrictive to bring inflation sustainably down to 2% over time, and to keeping policy restrictive until we're confident that inflation is on a path to that objective.
After the bell, Adobe delivered a lukewarm outlook for sales in 2024, disappointing investors who expected new generative artificial intelligence tools would boost the software company's results. But after hours, we got Adobe trading lower now by 6%. Big day for Vertex Pharmaceuticals. It rallied after it announced positive results from a mid-stage study of an investigational non-opioid drug to treat painful diabetic peripheral neuropathy. Today we had Vertex up by 13%. Again, recapping, S&P today did advance 63 points, up 1.4%. The Dow at a record also up 1.4%. NASDAQ up 1.4% as well. 10-year yield 4.01%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Right, I like it. The reign of BlackRock is coming to an end, at least in the $7.8 trillion market for U.S. exchange-traded funds, also known as ETFs, which BlackRock has just dominated for decades. I know somebody who knows quite a bit about ETFs. That's none other than Bloomberg News senior markets reporter and BTV anchor Katie Greifeld. She writes all about Vanguard's rise for Bloomberg Business Week. It hits newsstands later this week, but you can read her story now on the Bloomberg terminal and at bloomberg.com/businessweek. Also here in our Bloomberg Interactive Brokers studio, we got the editor of Bloomberg Business Week, Joel Weber. Joel, come on. This was bound to happen at some point. It hasn't happened yet.
Katie and I talk a lot about ETFs. I think from the get-go, we'll just say, Larry Fink, if you're listening, you can reach Tim Stenovec at TSTNOVEC1 at Bloomberg.net.
That's right.
This is not happening yet.
I'm available.
But if you look at the trend line of how Vanguard has slowly risen, and how BlackRock has slowly fallen, there will be an inflection moment. Not too far away, right, Katie? We don't know when.
We don't know when.
It will probably happen.
Probably in the next 18 to 24 months. There are some nuances there, which I'm sure we'll get into. But I mean, like Joel said, this is something that the industry has been watching and waiting for probably a decade at this point. If you take a look at the chart of market share.
It's a lot of popcorn.
A lot of popcorn.
Worth of popcorn.
Yeah, we've been waiting for this one. But Vanguard has been increasing its share of the U.S. ETF market for 21 straight years. Just amazing growth coming out of Valley Forge, Pennsylvania. And BlackRock...
Sleepy there.
Sleepy, yeah. A lot of trees. But BlackRock is still enormous. Let's just put that out there. $2.5 trillion in U.S. ETF assets. But their share has been dropping and dropping. Right now, it's at the lowest in at least 20 years, 32.5%. Vanguard at 29.5%. That is the slimmest margin between these two ever.
What's up with that?
What's up with that? So there's a few things going on right now. Vanguard enjoys a very, very loyal investor base. You think about who they appeal to. It's financial advisors, it's retail investors, not YOLO retail investors, but actual mom and pop. And
Boglehead.
Yes, exactly. And those are very sticky assets. And that type of investor base, it tends to shovel in money to these funds in almost every market cycle. And
actually, when things get worse, they pile in.
Exactly.
It's like, oh, great, buying opportunity, we're in.
Exactly. So that's what they're enjoying. They have a very loyal, sticky asset base. Whereas you think about these BlackRock funds, they're enormous, they're very liquid, and they're trading tools. I mean, Wall Street uses these, and Wall Street, those flows are more volatile.
Well, I wanted to ask you about that, Katie. I too hail from not far from Valley Forge. I'm sleepy myself, so I can relate. Always been fascinated with Vanguard. Because the other reason is I'm notoriously a cheapskate. You know, I do not want to spend more on something. Right, yeah. You can tell. But so I look at, the flagship ETFs of both companies, and Vanguard, 0.3% on the S&P 500. Its expense ratio.
0.03, right?
It was 0.03%.
Yeah.
So 3 basis points.
3 basis points for those following at home that speak on Wall Street language. So to me, it's amazing this hasn't. Why has it taken so long? Like, what makes the BlackRock funds competitive at a higher management fee than Vanguard?
Well, the thing is, I will say that BlackRock has been forced to sort of follow Vanguard's lead here. Yeah. They've had to cut fees as well, introduce their own very low-fee products. You take a look at their S&P 500 funds, the iShares one, ticker IVV, that also charges 3 basis points to match Vanguard's fee. But in terms of why, BlackRock has enjoyed this position at the top of the league table for so long, since 2006, they were an early mover here, and that's really powerful in the ETF market. That first-to-market advantage, you see it both on the issuer side and also when new product sets are introduced, when a new category is introduced. So that is in BlackRock's favor. Also, you think about some of their funds. TLT, that is their long-dated treasury ETF.
God, you love TLT. You love talking about TLT.
Well, I'm talking about TLT so much because it has been insane. The volume in the fund this year has been incredible. People are shoveling so much money into this ETF this year, even though it's
this year's meme stock is TLT.
Kind of. It kind of is. Like these funds that
the normie meme stock.
These funds that BlackRock have, a lot of them are just capital market instruments, and that's really powerful. That's why SPY, which charges 9 basis points, which is the S&P 500 tracking fund, introduced by State Street. It's the oldest, it's the biggest, it's relatively expensive, but it's just been around for so long. That's what people use.
Yeah, still bigger than Vanguard's fund at more than 3 times the. Granted, both are pretty cheap to.
In the grand scheme of life, but this is a market that's measured in basis points, so it's pretty expensive.
You know, one thing that BlackRock has that Vanguard does not have.
Tell me.
Is a filing for a Bitcoin ETF.
I was wondering when we would get there.
Well, we're here now. Everyone's favorite thing to talk about in the ETF world.
It's at least 50% of people's favorite thing to talk about in the ETF world who are in this room.
So if you haven't been following closely, there is no spot Bitcoin ETF, but there's something like, 13 filings?
Something like that.
Something, I lost track. Vanguard is not one of them.
No.
So what's going to happen if BlackRock has a moment here where they get to have a Bitcoin ETF and Vanguard doesn't have one?
This is so fun. I'm so glad we're talking about this because it sort of gets into the spiritual differences between BlackRock and Vanguard. BlackRock has over 400 ETFs. That is a lot of ETFs.
Wow.
They're in virtually every single asset class.
More than anybody else.
Pretty much. You take a look at Vanguard, even though there's only $300 billion that separates them in AUM, Vanguard only has 83 funds. Vanguard is not, they don't even have a commodities ETF. So they're very plain vanilla.
And by plain vanilla, it's like hold the vanilla bean, just like straight vanilla. Yeah.
Exactly, exactly. And I asked Vanguard, will you ever file for a spot Bitcoin ETF? And usually it's hard to get Vanguard to say anything too fired up. They said, absolutely, we have no intent to do this. The case for cryptocurrency is very weak, high volatility, et cetera. Whereas BlackRock, they are leading the charge here. A lot of people watching January to see if that spot Bitcoin ETF gets approved. And if it does, that can give them a leg up, especially if BlackRock puts their spot Bitcoin ETF into some of their model portfolios. That could be a game changer here and buy them a little bit of time.
Except when Joel used to send me down to Vanguard to interview Jack Bogle.
It's true.
Probably 10 years ago at this point.
Yeah.
Talk about, he was happy to shake things up. He would spitfire time.
He'd have a few things to say about a Bitcoin ETF. That no intent was like the G version of what you'd get from Jack Bogle.
Right, exactly. But, Bogle never wanted to have an ETF in the first place. You'd ask him about ETFs, and the argument was, well, you can trade it all day, and he'd be like, why the heck would you want to do that?
Yeah, exactly.
So I wonder, is it sort of the ghost of Bogle that's influencing Vanguard, or is it more to do with just the structure? BlackRock is a for-profit company. It has its own stock. It has its own shareholders to answer to. Vanguard's a completely different business model. So will you talk to us about that? And does that play a role in their decisions on things like this?
I think it is partly the Bogle effect here, to name check a book by Eric
I've read a book
Balchunas.
called that before.
Yeah, Joel, I don't know if you know him.
I do. We co-host a podcast together called Giants.
He's
All
actually
about
not.
ETFs.
He's not quoted in this story though.
Eric Balchunas? I mean,
No.
that would be too on the nose. I
he's
can't
not.
do that. But yeah, I mean, you think about, again, Bogle's choice words. To your point, Vanguard doesn't say anything too, it's hard to rile them up. Bogle definitely was more outspoken. But yeah, he didn't have a lot of love for commodities. It makes sense that Vanguard doesn't have a lot of love for crypto. Again, to go back to the quote that they gave me, they say that most crypto assets, they lack intrinsic economic value. They generate no cash flows. That is a biggie for Vanguard. It's the same thing with commodities not generating any cash flows. Just, it's totally out of their profile that they would even venture into crypto.
It seems like BlackRock might be worried about this. Like, you've seen this lead continue to sort of slip away. It goes back to, obviously, BlackRock acquired iShares, and that was like this amazing acquisition. Do you get a sense that BlackRock's nervous about this, about the moment that they become sort of like the number 2 in the ETF game?
I will say that BlackRock is pretty competitive in spirit.
Yeah.
And I think it's also to point out here, even though their share is slipping, it's a case of the pie is just getting bigger.
The pie is getting much bigger, right?
Much bigger.
Hence the podcast name Trillions. Trillions.
Yeah.
It grows a lot.
Yeah, we're up to $7.8 trillion in U.S. ETF assets, about $10 trillion globally. You take a look at BlackRock's U.S. ETF assets, they're at $2.5 trillion. That's an all-time high. So it's not like BlackRock is shrinking here. It's just that you have this very formidable challenger in Vanguard, and also you have all of the others. I mean, you take a look at the percent of flows that are going to people outside of BlackRock, outside of Vanguard, and it's at a record high.
So it's not just that people want the boring stuff that, boring low fee stuff that Vanguard has. So Joel asked about the competitiveness of BlackRock and if they're watching this closely. What about Vanguard? Do they care if they're number 1?
No, I mean, again, I always, as someone who's been covering this for a few years, I just love the spiritual differences between BlackRock and Vanguard, where BlackRock is competitive and, wants to be number 1. Vanguard does not care. The exact quote that I got from them is, Vanguard isn't focused on who's at top of the ETF league tables. And I believe them. So it's pretty interesting.
They're like, league what?
You watch that thing?
You just come to us. I also, the spiritual difference there is like, the financial advisor, I think, is a set that really gravitates to Vanguard, whereas like more of like probably like the trader is who I think you said earlier, Katie,
Yeah.
right?
Yeah. And I mean, that's something that I make sure to put in every story because it's very real. I mean, even though their share is going down, their importance among Wall Street traders is only going up. A lot of people are using these as liquidity sleeves, et cetera, a way to get quick exposure, these BlackRock products, because a lot of them just trade like water.
Well,
Okay.
go ahead, Joe.
No.
Well, I was going to ask Katie, there's also, I mean, traditionally, when you hear ETF, you think of a passive index tracking product until names like Cathie Wood come up and others who are actually running actively managed ETFs.
Which has been a theme this year. Like active management that has been one of the big takeaways of the year.
Yeah. So where do we stand with that? Are both of these companies losing share to providers that have more active ETFs?
That's where the others come in. Again, you take a look at the percent of share of flows that are going to outside of the big two, and a lot of that is going to these actively managed ETFs. And I gotta say, it's really interesting. Even though BlackRock likes to be number one in most things, they aren't a really huge player in the active ETF space. You take a look at their lineup. Again, they have over 400 US ETFs. Only 38 of them are actively managed, and they have launched a few. Rick Reeder, for example, their big fixed income guy, I forget his exact title, but he's very important. He launched his first ETF this year. So they're bringing out some of their star players in the ETF wrapper as an active strategy. But again, these issuers, they're not known for being active managers, even though they are so huge.
What do you think that would be inside the Tim Sinovic wrapper?
Oh, God. I would love to know.
You have a full minute to think about it, Katie.
I feel like you would be extremely sensible, and then there would be like 1 to 5% of your portfolio that would be absolutely bananas.
Is that Eric Balchunas calls that the hot sauce, right?
Yeah, exactly.
In the burrito, you just put a little bit of hot sauce. You would have, maybe a little bit more than usual.
Oh, I would love a burrito right now. Why did you bring that up? It sounds great.
All right.
All right, should we?
It's a great
burritos
note to end on.
Should we do it? Burritos?
Taco Bell's around the corner.
Yeah.
Right? Also Chipotle.
This is a good piece, Katie. I didn't know we could actually talk for 14 minutes about Vanguard and BlackRock ETFs. But then I saw you come in the studio, and then I knew we could actually.
I was going to ask Katie to name all 400 BlackRock ETFs. Go.
At this point, I could probably get at least 100 of them.
Hey, check out this story. It's in the upcoming issue of Bloomberg Businessweek magazine. It's available on newsstands, online, and on the Bloomberg Terminal later this week. But right now, you can read the story on the Bloomberg Terminal and, of course, at Bloomberg.com. It's about the $7.8 trillion market for U.S.-traded ETFs, which BlackRock has dominated for decades. A big thank you to Bloomberg News senior markets reporter and BTV anchor Katie Greifeld, who writes all about it in the upcoming issue of Bloomberg Businessweek. Also, the editor of Bloomberg Businessweek, Joel Weber. Everyone here at a nice little round table in our Bloomberg Interactive Broker studios. You're watching and listening to Bloomberg Businessweek.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 5:21 on Wall Street. We do check markets all day long here at Bloomberg. I'm Charlie Pellet. We begin with a developing story headline right off of the Bloomberg Professional Service. UBS stepping up its bid to claw back cash from Credit Suisse defectors. We'll get you more details as they become available. Big day for the U.S. stock market today. A record for the Dow. Wall Street's great cross-asset rally got an extra dose of encouragement as dovish Federal Reserve signals push the S&P 500 closer to its record while sinking bond yields. Here's Fed Chair Jay Powell.
Inflation has eased from its highs, and this has come without a significant increase in unemployment. That's very good news. But inflation is still too high. Ongoing progress in bringing it down is not assured, and the path forward is uncertain.
Traders cheered a tweak to the Fed's dot plot, with officials expecting to lower rates by 75 basis points next year, a sharper pace of cuts than indicated in September. Bottom line, again, a record for the Dow today, up 1.4%. The Dow Jones Industrial Average now at 37,090. The S&P up 63, 4707 on the S&P, up today by 1.4%. NASDAQ, the composite index, up 200, higher by 1.4%. 10-year yield, 4.01%. Two-year yield, 4.42%. Spot gold at $2,022. And West Texas Intermediate crude up 1.2%, $69.47 a barrel. After earnings, after the close of trading today, we did hear from Adobe. Adobe shares trading lower after hours, down by roughly 6%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Hey, check out the new Bloomberg Business app. It features Apple CarPlay and Android Auto. You can listen to Bloomberg Business Week and all of our Bloomberg radio programs at any time. All you got to do is download the Bloomberg Business app on your smartphone, then connect your phone to your car. It's free. It's in the Apple App Store. It's on Google Play. Thanks to our sponsor, Interactive Brokers. Tim Stenevec and Mike Regan in our Bloomberg Interactive Brokers studios. Mike, VC-backed companies raised $29.8 billion in the third quarter of this year. So if we go back to last year, that's down from the $40.3 billion in the same quarter, but then go back to 2021, that was $82 billion in the third quarter of 2021. So we're down significantly from them.
Everything reverts back to 2021 as the year when nothing made sense and that everyone made money, I guess. But
and now we're like close to, we're like at 2021 levels on the S&P 500 at this point. We are at 2021 levels.
So maybe the VCs will come back.
Yeah, well, that's the question. We'll pose it to Jeff Grabo, U.S. venture capital leader for EY. He works both with entrepreneurs and VCs as companies try to scale. He joins us on Zoom from Palo Alto, California. By the way, those figures that I gave, that's from data from EY and Crunchbase. Jeff, good to have you back with us. How are you?
Thank you. Great to be here.
So what do you think? I mean, Mike and I have been talking all afternoon, both on air and off air, about what we're seeing in the equity market as sort of this exuberance. Are we going to see the exuberance come back to the VC world?
Well, I mean, looking back at 2023, we've seen the continuation of the slide that we saw in 2022. There's been a deceleration of capital as the fundraising environment's gotten more challenging. And when we look back, Q4 of 2023 is about half of where it was in Q1. So not the, that's on a national basis. So not the exuberance that you're seeing in the equity markets. Companies have went into a sustained mode and pulled a lot of levers to try to stay out of the fundraising markets as they became more challenging.
Well, Jeff, what is exciting in the VC space these days? I always picture VC money as kind of following trends to some degree. It was crypto and blockchain for a while there. I'm guessing is AI really the star of the VC show these days?
Well, I mean, AI has definitely been a bright spot, and without AI in 2023, numbers would have been down significantly from what we've seen. It's a transformational technology. Companies are eager to deploy it, eager to put it into operation to see how they can get efficiencies, cut costs, all the things that we talk about. I think it's overhyped in the near term and underhyped in the long term. But I think it's something that that everyone's focused on right now.
But is there a belief that venture-backed companies can take on the likes of the more mature companies, even if they are venture-backed, that are out there right now? The Anthropics, the OpenAIs, Google's DeepMind, what Microsoft is doing, what NVIDIA is doing. Is there a belief in the venture capital community that, you know, a couple of kids in their garage in Palo Alto can do this?
Well, I think we may see a slight slowing of what's going on in the AI markets. You're still going to see large amounts of capital deployed, but I think we're seeing where there's some questions around, because the technology is moving so fast, where platforms end and where extensions begin. And so I think there needs to be some settling on that. But I think long term, there's going to be lots of opportunities out there for companies, and these companies are going to take significant amounts of capital to be able to do what they think they're going to do. So I think it's a good opportunity. It takes time, and we're to use sporting analogies, we're in the early innings of the AI game.
Jeff, it used to be the paradigm always was, you start a company with venture capital, you grow it, and oftentimes you then take it public through an IPO. The IPO market this year has been just awful. So I'm wondering how important it is for that IPO market to unfreeze in 2024 for the venture capital industry, or is there enough sort of money sloshing around in VC funds to keep these companies going if the VC market does pick up in 2024? Talk to us about that relationship between a robust IPO market and what it means for the VC world.
Well, I mean, generally speaking, I think a robust liquidity market is always good for investors. And the phenomena we've had, to take a step back, there's three levers, kind of three legs in the venture ecosystem. It's fund formation, it's capital deployment, and it's liquidity. And we've had phenomenal fund formation the last 5, 6, 7 years, incredible fund deployment. Since 2018, there's been over $1 trillion invested into venture-backed startups in the U.S.
Jeff, it sounds like we lost you. We're going to work to get Jeff's audio back right now. That's Jeff Grabo. He, of course, is U.S. venture capital leader for EY, working with entrepreneurs, VCs, as these companies try to scale. My next question for him, Mike, was all about interest rates, because we're in an environment right now where we got more than almost $6 trillion in money market funds. And if you're a high net worth individual and you say to yourself, okay, well, there is an alternative these days. The days of Tina are gone. Bonds are paying, not as much as they were a month ago, but bonds are paying. And money market funds are paying over 5%. So what does that mean for fundraising for venture capitalists?
That's right. It's got to be a headwind, I would assume, right? But yeah. I mean, we look at this market today, just the mere hints from the Fed that, these rates could be coming down next year really just, lit the public markets on fire today. So it does make you wonder what's going on in VC land too.
Hey, when do we see, I'm kind of, as we get Jeff back, I'm going to take advantage of having you in the studio and pepper you with some questions, Mike. When do we start to see lower rates seep into the money market funds as the market expects rates to be lower?
Well, it's certainly that front end of the Treasury yield curve is so important, and when you see this dip in the 2-year yield today, wow, by the end of the day, we're talking about a 30 basis point drop in the 2-year yield, and that's not even looking at the T-bill yields, even shorter term. Those money market rates will adjust pretty quickly. They're all short-term investments in those funds, so they will. You'll see a reaction